The names that move markets are on Bloomberg.
We've seen story after story about companies delisting from the London Stock Exchange, listing in New York, listing in Europe. I want to turn that around. I want Britain to be the place of choice to make an IPO, to grow your business. That's why I welcome the reforms that the FCA put in place last week. It's also why I'm determined to change our pension system so we can keep more businesses here in Britain.
Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close.
1 minute remaining. I'll lead with the weekly initial jobless claims number.
Context changes everything. Power, money, culture. As Linda Hammond tells the story of Asia's rise through the people who are helping to
According
shape
to a source, the OPEC Plus JMMC are to meet next week on October 2nd.
Inspired by the fusion of East and West.
I'm like the ambassador of the tour.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg.
10 seconds.
60 minutes away from the opening bell. Some important economic data just seconds away. Mike McKee's in Washington, D.C. He'll break that down for you. The scores going into jobless claims look like this. Futures are positive on ES&P.
249k, 249k, higher than forecast, 236k. With continued claims of 1.877 million, 1.877 million, higher than forecast 1.855 million. US unit labour cost prelim 0.9%, 0.9%, lower than forecast 1.7%. Productivity prelim at 2.3%, 2.3%, higher than forecast 1.8%. Looking to the market, seeing some whipsawing in the S&P 500, but some weakness coming through in the dollar. Another OPEC Plus statement now says the JMMC meeting reiterated that the gradual phase out of the voluntary reduction of oil production could be paused or reversed.
Was 235, so a big change in initial jobless claims. We also get unit labor costs and non-farm productivity. Productivity rises a lot more than the first quarter and more than expected, 2.3%. Forecast was for 1.8, and unit labor costs drop just up by 0.9%. They were up 4% in the first quarter. So good news on labor costs and productivity on the inflation side of the Fed's mandate, but still some issues on the
So Q2 prelim prior revisions here. So the productivity prelim prior was revised up to 0.4% from 0.2%. Unit labor cost revised down to 3.8% from 4%.
More people getting claims, taking longer to get jobs. Interesting thing I was looking at today is we started today with, John, the Fed funds futures, the overnight index swaps, basically where they were on Tuesday. Volatility yesterday, but everybody expecting at least one rate cut. And now we're pricing in a little bit more than just the one rate cut because these numbers are apparently something that the market thinks will worry the Fed.
I can tell you, Mike, 3 basis point swing at the front end of the curve. Not much, but directionally, this is how we've responded to that data. We're down about 2 basis points now on a 2-year, the very front end of the curve. We were higher going into the number by about 1. So down about 2 or 3 basis points at the front end of the curve becomes a 4 basis point swing at the front end. That's just dancing around the front end. But you can see how we've responded to this. The wrong kind of upside surprise on jobless claims going into payrolls tomorrow. I'll go back to the estimate for payrolls tomorrow. It's 175. The previous number was 206. But certainly, if you get much of a downside surprise on payrolls, maybe an upside surprise on unemployment. Lisa, it just goes back to that conversation that we've had repeatedly on this program. You've got to draw me a line. Tell me what the distinction is between a welcome cooling and an unwelcome deterioration in the labour market.
Yeah, does the Fed still have time to really assess all of the risks and make a move in September of just 25 basis points? I do want to just put into size and scope some of these claims that we're getting. Jobless claims coming in at the highest rate going back to August of last year. Continuing claims coming in at the highest since November 2021. A market shift upward at a time where people are starting to see those cracks in a growing number of places.
Mike, we've had a couple of head fakes so far this year when it's come to jobless claims. They've started to gap out, push higher, and then they've come all the way back in. How much weight would you put on this number this week?
Well, because it's such a big move in a short period of time, I would be reluctant to say it's a new trend. Let's see what happens next week. But we are pretty much past the plant shutdown month of July, so maybe this does have some validity to it. And certainly there have been a lot of concerns about the labor market and how fast it might be slowing. You heard all the questions for Jay Powell yesterday. It'll be very interesting tomorrow to see what happens. And if we got a 0.1% rise in the unemployment rate, triggering the SOM rule, that would be it'd be interesting to see what the markets do with that.
There is this issue going into tomorrow's non-farm payrolls report of what is more important, the headline number or the unemployment rate. We've been talking extensively about that at a time where it's very hard to gauge what the correct amount of jobs being created for this market currently are. Michael, what do you think is going to be more important? Certainly not just for market participants, but also for some policymakers.
Well, I think the unemployment rate is what everybody's going to be looking at first. If we get a really strange headline job creation number, very high or very low, that might take precedence over the unemployment rate. The unemployment rate has been influenced by the size of the labor force a lot in recent months. So we have to look at that first. So both probably, we come into this with both probably being important. We'll just have to see which one dominates.
Hey, Mike, appreciate the update. Thank you, sir. Just to recap things for you. Jobless claims, the wrong kind of upside surprise. Unit labour costs a little bit softer than expected for the second quarter as well. Let's push this through the market. We'll start with stocks, go to bonds, finish on foreign exchange. Equities stay elevated, up by 0.6% on the S&P 500. In the bond market, we were just a little bit softer at the front end. Yields were just a touch higher going into the number. We're down by about 2 basis points. That's not a big move, but directionally you can see how the market's responded to that economic data. The wrong kind of upside surprise on claims. We just back away a little bit on 2-year yields again, encouraging that idea that maybe this Fed has got to go in September, perhaps even for some of you I know, they think they're late already. Okay, let's turn to foreign exchange. The dollar fades as you get that rally at the front end of the curve. The euro, just a little bit stronger off the back of it, but still down on the session by 0.2%. 108.07. Lisa, that debate gets a little bit more fuel going into payrolls tomorrow morning.
Yeah, especially because this is a point in time and usually it isn't linear. And that's really, I think, what's really creating some anxiety for some people. You know, I'm a little bit confused because we have people come on the show and say that the jobless claims are actually the most high-frequency data and most dependable data to really see and gauge the labor market in real time. And then it comes out and people say it's noisy, you can dismiss it. So I'm trying to figure out which is which at a time where the continuing claims are coming at the highest pace since November 2021.
Over the last 12 months, we have seen claims pop higher and then pull back again. And I think after you've seen a series of head fakes, you do question where we are right now. Let's get to the panel. Greg Peters of PGIM Fixed Income alongside Subhadra Rajappa of SocGen. Subhadra, I want to start with you. You said we see signs of easing, of softening, but no immediate need to ease, to cut interest rates. Where are we in the labour market at the moment?
So we're definitely at a cusp. I mean, today's numbers is something worth paying attention to. We want to figure out if it's something idiosyncratic related to to Beryl in Texas or something else. I mean, but we are hearing other headlines. I heard perhaps Intel is looking to lay off employees. So this is definitely something worth paying attention to. But again, it's very hard to read too much into one data point. Like Mike McKee was saying, you're going to have to look at the totality of the data. And that's when tomorrow's data comes in, it becomes very important. If you look at the headline number, our economists expect another 200,000-ish jobs being created. And the unemployment rate might tick up, but again, the most important data point for me tomorrow is going to be that unemployment rate. If that goes up above, say, 4.2%, that's going to send out alarm bells.
Do you think that this market will respond as if we're already in a recession, if we go to 4.2 and everyone runs around screaming, SOM rule, SOM rule?
Not really. I mean, there are many indicators of a recession.
Traders add to Bank of England easing wages, favouring 2 more cuts this year now.
Not to be a good predictor of recessions. To me, the one metric that I track very closely is corporate profit margins. And corporate profit margins are still relatively healthy. As Mike McKee again pointed out,
noting cable as well, pairing losses just down 0.3% on the session as the Bank of England press conference is underway.
People entering the workforce, higher participation rate because of immigration, then that's something that we might want to dismiss.
Greg Peters of PGIM also with us. And Greg, I'm curious from your perspective, what your reaction is to these numbers, given that the balance of risks, at least the Fed believed, was fairly measured. And the labor market is still somewhat of a mystery, but certainly showing signs of cooling.
Yeah, so I mean, the markets have definitely moved from worries around inflation to worries around labor. At the same time, those worries should manifest quite differently, and they're not. So, for example, if the bond market's worried about labor rolling over, triggering the Somme rule that leads to a recession, then that should have an impact on risk assets, and you're not seeing it. So, for me, there's a continued confusion around the data reads. The bond market continues to price in, I think, too much in terms of rate cuts. Obviously, a weakening labor market has a very different output relative to disinflation coming through the system. But risk markets continue to kind of trade happily along. And so I think that disconnect needs to be rectified here over the next couple months or so.
Greg, let's build on that. So who's wrong? Is it the bond market pricing in too much accommodation in a weaker economy, or is it risk assets which are pricing in way too much strength, in your view?
Well, as the answer always is, a little bit of both. But I do think the bond market is pricing in entirely too much Fed accommodation. The way we're looking at the forward curves, there's about 200 basis points of cuts being priced in. I think you need to see a real rollover in the economy for that to come to fruition. And if that is indeed the case, then risk markets are priced too richly. So the disconnect in my mind is more on the bond market side. As Subhadra said, kind of at the micro level, what we're seeing out of companies and boots on the ground, it's just still a robust environment.
So, Greg, you had said previously at the start of the summer that the macro story is a positive one for risk taking. Is that your view still of things as we get deeper into summer?
I think it is. I look at the fixed income markets, the credit markets. I think we're in a very good place. While I do think the bond market's pricing in too much, it has been pricing in too much almost persistently, the past several years. And fundamentals look pretty robust, and less hiring is a very different environment than a lot of layoffs, which is where the Somme rule start to really trigger as that catalyzes the recession. So we haven't seen that yet. We're not really hearing that from companies, and so we think we're in a pretty decent fundamental place here. And the bond market is pricing in too much.
Subhadra, start of the year, consensus trade, bull steepener. 2 years going to rip. Fed's going to cut 5, 6, 7 times. Economy's going to decelerate. Didn't see it. July happened. Big rally at the front end of the curve. Everyone gets excited again about the so-called bull steepener. Do you agree with Greg? Do you take the other side of this?
I completely agree with Greg. I mean, our point has been, in fact, for the last few months, we thought the Fed will be on hold for the remainder of the year. So I feel like the bond market is overpricing cuts for this year. And as Greg pointed out, and he tracks this more closely than I do, you're not seeing a rise in defaults in some of these corporations. The corporate sector in general seems to be very healthy. There's money that's going into these risky assets, and financial conditions, broadly speaking, are relatively easy. So this move recently has come from a decline in 2-year yields, and at times it's come from rising long-end yields. So if you see real weakness in the economy, you should see the entire yield curve, decline meaningfully across the curve. And a lot of this has been, the unwind of the Trump trade, the markets looking at what the impact of the elections are going to be. So to me, it feels like at least the front end of the bond market is overpriced for cuts given the general health of the economy.
Jason Thomas of Carlyle was on earlier, and Subhadra, you seem to suggest that things are priced to perfection somewhat on an index level, certainly with the momentum trades. And it seems like Greg Peters is somewhat sympathetic with the idea that there needs to be some sort of coming together with some froth coming out of the risk assets and maybe fewer cuts being baked into the bond market. Do you agree that there needs to be sort of a meeting of those worlds, and it means kind of mild losses on both?
Yeah, I think at some point there's going to be a meeting of both those worlds, given the fact that you are seeing some areas of the economy that are slowing down, that are going to perhaps do well, especially the interest rate sensitive sectors of the economy are going to start doing well when the Fed cuts rates. And the question is if they're going to be able to orchestrate a soft landing this time around, or we go to that traditional route where the economy slows down too much and they're too late to the party to cut rates, and that leads to a more meaningful recession. Right now, there's really nothing in the data that suggests that that there's any sort of an urgency for the Fed to cut rates. But at some point, that normalization will happen where the economy will slow down and the Fed will have to cut more deeply.
Greg, just your final thought. Am I characterizing your view correctly, that in some ways there is a bit of a price to perfection kind of feel in markets here?
Absolutely, Lisa. You know, as I mentioned, we're pretty constructive on risk assets. We think the fundamentals are pretty decent for risk taking. The challenge that we have is that it's already priced that way and then some. So the risk reward is really quite poor. So you know, the markets have been front running as they normally do the fundamental picture, but I think it's just priced too much for perfection here. It's hard to be on the right side of the trade from a long perspective.
That was Lisa managing to make even the bulls sound bearish. Greg Peters of PGIM and to Patrick Schnapper of SocGen. To the both of you, thank you. Well done, Bramo.
Thanks, you're welcome.
Well done. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The Democratic National Committee says Vice President Harris is the only person qualified for the Democratic presidential ballot. Harris has secured the support of 99% of participating delegates since entering the race less than 2 weeks ago. As for the timeline going forward, the virtual roll call to make Harris the official nominee will run from today until the 5th. Harris is then expected to announce her running mate by August 7th, and then 12 days later, the party holds its convention in Chicago the week of August 19th. And another day, another record for NVIDIA. The chipmaker added $329 billion in value in yesterday's trade. That's the largest gain for any stock in a single day. It's a record the company has set many times over the past few months. But that 13% rally comes a day after a 7% rout, and that wiped out more than $193 billion. In the last month alone, the shares have seen drops that accounted for half of the 8 biggest market cap wipeouts on record, according to data compiled by Bloomberg. And it is day 6 of the Paris Olympics. Simone Biles and some of her teammates are set to compete in the women's gymnastics individual all-round final. In swimming, there are 4 finals on the schedule. All eyes will be on Team USA and Katie Ledecky in the 4x200-meter freestyle relay after she won her 8th gold medal in the 1500-meter freestyle yesterday. The U.S. is leading in the overall medal count with 31. 6 of them are gold. China, meanwhile, has 11 gold medals and 21 overall. And that's your brief, John.
Danny, thank you. Appreciate it this morning. Up next on the program, we'll set you up for the day ahead and get the latest on the election campaign with Eric Cantor of Moelis & Company. That conversation just around the corner.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
UK bonds extend short-end gains, 2-year yield down 11 basis points to 3.72%.
Counting you down to the opening bell, just around the corner, 42 minutes away. Your scores look like this in the equity market. On the S&P 500, firmer by around about 0.5% through much of this morning. Moments ago, we had a soft jobless claims print. Upside surprise, the wrong kind of upside surprise. Bonds rallied, yields dropped just a little bit. The 10 years back down to just north of 4% at 4.03. Your trading diary, the calendar looks like this through the next couple of days. At 9:45, we'll get the S&P PMI data. ISM manufacturing gap just 15 minutes later. After the close, we'll hear from Apple and Amazon. We'll round out the week on Friday with the July payrolls report. And as we turn to the presidential election, the DNC set to nominate Kamala Harris in a virtual roll call beginning today ahead of an anticipated vice presidential pick announcement at some point in the next week or so. With us around the table for some thoughts on all of this is Eric Cantor of Moelis & Company, the former House Majority Leader. Eric, it's good to see you, sir. Thanks for dropping by.
John, it's great to be here.
This is not a therapy session, don't worry, but I will ask you about your feelings. How frustrated are you that this whole campaign so far on both sides is just about vibes and feelings and not about policy?
Well, you have to sort of take a step back and realize where we're operating in. We are operating in the ecosystem of the digital universe that we're in, and just the incentives, I think, for much of the press and journalists is to sort of evoke a response that will go viral. And I think that's just where we are right now, and I think ultimately what will happen, the impact of this election will impact families, businesses, sectors, Wall Street, whatever. And I think at the end, we got to get down to this discussion. We're just not there right now.
So in 10 minutes time now at the top of the hour, see the release of the Bank of England Decision Maker Panel Survey.
And what kind of potential framework are you going to come up with for the federal deficit? Look, there are all these questions that we have that we don't really have answers to, but the hints of it don't point to one party being more business-friendly than the other. Do you get a sense of which that business-friendly governmental party is anymore?
Well, if you take a look at what's going on globally, I mean, we have seen as this year has been dubbed the year of the election, and there have been, I think, almost half the globe's population has gone to the ballot box, so which does speak well for democracy. I know there's a lot of calls for the demise of democracy, et cetera. But I will say that the common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor. And our country is not immune from that either. I look at the left, and they have always been about populism versus business and Main Street. But even my party now, we have seen an increase in the voice, which advocates more of a populist, more robust government involvement in the economy. And I think what that means is we're going to be set up in the Republican Party for a real debate now going forward. We haven't had one of those in a while.
What do you think that debate should be?
Well, I think what it will be is you've got, voices who have come to the fore. I mean, there's been no secret that our vice presidential nominee, J.D. Vance, has taken a very different view than those of us who are more traditionally, let's say, classical, economically liberal in terms of lower taxes, less regulation, a limited government posture and fiscal discipline. Those are the kinds of things that I think someone like me would stand for. And then as far as foreign policy, I don't think that necessarily the voices that are talking about, isolationism or nationalism are necessarily those who feel like America needs to lead in the world. I mean, I do think that if it's not for our country, I worry about where the world goes and how that impacts us here at home.
How do you bring that idea back alive in the Republican Party? Because it feels like it's dead and buried.
Well, I do think that we're going to see things play out. I do think we will win the election, and hopefully we'll have a unified Republican government in Washington that can affect some change. And I still think there is the overwhelming majority of members of my party who will serve in policy-making positions who do share where some of the, what I call more orthodox Republican positions of lower taxes, creating an environment for investment, for risk-taking, to create more jobs, more productivity, and more wealth.
So is that what you tell your clients who ask, in particular about J.D. Vance and some of his comments, in particular about Lina Khan and the FTC currently and how much it has engaged in policy that he thinks is good in terms of breaking up big business? How do you advise them to understand that if you think that your party, the Republican Party, will ultimately be pro-business?
So it's so interesting because at Moelis, many of our clients are watching what's going on in Washington, wondering what's going to happen on the regulatory environment. There's no question. And if you look at this election, it is an election where we're going to have some change from a statutory standpoint and regulatory standpoint because there is no incumbent running. So even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means. But what I think is going to happen as far as sort of the regulatory outlook is that you'll see change. You'll see a rotation in asset allocations. I mean, we're already seeing so much of that going on in the markets from the S&P into the Russell. But I do think all of this is going to bring about some more activity in the markets. And I know from Moelis & Company's standpoint, we're very optimistic going forward.
Do your clients and your colleagues and yourself donate to both parties to sort of cover your bets, or is it sort of, picking a side?
Listen, look, it sort of goes back as long as I have been sort of attentive to this stuff. Wall Street, business in general, it's not a monolith. It never has been. And it's about trying to affect the policies that create an environment for growth. And if there is an administration like there is now that is very hostile to growth, I see. I mean, if you look at Lina Khan, she has just tried to pursue this very unorthodox sort of thesis in antitrust, and the courts have pretty much pushed her back.
In 5 minutes' time now, at the top of the hour, we see the release of the Bank of England Decision Maker Panel Survey.
It's incumbent upon Kamala Harris to step up and say, how is it that she's going to deal differently if she wants the support of the business community?
We'd like to see that interview. I'll put it that way. It's working for her not having one at the moment and not answering questions. We'd like to see that interview, particularly here at Bloomberg. I want to squeeze this one in. 1 minute. What's the biggest difference between Trump 1.0 and Trump 2.0? How have things changed?
I'm not sure I'm qualified. I think there's only one person who could tell you that, and that's President Trump. Look, the unpredictability factor is something that's worked for him, so you don't
US Treasury 10-year yield hits the lowest since early February at 4.016%, last down 7.9 basis points at 4.0238%.
Trump won, which was really a deregulatory environment trying to produce more investment and more growth in our economy. And I think, look, Donald Trump is a business person. I mean, he does understand that, Washington can either be an adversary or can be there to provide and condition an environment for investment. And I know that is his goal, to want to win as America. And my bet would be on that.
Well, we all want that. We all want to win. Eric, thank you, sir. It's good to see you. Thanks for dropping by.
Pleasure.
Eric Cantor there of Moelis & Company and former House Majority Leader. Tomorrow, Mohammed Al-Erin of Queen's College, Cambridge, Sarah House of Wells Fargo, Priya Misra of JP Morgan, Nadia Lovell of UBS. Payrolls Friday just around the corner from New York City. Thank you for choosing Bloomberg TV.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
The more that you learn about this case, the more it reads like a Hollywood script.
US Treasury 2-year yields fall to a 6-month low of 4.235%, last down 8.3 basis points.
They could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant?
Shortly expecting the Bank of England decision maker panel survey.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
The effective Fed fund rate's unchanged at 5.33% for July 31st.
Futures flying after the Fed with 30 minutes to go until the start of cash trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, investors cheer as Powell signals that a cut may come in September. Meanwhile, Meta's upbeat earnings also fueling this rally. Now, all eyes turn to Apple and Amazon, which report after the bell today. And from $25 billion to zero. Details on how Bill Ackman's IPO dream imploded in just a few weeks. But let's take a look at where markets are trading about 30 minutes until the cash trade opens. You can see green on the screen once again. S&P 500 futures up about 0.5%. Of course, we had a relatively dovish Powell yesterday. We also had some pretty solid earnings, which we'll get to in just a bit. But you can see that in the NASDAQ 100 as well. That index higher by about 0.5% as big tech roars back to life here, and relatively quiet in the bond market right now, but that's after a big rally. Shonali, you can see we're just about at 4% on the 10-year Treasury yield.
And speaking of rallies, we're watching shares of Meta and Nvidia both rising pre-market. Meta now up more than 9% after revenue beat expectations, selling that AI story, Katie. Also, Meta in conjunction with Nvidia on the rise for another day. Gains of nearly 13%.
So just a correction, then the Bank of England decision maker panel survey due for release at 9:30 a.m. Eastern Time, not 9 a.m. Eastern Time. So just under half an hour's time now.
Nvidia follow through on that huge rally that we saw yesterday. Of course, adding a record amount of market cap. We'll see if that holds. But also a big focus, of course, on the Fed, because there will actually be 2 more CPI prints before that Fed meeting in September, and inflation keeps falling. Paul's Torsten Slok says that the Fed will have no choice but to cut rates.
Growth has actually been quite strong, whereas inflation has been coming down. So we have in the market and even the Fed been expecting that the economy would slow faster for the last 5-6 quarters. That hasn't happened. So that does raise the question, why should the economy be slowing faster over the next 2 quarters if it didn't happen over the last 5-6 quarters? So for the Fed, I do think that if we do get inflation still moving lower, they have now promised us that they will be cutting rates in September.
And of course, you'll remember that Torsten Slok was out with that big call that
In the Bank of England decision maker panel survey, year-ahead own price inflation was expected to decline at 3.7% in the 3 months to July, and 0.2%, that's 0.2 percentage points lower than firms reported in the 3 months to June.
And Mike, you and I have talked about sort of when does the inflation worry shift to worries about growth? And it seems like the Fed is very aware of both parts of its mandate right now.
Yes, and as John Maynard Keynes apparently never said, but gets credit for, when the facts change, I change my mind. And that's what we're seeing a lot on Wall Street and around the world. Bank of England, the latest to move interest rates today. They cut by a 1/4 percentage point to 5%. And the question is, do they keep going? Because it was a 5-4 decision, very close. Bank of Japan, as you can see, raised interest rates. The Fed stood pat. But as you can see on that chart there, they are expected to start cutting aggressively, and the story may be in the labor market. That was what Jay Powell was talking about yesterday and asked about a lot. Do they have concerns about the labor market weakening too fast? And you see it in this morning's jobless claims numbers. 249,000 jobless claims, a big jump from 235 the week before. Now, July is always a month with seasonal issues, so we don't know if it's an actual trend, but as you can see, claims have been moving up for some time. Does it mean a weak payrolls report tomorrow? That's what everybody is going to be watching. The data ahead, as you mentioned, Katie, we get a couple of CPI prints and a PCE print and 2 jobs reports before the Fed next meets. And tomorrow's numbers expected to be 175,000 jobs created and 4.1% unemployment rate. But if we get a 0.1% rise in the unemployment rate, we trigger the SOM rule. If we get to 4.2%, which suggests that once you get to a certain level of unemployment, it accelerates rapidly. So the Fed may be indeed cutting in September, but the question is it because the economy has slowed significantly and we have problems in the labor market, and are they behind the curve, or is it because inflation just went away?
Michael McKee in Washington, thank you for joining us. Of course, come back home. We have jobs to cover tomorrow. But joining us for now is Megan Horniman, CIO at Verdence Capital Advisors. And you see that labor market starting to show those signs of weakness, and you see the earnings picture and some signs of weakness as well in the consumer. Of course, those are backward-looking points. Megan, if you look at the forward look, compared to what you're seeing in the job market, how much more weakness follows through in that consumer story?
I think there's still some weakness to go for the consumer. If you look, they've been spending specifically on credit cards. Credit card debt's at a record high now. This is concerning given the fact that they just continue to spend and fuel this debt level that they have. So I think you're going to see the consumer pull back. We are seeing some weakness there in the labor market. We've seen mixed reports on consumer confidence. There's been some weakness shown there. So I think the consumer has some ways to go here. The other thing is, if you look at, I keep mentioning credit card debt, but if you look at delinquencies, they're now rising pretty rapidly. So there's still some room, I think, for the consumer to weaken.
And I want to link together what we're seeing, of course, with the Fed and with earnings season. There was a great story on the terminal today that if you take a look at earnings calls, the words Federal Reserve on track to be mentioned about 380 times on second quarter earnings calls with analysts. That's would be the highest tally ever in records going back to 2001 if this pace holds. And I mean, when you think about that and you think about the health of corporate America right now, the health of the consumer, I mean, how badly do some of these big companies need and want a rate cut?
I think want is the word there of the day. These companies want it, investors want it. This is what I think we're seeing. I think there's a little bit of a difference on the need side of it, though. I do think the economy's slowing. I think the consumer's in trouble, but we're not collapsing. And this collapse that everyone has expected has not occurred yet. So I think the Fed, that's why they're in this difficult situation, because inflation is slowing. It's not where they want it to be quite yet. The labor market, yes, it's weakening, but the absolute level of unemployment, the 4.1%, is still relatively low. Now, this morning's numbers that we got, and I know it's been mentioned that July has some seasonal effects in it, but when you look at the continuing claims that are at the highest level since 2021, that's something the Fed is going to take notice of as well.
Megan, if you take a look at the 3 cuts being priced in through swaps markets for Fed rate cuts, do you think the market, the economy, really needs those cuts right now?
No, not at all. I think if they do anything in September, again, the market's pricing it in fully for September. The Fed's kind of opened that door for that. But they've also made it very clear that there's a lot of information between now and that September meeting. We'll have 2 jobs reports, 2 inflation, more than 2 inflation reports that they'll get before we see that September meeting. So there's a lot of information between now and then. I think the most market-moving event we'll get will probably be at the end of this month when we get that Jackson Hole speech. That tends to bring a lot of volatility when the Fed speaks at that symposium. We'll probably get a little bit more idea then if September's a done deal. But I don't think that they have the flexibility, given that inflation, there's many areas of inflation that still are sticky, that they can come in with 3 rate cuts. I just don't see that possible.
Yeah, and it's a good point about Jackson Hole. They always tend to make news in the mountains, so definitely one to watch there. But let's talk a little bit more about earnings season. Of course, this was really the heart of earnings season, one of the busiest weeks out there. You think about what we've learned from big tech in particular. Do you think that this has sort of spelled the end of the rotation trade? Maybe we could still broaden out, but when it comes to leadership in this market, do you think that tech is in the driver's seat?
I think so for now, but I also think that the tech is also being driven by the fact that, as you mentioned, the market's pricing in 3 rate cuts. It's also being driven by the fact that we are sitting at that psychological 4% level on the 10-year, and we tend to see tech do well when interest rates move lower. I think there's a little bit of way too much optimism, I think, almost you could say price for perfection in the tech side. And I think that there is room for rotation that we saw on some of those small and mid-cap stocks, but the threat to small and mid-cap stocks right now is how slow the economy gets. If the economy slows much more than anticipated, then you will see, I think, some weakness there because they do tend to be cyclical.
All right, Megan, always great to speak with you. Appreciate you taking the time. That is Megan Horniman of Verdance Capital Advisors. Now let's take another check on futures right now because it looks like we're going to have another rally on our hands. You take a look at the S&P 500, up about 0.4% in the pre-market. Same too if you take a look at the NASDAQ 100, of about 0.3%. Not so great when it comes to the small caps. The Russell 2000 just about flat right now. But let's take a quick peek at some of the big names moving because that's where all the action is in the single stocks right now. You can see Meta absolutely flying up 9% pre-market, of course, after their performance on the earnings stage last night. Different story for ARM, of course, sticking to that tepid sales forecast, weighing on shares right now down about 11%. And Carvana actually turning a surprise profit, and you can see that surprise in the shares right now, up about 10%. We're going to get to all of it next. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
now to high interest, a look at what's making headlines around the world. Russia is releasing Americans, Wall Street Journal reporter Evan Gershkovich, former U.S. Marine Paul Whelan, and the Russian-British dissident Vladimir Kara-Murza as part of a major prisoner swap with the United States. The two Americans have been jailed in Russia on espionage charges denied by them and the U.S., and in exchange, the U.S. and its allies will return prisoners to Russia that they hold under the deal. And the Israeli military said it had confirmed that Hamas military chief was killed in a strike in Gaza last month. The announcement that came after a day that Israel said that it had killed the group's political head in Tehran. And former President Donald Trump openly questions Vice President Kamala Harris's racial identity. Trump spoke at a contentious roundtable at the National Association of Black Journalists yesterday in an effort to reach out to voters of color. Harris condemned the comments, calling out the same old show of divisiveness and disrespect. Katie.
All right, and let's turn back to earnings right now because shares of Meta soaring in the pre-market, up about 9% at the moment. That's after the company reported a revenue beat as investments in AI help it sell more targeted ads. Bloomberg Intelligence senior tech analyst Mandeep Singh joins us now. And this was really the bar that these companies had to meet this earnings season, whether or not they could show that their spending was actually paying off. And in Meta's case, it seems like they actually met that bar.
And look, I think in the case of Meta, they are skewed to e-commerce, gaming, entertainment, these verticals. So it looks like the ad spending is really coming back very sharply for these type of companies. On the AI side, I mean, they are infusing AI across the revenue opportunity there because that's the one app they have not monetized, even though it's got, over 2 billion daily active users.
Does this give Meta more legway here to spend more on AI ultimately, given the payoff it's seeing across the multiple platforms?
Actually, that's what I was surprised by. They were quite prudent on their call about how they are going about CapEx. Remember, Microsoft said, we are going to increase our CapEx every quarter going forward till the end of 2025. Meta actually underspent versus consensus in this quarter. They said, the lower end of the guide is raised by $2 billion, but they kept the upper end the same. In 2025, yes, they called out they will increase the CapEx, but they seem to be more in the wait-and-see mode as opposed to everyone saying we are GPU constrained and we need to spend more on CapEx.
Well, can we talk about Reality Labs? Of course, that's the division that's building those smart glasses and all their other exciting futuristic stuff. It lost nearly $4.5 billion in the quarter. That is a shocking amount of money. When does that start to narrow, or could it actually expand from here?
Well, one thing they've done, I think, this year is they have shifted some of that Reality Labs losses into AI. So even though it shows up as a loss for the segment, they're actually infusing AI in their Ray-Ban AR glasses. Now, you could argue, is it really AI spend that's showing up in that $4.5 billion loss? Or is it the R&D around the AR, VR? And I think there is a very fine line. You can't really distinguish what is AR, VR versus what is AI. And in this case, I think they have taken the actions to double down on AI, which is paying out. And remember, Meta owns its own large language model. Only 2 other companies have that. That's a big advantage. That's what Amazon doesn't have. That's what Apple doesn't have, and they have to rely on someone else to give them the large language model. So that's a huge plus for Meta.
Benefit to open infrastructure. Mandeep, thank you so very much. That is Mandeep Singh of Bloomberg Intelligence, of course, in the middle of a very busy earnings season. We should also mention ARM, the company reporting earnings yesterday that were strong, but shares are under pressure after leaving its sales forecast unchanged. Don't miss ARM CEO Rene Haas on Bloomberg Technology today at 11 a.m. Eastern. And turning to the big earnings on deck today after the bell, the stakes are high for both Apple and Amazon. Investors are watching for more information on Apple's AI iPhone and AWS growth over at Amazon. We're going to discuss this with Maxim Group senior analyst Tom Fort. And you think about the potential over here at Amazon in particular. Curious about what you're more excited about given what you saw out of the rest of the group so far. Is it AWS potential with the cloud, or is it what you might see in advertising?
So what excites me most about Amazon is Andy Jassy's comments last quarter that the company today can both invest for the future and generate profits right now. So when you think about the investor focus for the June quarter, it's return on investment spend for artificial intelligence. And I think it's a very strong statement by Andy that Amazon can have high margin and cash flow today while investing for the future. So I think Amazon's well positioned as far as exploiting artificial intelligence to both drive incremental revenue and to improve its cost structure.
Well, talk to us too also about the investor focus, also specifically on the cloud, on AWS. Of course, we had Microsoft earlier in the week, feels like a long time ago at this point, but there was disappointment there when it came to Azure growth. I mean, what are you expecting to see out of the Amazon cloud unit in particular?
So I think last quarter, the trend was companies are starting to resume spending on IT and resume spending on cloud. And there had been a lot of efforts on focusing on expenses given the challenging macroeconomic environment. So I'm looking for that trend to continue in the June quarter. I do think that there's some risk to Amazon, as reflected in the Microsoft Azure numbers, that you may not see as robust a performance in its cloud computing division as companies in general are trying to determine if they're getting the proper return on their investment spend on AI. But I think that last quarter's trend on a resume of spending, less efforts on cost cutting by its customers should benefit Amazon in the June quarter.
Tom, you think about the spend that Amazon is making on newer initiatives. You think about the deal they struck with the NBA, for example. How do you expect them to address analysts about these initiatives and how it might pay off in the future?
So I've been doing a fun compare-contrast on Amazon's efforts to disrupt the sports broadcasters, the latest example being this NBA deal, and Temu's efforts to disrupt Amazon, the best example with the fact that they had 3 advertisements during the Super Bowl. So when I think about Amazon's spend for live sports broadcasting, I view it as kind of a lost leader. So to the extent they're disrupting the legacy players, I think that's the advantage for Amazon. But on an individual deal basis, Thursday Night Football for NFL and this potential deal with the NBA, I don't think they're making money as far as incremental Amazon Prime members or even from advertising revenue.
So big focus, of course, on what Amazon is spending money on and, of course, on that cloud. Let's also talk about Apple as well. There's a great story on the terminal today that the headline is Apple, Amazon results are crucial for the NASDAQ 100's.
It's been 10 minutes time now. At the bottom of the hour, we see the release of the Canadian manufacturing PMI. The prior was 49.3.
Expectations are too high for Apple right now. Walk us through that.
So think about shares trading at north of a 30 times multiple. And what would success look like on an AI-inspired upgrade cycle? Success would be, call it 5 to 10% EPS growth. So you're talking about a PE to growth ratio of 3 to 6 times. So, and by way of comparison, its big tech peers are trading more like 27.5 times forward PE. So I think investor expectations are way too high. If you look at the AI upgrade cycle for Apple, we think it can add $50 billion of incremental revenue, about half the benefit they got from 5G. The reason we think it's half the benefit is there's less pent-up demand. I don't think people waited to buy a next-gen iPhone that has AI capabilities. And then they have regulatory challenges when it comes to rolling out Apple Intelligence in Europe, which is 25% of sales, and China, which is 19% of sales. So I think right now, as it pertains to Apple, the stock's ahead of itself.
To that end, you've seen a lot of upset in some of the big tech earnings we've seen so far. And if you think about any areas of vulnerability, Tom, where are you most concerned?
So I'm absolutely looking forward to their comments on the September quarter and what they're saying about iPhone sales projections. What's particularly interesting, and I think Bloomberg broke the story first, is they're essentially going to ask consumers to buy the new hardware and then wait for a software upgrade to get Apple Intelligence. I can't think of a similar occasion like that for Apple in the past. But I'm going to be paying laser focus on the iPhone commentary for September sales by the company.
All right, Tom, really great to get that preview with you. Really appreciate you taking the time. That is Maxim Group Senior Analyst Tom Forte. And it's interesting, of course, his comments on that AI upgrade cycle. Remember, Steve Eisman, we interviewed him a couple weeks ago. That's one of the big reasons why he's bullish on Apple. Of course, it'll be interesting to see what the company reports after the bell. But coming up on this program, we're going to take a look at the companies making the most social buzz today next. This is Bloomberg.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
All right, this is Bloomberg Open Interest. A quick check on futures. About 6 minutes until the bells ring. You can see still holding on to gains here, slipping a little bit though. The S&P 500 about 0.3%. NASDAQ 100 up about 0.1, and the Russell 2000 now nursing a loss in the pre-market, down about 0.2%. But it's time now for social climbers. The company's making waves on social media this morning. And first up, Moderna reducing its sales outlook for the year.
In 5 minutes time now at the bottom of the hour. Do you see the release of the Canadian manufacturing PMI? The prior was 49.3.
Trying to find new uses for its mRNA technology. Next up, some bitter earnings news for Hershey. The chocolate maker reporting a second quarter miss as consumers spend less on candy and snacks. The company is also facing another batch of challenges, including the rising cost of commodities such as cocoa and butter. And finally, Weight Watchers is laying off employees and cutting costs as it struggles to stay relevant in the era of obesity treatments. Popularity of weight loss drugs from Eli Lilly and Novo Nordisk have really decimated demand for the company's iconic diet plans. Of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. And Shonali, this is really a recurring theme when it comes to the disruptive impact of those GLP-1s.
It certainly is. And you take a look at what we're seeing across the food industry right now, and you have to wonder, is this because of budgets, Katie, or is this because of those GLP drugs that people are changing their dynamics? You take a look, for example, at Wendy's. For example, they're still seeing the same EPS for this year, but they're cutting their sales guidance as their guest counts drop in the United States. So fewer burgers, but people who are spending money on burgers are spending more on them.
Yeah, I'm looking forward to discussing the impact of all that just in a little bit, of course, on this program. And coming up, actually, we're going to be speaking to iCapital's Anastasia Amoroso on how private credit is filling the lending gap left by retreating banks. That is right up Shonali's alley, and that is next. This is Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood is just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates...
1 minute now for the Canadian manufacturing PMI as well as the markets on open imbalance.
That, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, we are moments away from the start of the trading session. Of course, this is the first day of trading for August, and of course, it comes after what we saw, all the fireworks yesterday. Of course, you can
47.8, 47.8. Looking now to the market on open imbalance as well. S&P 500, 260 million to the buy side. NASDAQ 100, 30 million to the sell side. Dow 30, 30 million to the buy side. Mag 7 stocks, 25 million to the sell side.
And let's take a quick check on the major averages, of course, as trading kicks off in these first few seconds. And you can see, of course, the fireworks of yesterday not quite following through today. Of course, the S&P 500 up about just, let's say, 3/4 of a percent. The NASDAQ 100 just about flat, and the Russell 2000 pretty much flat as well. So let's get to the single stock action in the fast food industry in particular, because we have Wendy's and Shake Shack reporting. Wendy's cutting its guidance after a decrease in customers in the U.S. And meanwhile, Shake Shack, it's really soaring right now, or pretty much unchanged. We'll give it a moment. It's hoping to achieve positive free cash flow this year, Shonali.
Also keeping a look on the private asset world here, because two proxy stocks here, Apollo, Blue Owl, both in focus today. Apollo reporting an earnings miss. Profit is dropping at its Athene annuities business. Apollo now down almost 5% after more than 30% rally this year. Blue Owl down about 1.6% after a nearly 28% rally this year. We're also watching.
We have posted out the Canadian S&P manufacturing PMI July report on the feed for anybody interested.
A tepid annual forecast. Meta now up almost 9%. ARM now down more than 9%. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And to give great context, Shonali, for those earnings reports, let's take a look at the week in tech so far. And this has everything to do with NVIDIA. NVIDIA, after on Tuesday slumping to basically a 102 handle from its high, its all-time high on an adjusted basis of 140, now trying to rebound on the day off of the pre-market highs, up just about 0.5%. Lots of volatility here, and of course, there's a fear that
so following earnings last night, Meta shares jumped 10% on the open, adding $123 billion in market value.
Modeled in, but again, on the week, a nice recovery for NVIDIA, which has been in a bear market, coming out of it now. Now, if we put the Meta and the ARM results into it, well, Meta having a great day, to your point, and they really put up a great quarter here. This is taking a look at the AI race overall. Meta putting up that big quarter, so they are in blue there. In white, we have ARM, because of course they put up a good quarter. They held the guidance, but investors wanted more given how much the stock was up on the year, at one point up nearly 140%. And then interestingly, there's NVIDIA in yellow. So in yellow, we have NVIDIA. In white, we have ARM. Those are more of the hardware AI makers. And then in blue, Facebook, or Meta, I should say, and purple, Tesla, which are more the shiny applications of AI. At some point, Katie, we're probably going to see it flip, where the hardware becomes more commoditized in years out, and then some of these applications of AI, those uses, they will climb. But right now, this is a look at the race, the AI race, and what it means for these stocks.
All right, Abigail Doolittle, thank you so much. And we should point out that Meta right now rising 10% at the open. That would add $123 billion in market value. So just some incredible numbers that we're seeing right now. Let's discuss all of it with Anastasia Amoroso. She is Chief Investment Strategist over at iCapital. And you think about sort of the mood music heading into this week. It was very tense. And now we have, of course, some of the big names finally out there. Of course, we still have some big ones after the bell today. But do you think we're past peak panic or at least peak upset?
Well, I think we are for now, assuming Amazon and Apple deliver, but I don't know if we can assume that for both of those, but I do think the results from Meta are really encouraging to the market because it really tells you that there are ways to monetize artificial intelligence investments right now. And what the markets were really panicked about is, we're spending all this money on AI CapEx, but is the payoff years away or not? And what Meta really shows is that the payoff is actually happening right here, right now. And that is very different from what we saw from other reports where, for example, Microsoft is clearly ramping up CapEx, but the revenue growth expectations are not ramping up as much. So yes, I do think that alleviates some of that concern, but I do agree with that leadership board for now. I think the semiconductors, the hardware stocks, I think their outperformance is likely to continue because that's what investors are sure about right now, is that the other Max 7 stocks are going to be spending on CapEx.
So what does that look like now that we have a glimmer of hope from Meta? If you think that there's still some dry powder to put to work, do you still put it towards the Mag 7 names, or do you hold off until you see the rest of them catch up to the Meta story?
So now I actually sort of have a three-prong approach. Coming into last week, I would say it's a barbell of defensive stocks and also some of the rotation trades. And the reason we've liked that is
in 10 minutes time now at 9:45 a.m. Eastern Time, see the release of the US S&P manufacturing PMI for the month of July. This is the final read. Forecast 49 spot 6 on the prior 49 spot 5 with a range of 51 spot 6 to 49 spot 5 expected.
On a pullback. Look, I think within the big tech complex, there's going to be this divergence of who's immediately seeing the benefit of AI, who's not. But again, one thing that we can be sure of is that all of them are going to be spending on AI CapEx. And so semiconductors are the beneficiaries of that. They've pulled back nicely. So that's why I would be adding to that. And of course, it's a cyclical story as well, which will benefit from rate cuts.
So Matt Miller is off right now. He always likes to pull up these complicated terminal functions on screen. I'm going to do that right now because if you take a look at NVIDIA and then the function SPLC, it shows that NVIDIA gets 19% of its revenue from Microsoft. So that CapEx spend is going directly to another big tech player, NVIDIA, and that's really propping up the whole market. And we spoke to Larry Adam from Raymond James a couple of weeks ago. I wonder how many times I'm going to bring up what he said, but he made the point that you want to go where businesses are spending money, not necessarily where consumers are right now. It seems like, again, you take a look at that very complicated function, that would prove that point.
That's right, absolutely. And if you look at the Microsoft CapEx numbers, I believe they're up something like 78% year over year. So that's a huge number. And so that's why investors are focusing on that certainty. But, the other point I would say, obviously the likes of NVIDIA are going to benefit, but not exclusively. That's not going to be the only player. And some of the headlines we saw this week is that maybe there's some competition that's heating up with other semiconductors as well. So that's why, I would look at buying a basket of semiconductor beneficiaries from AI.
Let's talk about not just what we're seeing out of earnings season, but what we're seeing in the changing expectations coming out of the Federal Reserve. You have a market now pricing in 3 rate cuts this year. Yeah. Do you think that this market needs those 3 rate cuts to materialize to keep the valuations we're at?
Near term, yes. I think so. And, of course, Fed Chair Powell did not say anything about the future path of policy. But I think part of the reason why some of these rotation trades have worked as well as they have is because markets are counting on the tangible benefit, the tangible relief from those 3 rate cuts. And if you look at a middle market company or a smaller company that maybe has had leverage that is floating rate, the fact that we have priced in those 3 rate cuts, that's providing immediate relief. Because if you look at the SOFR rates, of which some of those floating rate loans are based off, those SOFR rates 6 months out, they're already coming down. So I do think that if we see some pullback in those rate cuts expectations, the rotation trade maybe gives a little bit of it back. But longer term, I think the Fed and the markets are right to look for something like 150 basis points of rate cuts. And so that's what I'm looking for, and that's what I'm looking through is the actual relief that's likely to come.
And I want to talk about the rotation trade in the context of this very muted IPO market, because someone made the point to me sometime in the past few weeks that you think about the companies that are staying private, it's those smaller companies that might have gone into that small cap index. And now the companies that are going public are debuting as mid cap or large cap companies.
Yeah.
So you're not getting that quality in the small cap index. How do you think about that?
Well, this has been a trend that has been ongoing for probably 20 years. And if you look at sort of before the financial crisis or even further back, the average age of the IPO was about 8 years. You know, now the average age of the IPO is about 11 years, and that's being extended. And so what happens is when the companies, to your point, do IPO because they've seasoned so much in the private markets, they IPO at much higher valuations. But what this also means is that some of the hyper growth that typically is associated with a company that's an IPO, some of that hyper growth has already happened in private markets. So that's why investors, I think, would be well served to look at both sides of public and private market balance sheet because a lot of the value can actually be created in private markets pre that IPO.
I want to pull up some of the stocks that we're looking at today here too, because Apollo, for example, KKR hit a record high yesterday. Apollo's on the decline today, but their fee-related earnings actually beat expectations. It was their spread-related earnings. So things are getting better for the private markets in some ways. How do investors get a piece of this? If you're a retail investor, you don't have a lot of options here. Is it just buying the stocks of the ones that are publicly traded?
Well, the great news is that you do have many more options than you've had in the past. You know, of course, you can buy the stocks of some of the alternatives managers that we've discussed, but at the same time, you know, what used to be an institutional asset class and where you needed to have a large ticket size for an individual trade, we are able to bring, as an industry, to bring down that minimum. We're able to expand access. We're able to expand reach to the retail investor.
25 minutes time now at 9:45 a.m. Eastern Time. We see the release of the US S&P manufacturing PMI July final read. Forecast 49.6 on the prior 49.5 with a range of 51.6 to 49.5 expected.
Right, things are picking up for private markets. For example, on the iCapital platform, where we look at the private wealth channel flows into private market assets, we're seeing very strong demand for private credit, which represents about 44% of the flows that we're seeing on the platform. We are also seeing demand for private equity and infrastructure and secondaries. Those are all areas of strength. And when you think about the broader industry, you know, the reason I really think there's a lot of momentum that's building, we are seeing fundraising pick up in year-over-year terms, especially in secondaries, especially in private equity, in direct lending. And we're also likely to see, you know, Katie, to your point, a better exit environment with IPOs and M&A coming to the fore.
Anastasia, we have less than a minute left, but I want to go back to that point about access because it's interesting. If you take a look in the ETF world, and retail investors love ETFs, issuers from BlackRock to Goldman to Invesco are looking at ways to fit private assets into ETFs somehow. When you think about that structure, do you think that's a possibility?
Well, it might be a possibility, but I think a lot of work has to go into it. And I think there's a lot of industry appreciation for you can't just put an illiquid asset in a liquid format and call it a day. There's a lot of considerations that have to be given, and I truly believe that the industry is being thoughtful about that. I mean, to the point of access, of course, a private investor would prefer to have the liquidity, but you have to put really careful guardrails around that if you're dealing with private markets.
$20 says Katie rather see a private equity ETF before a Solana ETF.
There you go.
That is
absolutely.
Asia Amoroso of iCapital. Stick with us. More markets ahead. Busy earnings season. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The deal.
That deal.
The deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Earnings season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing earnings out of
1 minute remaining.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
10 seconds.
Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in
49.6, 49.6 as expected.
And fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at bloomberglive.com/powerplayers.
This is Bloomberg Open Interest. A quick check on the stock market. Of course, we are seeing green on the screen today, and the S&P 500 rising now at a faster rate, 0.7, nearly 0.8 of 1% higher. NASDAQ 100 rising in synchrony. The Russell 2000 getting a bigger bid at 0.3 of 1%. Katie.
And it's time now for top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo raising its recommendation on Carvana to overweight, also lifting its price target by nearly $100 after the online used car retailer delivered a surprise profit in the second quarter. Next up, we have Oppenheimer cutting Etsy to a perform rating after the e-commerce platform gave weaker third quarter guidance. The analyst says that the outlook suggests no near-term visibility. And finally, Loop Capital raising Reddit to a buy. Analysts say that there's upside to the street's estimates and cites an attractive valuation. Meanwhile, two stocks we're watching this morning post-earnings are Shake Shack and Wendy's. Shake Shack soaring right now at the open. It announced positive free cash flow for the first time in 7 years. Wendy's stock, it's also rising by not as much. That's after the CFO.
So we have posted out the US S&P Manufacturing PMI July final report on the feed for those interested.
Joins us now.
Williamson, who's the chief economist at S&P Global in this report, notes that the manufacturing recovery moved into reverse in July, though the gloomier growth picture was accompanied by a market cooling of inflation in the goods-producing sector.
Authored a great turnaround at Papa John's, and it seems like he's got a great plan for Shake Shack, right? It's primarily going to center around improving the marketing program and increasing ad spend. You know, Shake Shack has not done a lot on that end, and you know, he has a great marketing background, so we think he's the right guy for the job. And he's also talking a lot about running better restaurants, improving speed of service, right, improving throughput. You know, and this isn't rocket science. You know, it's a difficult business to execute in, but it's not hard to figure out. Better food, better service, better marketing should help drive sales in the near and intermediate term for Shake Shack.
When you take a look at what was going on at Shake Shack and when you take a look at what was going on at Wendy's, what does it all tell you, Michael, about what it means to sell a burger in this market?
Yeah, so I would say, from a 5,000-foot view, this is really supports what we've been saying for a while, and it's that the K-shaped recovery is impacting restaurant sales, right? And restaurants like Wendy's that cater to a higher percentage of low-income consumers, historically in quick service, about 30% of the customers are low-income consumers, right? And those consumers are struggling due to inflation, right? Due to higher restaurant prices and prices, frankly, everywhere, right? And so Wendy's has pretty large exposure to those customers, and they're struggling to drive positive same-store sales. Whereas Shake Shack caters to higher income consumers, and they're seeing less pressure to discount. They're able to continue to pass through larger price increases, right? And that's helping their same-store sales outperform right now.
Well, Michael, to that point, we did hear from the Wendy's CFO saying that higher income consumers are visiting more often. Maybe we aren't exactly seeing that yet in the earnings, but I think that says a lot about just the state of dining out right now in the U.S.
Yeah, from what we're hearing, everybody's trading down, right? From fine dining to lower cost full service, from full service down into fast casual down into QSR, right? It's kind of a cascade effect, right? And so if you're a Wendy's, your low income consumers actually drop out of restaurant visits completely to some degree and shop more at the grocery store. They are attracting some higher income consumers that are saying, maybe I'll eat out at a full service restaurant 1 or 2 fewer times a week, right? And save some money and go to a Wendy's, right? It's such a smaller portion of their customer base that it's not going to offset the traffic loss from the low income consumers. On the bright side, they do spend more and they do tend to buy higher margin products.
Michael Halen of Bloomberg Intelligence, we thank you so very much for keeping an eye all over the market for us. Now, coming up next, we're going to talk about Bill
The
Ackman's
Hezbollah leader
IPO
says the battle with Israel has entered a new phase.
on the closed-end fund IPO. We're going to discuss it in today's Wall Street Beat. Stick with us. This is Bloomberg.
So in 10 minutes time now, at the top of the hour, see the release of the US ISM manufacturing PMI for the month of July. Forecast 48.8 on the prior 48.5, with a range of 50.5 to 47.7. Prices paid, forecast 51.8 on the prior 52.1. The employment index, forecast 49.2 on the prior 49.3. And the new orders index, forecast 49 on the prior 49.3. With this, we also see the release of the US construction spending data for the month of June. Month over month, the forecast is 0.2% on the prior minus 0.1%.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Power, money, culture. As Linda Hammond tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
Inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Let's take a check on stocks. About 20 minutes into the first trading day of August, we have a rally on our hands. The S&P 500, the NASDAQ 100 up about 0.6%. Small caps getting in on the action, but to a lesser degree. The Russell 2000 Shanali currently up by about 0.2%.
Matt leaves the kids home alone and the party's on, Katie.
Yeah.
It's time now for today's Wall Street Beat. Bill Ackman pulling the plug on his IPO dream of that closed-end fund after his fundraising targets plummeted in just weeks. Joining us for more is Bloomberg's Bailey Lipschultz, who has been covering this top to bottom. And when I look at the story that was written overnight by Kathy Burton and Annie Massa of Bloomberg, one part stuck out to me, that Seth Klarman was angered that Ackman named him in a letter to big investors about the IPO that was later made public. This letter served as a role in complicating the IPO, didn't it? Is he losing friends over this?
I imagine his inbox is probably pretty filled with messages. I mean, when you look at kind of the pushback that we saw, according to the filing, that letter was never supposed to see the light of day, but he did name drop Seth Klarman's bow post. He did say that they were in for $150 million, name dropping them with Putnam and a teacher's retirement service down in Texas. But it does seem like shortly after that, bow post pulled its commitment, and then obviously things spiraled pretty quickly from there.
Absolutely, and you take a look at the press release that hit the wire yesterday. This question, they say, kept coming up. Would investors be better served waiting to invest in the aftermarket than in the IPO? Because I'm hoping you can translate this. So basically, this is a closed-end fund. Closed-end funds often trade at discounts.
Especially now, and he has an offering already in Europe that trades at a more than 20% discount. So from the start, when I was having conversations with people who actually operate at institutions, who they were really trying to sell this to, in addition to the retail investors, why would you pay an equal amount knowing that it's going to trade at a discount when you also can, though the terms are structured differently, just buy already essentially the same asset.
You're going to get it
for
on
20%.
sale in
Exactly.
like 2 weeks.
So you need to find someone who's willing to put in billions of dollars, and typically closed-end funds cater to retail investors who maybe want to have someone like a Bill Ackman kind of help manage their retirement, and maybe they're not thinking that far in advance, but the institutions are not.
Part of this play, too, is not just the relationship with institutions, but of course his followers on X. Yeah. What does this mean for his relationship to all those followers?
Well, if you think about it, Shonali, 1.3 million followers is a lot for you and me, but it's really a small drop relative to the likes of an Elon Musk or a Donald Trump, who we see rallying millions and millions
It's been
of
5 minutes time now at the top of the hour. Do you see the release of the US ISM manufacturing PMI for the month of July? Forecast 48 spot 8 on the prior 48 spot 5 with a range of 50 spot 5 to 47 spot 7. The prices paid component forecast 51 spot 8 on the prior 52 spot 1. The employment index forecast 49 spot 2 on the prior 49 spot 3. New orders forecast 49 on the prior 49 spot 3. We also see the release of the June US construction spending month over month, forecast 0.2% on the prior minus 0.1%.
This week, of course, big tech earnings continuing today. Earnings from Apple and Amazon after the bell, plus Intel after the bell later this afternoon. We're going to round out the week tomorrow with earnings from Exxon and Chevron. It's also big oil in addition to big tech. Of course, also, we get the jobs report at 8:30 a.m. Eastern tomorrow. But coming up in the next hour, of course, on this show, really looking forward to a conversation with TMX Group CEO John McKenzie, of course, the parent of the Toronto Stock Exchange. That's coming up at 10:30 a.m. Eastern in our next hour. Don't go anywhere. This is Bloomberg Open Interest, and this is Bloomberg.
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife.
Hezbollah leader says the Israeli response to any Hezbollah attack will determine if the war escalates.
A good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow.
1 minute remaining. I'll be leading with the US ISM manufacturing PMI.
I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
10 seconds.46.8, 46.8, lower than forecast, 48.8. Prices paid, 52.9, 52.9, higher than forecast, 51.8. The new orders component, 47.4, 47.4, lower than forecast, 49. Employment at 43.4, 43.4, lower than forecast, 49.2. Construction spending month over month for June as well, minus 0.3%, minus 0.3%, lower than forecast, 0.2%. So noting some weakness in the S&P 500 and the dollar following this report.
After the cash open, you can see, again, we're still on rally territory here. The S&P 500 up about 0.5% right now. Big tech a little bit more so, of course. We have some big earnings after the bell from Apple and Amazon, but right now we're up about 0.7%, of course, after we heard from Meta last night. Meanwhile, you take a look at the 10-year yield, currently down about 3-4 basis points on the 10-year Treasury. Shanali, of course, as we do get some breaking economic data.
Absolutely. ISM manufacturing index has fallen. Softer data.
Treasury 10-year yield falls below 4% to the lowest since February.
Bloomberg's chief international economics and policy correspondent. Mike.
Yeah, Shanali, the latest evidence that the economy is slowing and possibly slowing significantly. The ISM national number falls to 46.8 from 48.5. The forecast had been it would go up to 48.8. New orders crash 47.4 from 49.3. And listen to this one. Employment 43.4 after 49.3. A big drop in employment, and that's going to have people maybe recalculating what they think is going to happen tomorrow with non-farm payrolls. Production 45.9 from 48.5. The bad news here is that prices paid goes up to 52.9 from 52.1. So bad news on both sides of what we'd call the Fed's mandate.
All right, Mike McKee in Washington. Appreciate the instant insight. Of course, you can see bonds rallying a bit in the aftermath of that. So let's
We have posted the US ISM manufacturing PMI July report on the feed for those interested. The key findings notes that new orders and backlogs are contracting, production and employment are contracting as well, supplier deliveries are slowing, raw materials inventories are contracting, and customers' inventories are too low. Prices are increasing, exports and imports contracting.
Which is relatively relatively bearish. You take a look at where we're trading right now, about 55.50. So tell us about the path that you see to getting to that number.
Yeah, I mean, when we set that price target back in February, it was actually on the upside of the market. I think the fact that we have this target on the downside is more a reflection that we don't think we should necessarily be chasing the market when it's at all-time highs than it is a very bearish conviction. What we've seen is a ton of rotation under the surface, and we think that's where investors should focus and being more tactical around markets rather than a big headline conviction index level move.
But what does rotation really mean to you at this point? You see the softening economic data. You wonder whether that bad news is good news because of potential rate cuts, or whether more weaknesses in the economy will spill through to that stock market performance.
I think it's a great question. It's incredibly interesting. We think there's three things driving the rotation. One was how extreme positioning got ahead of earnings season, that narrow breadth rally that's been so talked about. The second thing is the macro picture, and this idea that the first order reaction to weaker data is positive because the Fed are going to cut, but then does the data weaken too much? And then the third thing are the US elections, which are also a cross current for some of those rotational themes.
Tell us about the importance of positioning and flows right now, because Scott Rubner over at Goldman has really been pounding the table that August typically is a terrible month for equity inflows. I mean, how are you thinking about all of those sort of technical factors as you weigh that with the fundamentals?
Well, I think it's quite good for explaining what has happened in the market, because we came into this earnings season with the Magnificent Seven looking extremely overbought. We had a lot of leverage building in some of the more index products that are more focused on those large cap names. And we've seen a significant correction, and we think a lot of that is that washing out of positioning. At the same time, those names and parts of the market that have lagged, some of the lower quality, smaller parts of the market, you think Russell 2000, for example, were much less crowded. And as a result, we've seen this extreme rotation. So we think that that reflects a bit of a cleaning of that positioning. So we think a lot of what we've seen is maybe a bit of a healthy correction in something that got very extreme. And now we think it's a kind of cleaner place for the fundamentals to dictate the price action.
You've seen that rotation waver in recent days, especially when you see it in the small and mid caps. Do you believe that it's sustainable? Do you believe that those areas of the market can be protected if we see a further downturn?
They can, but I think there's an absolutely massive question there. So I think in the FOMC press conference that we saw yesterday, Powell was directly asked these questions about the two parts of the dual mandate. Clearly inflation has moved in a favorable way, but what does that mean for the labor market? We get the payrolls tomorrow, and the question is, at some point, is softer data going to manifest in something that's much more difficult for the cyclicals and lower quality? And those parts of the market look much more vulnerable than they did a month ago, given that the rally that we've seen. So we think it's something where, for investors who are thinking of hedging and looking at optionality, those are the parts of the market that we're most focused on.
Well, how do you hedge right now? I mean, do you just rotate into higher quality, maybe some of those less cyclical names? Or are you talking about, tapping the options market right now?
I think there's two things. So ahead of earnings season, we were very focused on suggesting people consider replacing pure delta views with optionality. That's worked pretty well through earnings season, but when we look at the options market now, it does look that volatility levels, the premium people pay, is more elevated. So we think people have to be a little bit more careful about how they use options now. I think in terms of portfolio construction, then I think you can look at blending things like cyclicality and quality. You don't just necessarily have to be at one end of the barbell where it's large cap AI or just the lowest quality, smallest companies. There's definitely a piece in the middle, think equal weight S&P, or blending quality and cyclicality as factors that I think can give you potentially better risk reward in terms of that balance.
I want to bring this conversation to the VIX really quickly, because the VIX, for so long, it was doing nothing. It looked like maybe we were going to get to single digits. Now we're trading with a 16 handle, which feels maybe a little bit more reflective of what we're actually seeing in the market. But how do you think about the VIX? Is there actually a useful signal that comes from this metric anymore?
Yeah, I think so, but you have to be careful what it is you're looking at. It's index level volatility. What we've seen is a lot more stock volatility. But if you have half of the S&P moving a lot higher, half moving a lot lower, the net result for the impact can be that it doesn't move a lot. So what we've seen, when the VIX got down to the lows ahead of earnings season, that was masking higher underlying volatility as a function of the very low correlation. So we think the risk of the VIX moving into a much higher volatility regime comes from correlation. So to see the VIX up in the 20s, what you really need to see is a risk-off move in which the small and mid caps, the lower quality, and tech both participate together. I think in the short term, in a very tactical view, if the market continues to consolidate around here, then VIX with a 16 handle. It was a 12 handle just a month ago. I think we could trend back lower before we go higher.
Listen, there is a camp on Wall Street that believes we're headed lower before we go higher.
Yep.
And are you part of that camp? Do you believe that there's a greater pullback at bay, and is that what you keep your cash dry for?
I think what we've seen.
Swaps fully
through
price in
earnings
3
season
interest rate
is a
cuts by
pretty
the
healthy
year end.
correction and a cleaning out of some of the real excess in terms of positioning. I think for us to go lower from here, we need to see one or two things. Maybe some disappointments after the bell in terms of large cap earnings, and or a real deterioration in terms of the data. So that could come Friday in terms of the payrolls. I think absent either of those two things, I think the consolidation and the clean out we've seen kind of probably sets us up for a kind of short-term moderate rally. And we need to see a further deterioration in fundamentals, either macro or earnings, to take us lower.
I'm reading your notes right now, and you have this really interesting line that you should be careful what you wish for with softer data. It can become too soft, and it's interesting because it feels like we're still in this bad news is good news narrative when you think about what that means for the Fed, and I think that's an interesting pushback here.
Yeah, so I think we were at a point earlier this year where people were really fixated in seeing softer data. Now, clearly it was softer CPI was really what people wanted, and that has been delivered, and the market pricing for September, December, the rate cuts that we're now very, very likely to see has really firmed up. So if you think about weaker data helping from that perspective, well, there's less potential for it to move the needle there anymore. But at some point, if the data does decelerate too much, then it brings about the risk of a recession. And when we look at Fed cutting cycles, you can basically split them into two. Those where it's preemptive, you could think 2019 or the mid-90s where it's bullish for markets, and those where it is very bearish for markets because the Fed are cutting for a reason, which is the data is slowing too much.
Greg, we thank you so very much for your time. That is Greg Bodal of BNP Paribas. Now I want to pull up some breaking news here because you now have Fed swaps fully pricing in 3 interest rate cuts by year end. You pull up the WIRP function on the terminal, you see how drastically the swaps market has been moving alongside the data points that we've been seeing. The spot markets, of course, also moving quite meaningfully. You do have a 5 basis point drop in the 2-year yield today, and the 10-year down well below that 4% level, down now to 3.98. Of course, we had jobless claims this morning coming in much softer than expected, as well as that ISM data as well. Manufacturing looking like it's slowing, and of course the economy along with it. Now we're going to take a look back at those movers in the stock market. Here's Abigail Doolittle.
Well, let's take a look at one stock that is clearly working. It is moving to the upside. Meta Platforms up about nearly 10%, heading to its best day since February. They put up a great quarter. They had 7% bottom line growth, 2% top line growth, or beats, I should say. The growth, very significant. The growth on the bottom line closer to 34%, the top line growth of 22%. So big growth for Meta. They are spending tremendously on their AI infrastructure, but because of those results, investors looking past that spend. However, there's lots of earnings movers to the downside. Qualcomm down 5.6%. They beat, but the forecast is seen as a little bit of weak. There's some concerns around slowing mobile growth. ARM Holdings down 12%. They beat. They held the guidance, but because the stock was up so much, this is one of the chip companies that will have actual revenue attached to AI. Folks are waiting for the forecast to be boosted to account for that AI revenue. And then taking a look at the shares of Wayfair and Moderna, we have losses here too. Wayfair down 5.6%. They missed their third quarter outlook as trailing. Some are saying that the home furnishings decline is very similar or mirrors the great financial crisis. Stay tuned for more on that. And then Moderna down 15.3%, the worst day since 2021. They have cut their outlook on vaccine fatigue. Katie?
All right, Abigail Doolittle, thank you so much. And of course, you take a look at the bond market too. Pretty interesting moves, as Shonali highlighted. Just to go back to that 10-year yield, breaking below 4%, of course, after we got that softer ISM manufacturing data, of course, after we got Jerome Powell yesterday opening the door to a September rate cut. You can see rallying quite significantly when it comes to the bond market. On an intraday basis, looks like we haven't been below 4% since February, so some big moves there. Now, coming up, what to expect from tomorrow's payrolls number. We're going to get insight from Pooja Sriram. She is U.S. economist over at Barclays. That's next. This is Bloomberg.
Hezbollah leader says the group will definitely respond to Israel's killing of their top commander.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
And now to high interest, a look at what's making headlines around the world. Russia is releasing American Wall Street Journal Evan Gershkovich, former U.S. Marine Paul Whelan, and the Russian-British dissident Vladimir Kara-Murza as part of a major prisoner swap with the United States. The two Americans have been jailed in Russia on espionage charges denied by them and the United States, and in exchange, the U.S. and its allies will return prisoners to Russia that they hold under the deal. And the U.S. says the world should acknowledge that Venezuela's opposition won last weekend's election, while President Nicolas Maduro doubled down on his claims of victory. Venezuelans continue to protest the election, while the socialist president has intensified the rhetoric against his opposition. And in the race for the White House in the United States, Pennsylvania Governor Josh Shapiro met with Kamala Harris's representatives as part of the selection process for her running mate. Arizona Senator Mark Kelly's chances were dimmed as labor groups expressed opposition to his selection as the Democratic candidate's search for a running mate nears its end, Katie.
And of course, investors are weighing prospects of the Fed cutting interest rates in September as we count down to tomorrow's jobs report. Former Kansas City Fed President Esther George joined Bloomberg TV earlier today with her thoughts on the Fed's mandate.
We are looking at an economy that is growing, and by the reads of the second quarter, growing well above its sustainable long-run growth. You've got a strong labor market, and you still have elevated inflation. And I think that combination reminds me that the Fed's mandate is a long-run objective. And just as we saw earlier this year, the market had priced in a number of cuts only to have to pull back on that.
And that was Esther George, former Kansas City Fed president, speaking on Bloomberg TV earlier today. Let's get some more insight into the FOMC's thinking. We're going to do that with Pooja Sriram. She is Barclays U.S. economist. And I want to bring you some of the market pricing right now because Fed swaps, fully pricing in 3 interest rate cuts by year end, Pooja. Do you think that that's warranted when you think about, of course, the state of the economy right now and what we heard from Jerome Powell yesterday?
Hey, thanks, and thanks for having me on the show. So look, to be honest, as a baseline, 3 rate cuts does seem a little excessive to us. Our own baseline is, we think they will have a window to cut twice this year. And, the totality of the data that they keep talking about are actually looking good. They're very consistent with this soft landing narrative that the FOMC has, one that they're trying to get to. So in that world where we have, gradual disinflation, labor markets cooling, but a welcome cooling, not a deterioration, and, still resilient economic activity, in that world, I think 3 rate cuts seems a little excessive.
Well, to that end as well, if you don't see those 3 rate cuts, how do you expect the economy to progress? There's a lot banking on the jobs data this week, but of course there are multiple inflation prints to look forward to as well. How does the Fed's job get trickier from here?
Oh, I think, they've made it very clear to us that it's a data-dependent Fed, not a data point-dependent Fed. And, I like to stress that point because I don't think it's likely that they get completely shook by any one data point unless, it's a really bad reading, say, on inflation or on the labor markets. So I think from now through the September meeting, we've got, 2 more inflation prints, we've got a couple more employment data, and I think eyes will be on all of those data, to be honest. They're going to be watching everything quite closely.
Well, let's talk a little bit more about the labor market. Of course, we get that jobs data at 8:30 a.m. Eastern tomorrow. And if you take a look at the statement that the Fed delivered yesterday, they basically said that they're attentive to both risks of its dual mandate right now. That, of course, is stable prices and full employment. You compare that to what we heard in June when the Fed was highly attentive to just inflation risk. So it seems like maybe there's a little bit of nervousness entering about the state of the U.S. labor market. What's your feeling right now, and whether we could see further weakening now that we're above 4% on the unemployment rate?
Now, that's a good point. And look, this shift
So we're looking now to the Fear and Greed Index, 54 out of 100, which indicates neutral, while the Crypto Fear and Greed Index is 52 out of 100, also indicating neutral.
After a very strong Q1, we've got Q2.
We're keeping an eye on the VIX as well, which is currently up around 1.2% at 16.6 points. Brings us now to 10 minutes away from the bottom of the hour, where we see the release of the EIA natural gas change for the week. Forecast a build of 29 BCF on the prior build of 22 BCF. So again, forecast is a build of 29 BCF on the prior build of 22 BCF.
That has happened. And so I think that sort of motivated this shift in language that you speak about, where they're saying, well, inflation, not so much a concern given the progress that we've seen, but yes, labor markets are cooling. So it makes sense for them to squarely shift their focus on both sides of the dual mandate. Now, going by, the data that we have so far, we think, things are cooling in a very disciplined manner so far. Especially in the labor markets. It seems like demand and supply are rebalancing. We're not seeing any signs of an imminent deterioration, to your point. And of course, we'll see to tomorrow's report to see if that pans out.
What are your expectations for tomorrow's report, especially after you saw the jobless claims today, Pooja?
Yeah, so let me quickly talk about the jobless claims data. There's been a lot of focus on the claims moving up. And, while we take some of this at face value, we have, noted that there is a seasonality factor that seems to be distorting the claims data as well. So just, in today's morning's data as well, we think, the seasonality seems to have boosted the claims number, making it look a little more weaker than what the NSA numbers say. But that said, we agree claims data have been ticking higher. For tomorrow's report, we're looking for a 175,000 increase in total non-farm payrolls. That would be a touch slower than the number that we got in June. And we think private payrolls number should look a little better at about 150,000. It was at 136,000 last month. And one final point that I will make is, for the period that we're getting the data, we did have a hurricane that hit. Weather effects like these do tend to distort the data, so we need to take it with a pinch of salt.
Pooja, we got to leave it there. That is, of course, Pooja Sriram of Barclays, of course, and a very hot market for economic data right now. now, and a very swift movement in the bond market as well. Stick with us. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg, context changes everything.
We see a secular global industrial renaissance going on. And people talk about AI, but it's also in power, it's also in sustainable energy, it's in the auto sector as well. And when you look at the breadth of capital that's needed from these high quality companies, it really reckons back to what happened in the U.S. in the 1920s and 30s in the build out of railroads and industrial America.
It's been 5 minutes time now at the bottom of the hour. See the release of the weekly EIA natural gas change. Forecast is a build of 29 BCF on the prior build of 22 BCF.
Katie, at just how well these private asset stocks have been doing, because you are seeing a little bit of a breather today, but these stocks have really been catching up here with the behemoth of Blackstone, and the firms more heavily focused here on private credit in particular. Ares, Blue Owl, KKR have been rising this year at a much faster pace.
Yeah, it's really interesting to look at that chart, and it's pretty amazing. So you have KKR in orange there, really pulling away from the rest of the pack, and that only happened recently, really in July, I guess, after their earnings there. But it's really interesting to see Apollo sort of mid-pack here. I'm sure that's not exactly where they want to be.
Well, what's fascinating, what you're seeing, Apollo is the biggest of all the credit managers here, but KKR and Apollo are looking a little more similar now than they did before. Both of them now owning insurance companies. And interestingly enough, it's the insurance company profits today that fell below expectations. Fee-related earnings coming above expectations. That second part there is good news for the industry. It means that deal activity is coming back and perhaps profits along with them.
Absolutely, and it's an interesting point again on the insurance unit, sort of missing expectations there and dragging down the whole pie, at least on the headline level. So we'll continue to follow that, and coming up, we'll actually be speaking with the company behind the Toronto Stock Exchange, continuing to grow through acquisitions. John McKenzie, the TMX Group CEO, he joins us next. This is Bloomberg.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and
1 minute remaining.
Supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading
World Cup. This is a three as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Ten seconds.
NASDAQ has been investing in moving all of our technology solutions into a cloud environment now for over 10 years. And that is really paying off.
Build of 18 BCF, build of 18 BCF lower than the expected build of 31 BCF.
And you're making it so that you can bring new technologies in faster and you can play, I'd say, offense much more quickly.
And that, of course, was Adena Friedman. She is NASDAQ Chair and CEO, speaking to us on this program last week. And Friedman really emphasizing the need for exchanges to grow and adapt to the latest technology for their clients. Let's keep that conversation going now with John McKenzie. He is the CEO of TMX Group, and he joins us in studio. It's great to welcome you to New York.
Thank you. It's nice to be here.
So when you think about the Canadian IPO market and the U.S. IPO market, I feel like we're dealing with similar issues here, and that's just that there haven't been a lot of IPOs. I mean, what is the view from up north about when that dynamic might finally change?
Yeah, and we often look to the U.S. to be the leader in terms of when the IPO market opens up. But I am seeing, and similar to the dialogue you had last week, really strong optimism in the market now for new financing. And we saw it in the last quarter, less so in the IPOs, but in companies going back and testing the market and raising new capital. So June alone was the largest month we had for capital raising on our 2 exchanges in the last 2 years. So that's a really healthy sign, because that means good deals get done, and that gives confidence to people that are looking to price an IPO for the first time. Even more importantly, we had a great announcement for an Australian-based mining company acquiring a Canadian company, so opening up the M&A market again. And they've already committed to list that on the TSX in the fall. And I'm always a big believer, you get a couple of really good transactions done with good execution, that gives the confidence for others to follow. We know from a pipeline standpoint that there are deals to come. There are deals to do, it's just a question of that market confidence.
Speaking of M&A, there's no secret here that TMX has been a very active acquirer as well in recent years. What does that mean for your future M&A ambitions? Do you think there's more dry powder left, and where would you like to expand?
Yeah, we really do, and we always focus it on M&A to accelerate the strategy we were already building. So we were building out a strategy in terms of getting deeper into data sets, indices, serving the clients that way, and deeper into the issuers, because we have over 3,000 listed issuers. So we're always looking at how we provide more services to them. So the 2 recent acquisitions we did, ATS Canada was a trust company that helps us serve issuers more, and Vetify here in New York City, which is what brought me to New York this week, helps us serve that broader ETF and index community. So they're both accelerators, and we're in a position right now where our balance sheet is very strong. We've got a great track record on execution, and investors that have confidence in what our team can do. That gives us the ability to do more. So we're constantly looking for new things that we can tuck in and scale up with the franchise.
Well, you went exactly where I want to go, and that is straight to the ETF market, of course. I think
think you spent $1 billion in total on VettaFi, a transaction that definitely turned a lot of heads in the industry. So maybe just to set the scene here, what are you hoping to do with ETFs? Because I saw that and I was thinking, okay, they want to get more listings.
Yeah, and if I take a step back from that already, we're already one of the largest listers of ETFs in the world. We're actually over 1,000 listed ETFs in the Canadian market, and the Canadian market is only 2 to 3% of the global economy. So we've been way ahead of the game on that. We actually invented the ETF in Toronto over 30 years ago. A little known fact for everyone. We're the first market to do fixed income ETFs. We were the first market to do crypto ETFs. So it was an area that we thought we were going to really invest in so we could support our clients end to end. So not just on the listings, which we want to do more, but we also want to help ETF manufacturers create the next great new product, but we also want to be able to help them. And what VettaFi helps us do is create that ideation, but also help reach a larger investing audience, and also then do the analytics on the other side in terms of how their marketing and their outreach is performing. And when you think particularly as ETF manufacturers go to new marketplaces where they don't have their own distribution network, this is exactly what they need to get in front of a retail investing audience.
Right.
So we're already seeing fruits of the partnership we put together. We've got new products that are being launched in the Canadian market based on VettaFi indices. We've got new data sets that we're going to be bringing into VettaFi to create new product, and I'm really excited with what we can do together with the team.
Well, something I've been wondering about, of course, as we think about the IPO market versus the ETF market. I mean, new ETF launches are at record levels, and they have been for several years. You compare that to the IPO market, not too much going on, relatively speaking. How much of what's being lost in IPOs can be offset by new ETF listings, or is that not the right way to think about it?
I don't think it is, because I always think of ETFs in terms of what is the market for funds in terms of investing product. And at these days, I think we're seeing ETFs are only about a third of what you see in the mutual fund space. There's a lot of runway for growth, and a lot of runway for growth in developing in other markets. Like the European market isn't anywhere near as developed as the US and the Canadian market. So there's a lot of potential to keep growing ETFs. And at the same time, we're going to see listings come back. Now, even though the IPO market has been quiet, and maybe this is more unique to Canada because we have a junior venture market, we have a public listed venture market, we've still been bringing new companies to market even through this drought. Now, we've added 35 new corporate listings just this year alone, but a lot of them come through structured listings, direct listings, reverse takeovers, capital pool companies. So we've tried to build a lot of different vehicles to help a company go public even if the IPO is not the right path for them.
Well, I promise I have just one more question on ETFs, and I'll be quiet for a while. But something I've been trying to contextualize is where does the ETF business fall in terms of the importance to the bottom line when you think about the regular business, the traditional business of exchanges? Because, of course, you think about what's going on in the U.S., and SIBO, for example, has been pretty aggressive saying, we want to beef up in ETFs. We actually want to steal listings from the other exchanges. But when you think holistically about the business of an exchange, how important actually are ETFs? How does that factor in?
I think they're extremely important. And I think when you look at an exchange like ours, which is different from some of the other ones you mentioned, we actually have the full end-to-end of the capital markets ecosystem. So not only are we working with the ETF issuer in terms of, again, distribution tools, creating the product, bringing it to market, but we're the lister, we're the trader, we can list options on it, we can put futures on it, we clear it, we settle it, we're the depository agent for it, we own our own trust company so we can act as the agent to support the ETF issuer as well. So we can provide the full ecosystem to that, and it touches every part of our franchise. So in that way, it's critical.
The other thing VettaFi brought you to, as you mentioned, here to New York. And if you think about your ambitions outside of Toronto, how global do you want to get and how fast?
We set an objective a number of years ago that we wanted to be more global than local, so more than 50% of the revenue came out of outside the Canadian market. We hit that in the first quarter of this year. So we're going to have to write a new objective for it now. The U.S. is a big part of that. Europe's a big part of that too. We've been growing the energy franchise in Europe. But in New York and the U.S. in general, we're doing a number of key things. So we're building out, obviously, on the index space, as we talked about. We're building out on the energy space, so we have a great business called Trayport out of London that we are working on building in New York to build that presence for energy traders, to give a better solution for the OTC market here. And we're working also on bringing a new actual equity marketplace to the U.S. as well. So we've got a team that started in New York that's working on a U.S. ATS that's really focused on higher order, higher execution quality for buy side. We've already done this in the Canadian market. We launched 2 new markets last year to do it, so we're looking to port that into the U.S. market to serve the client base here too.
I can understand the inclination to break into the U.S. even more, but how much competition is there? I mean, we've seen a horde of new exchanges even start from scratch.
Texas.
Absolutely. Yep. And so what does it take to break in and ultimately succeed?
Not to be simple, but none of them are us. We bring a lot of capabilities to the marketplace that others don't, and we've been competing with large U.S. exchanges for years, either across border, where we've got the most seamless border of any capital market in the world, or directly in Canada, where CBOE and NASDAQ are already competing with us day to day. So we've got great technology, we've got connectivity already with the largest players in the industry, relationships, IP, trading capabilities, so we've got a lot to bring to bear that any other startup wouldn't have.
That was a nice mic drop. So we're us, so that's how we're going to compete. I do want to go back to that deal you mentioned. Of course, Paladin, I hope I said that right. That's that Western Australia-based uranium producer buying Fission, and now they're going to list on your stock exchange. You said last week that more U.S. miners and other ASX-listed companies should follow their route to Toronto. How are you going to make that pitch? What does that look like?
We actually have resources directly in Australia that are doing this all the time. And one of the things that we can demonstrate is that, particularly in the resource sector, the bulk of the financing globally for resources gets done in Toronto, either on the TSX or the TSX Venture Exchange. We have over 1,100 mining companies listed on the 2 platforms, which also means we've got the biggest network of analysts, lawyers, geologists that all follow it. We're probably the only exchange that actually employs a geologist on site.
That's pretty cool.
That can actually assess these businesses. So we have the whole ecosystem. And so if you're a company listed anywhere else, and the ASX is a great market, but if they want to get access to North American capital, the best way to do that is to list in Toronto with that, again, seamless border between Canada and the US to access North American capital as an entry point here. We've got over 230 international companies that list with us. It actually makes us think either number 2 or number 3 in the world for international listings. And it's really based on that value proposition.
John, thank you so much for joining us in New York. It looks like we'll be seeing you here more. That is John McKenzie, CEO of TMX Group. We're going to get a check now on the markets with Bloomberg's Abigail Doolittle. Abby?
It's shaping up to be an interesting day, Shonali. If we take a look at the NASDAQ 100 futures, overnight basically higher and into the open up about 1%, a pretty solid gain. But on that worse than expected ISM manufacturing number, take a look at the leg lower. That's basically an intraday move of almost 1.5%. So bad news being seen as bad news. It's really especially interesting that we're seeing this decline given the fact that rates down so much on that print. Usually yields down would help out stocks, but today it's risk off. Stocks down, bonds up. Let's take a look at what's beneath the surface and really helping this decline move. And the stocks underperforming, down 3%. XLS Technologies down 11.2%. This chip company put up a weaker guide than expected. This is true too for Qualcomm, down 6%. And then take a look at NVIDIA. NVIDIA earlier had been higher, and of course lots of volatility here. Right now down about 1%. Fears about whether or not their growth will be slowing. Right now it is modeled to slow in this current year and the next year. Still big growth, but the trend moving in the wrong direction for what's essentially a hardware company. Let's put this into the context of a new chart, because of course last week we were showing a chart that suggested that sub 100 could be ahead. This chart suggests the same deal. What we're looking at here at this point is a pretty ugly broadening formation, basically an ugly range of uncertainty. There is a possibility that we could see NVIDIA pop up toward the top around 130, but the bigger suggestion of this chart is to the downside. The RSI kind of trying to figure out what to do, momentum not really gaining. The reason that this stock really looks like it's likely to go lower, besides an uptrend that it could meet, not shown here. Take a look at this gap. This, of course, was on the last earnings report where investors just very
seeing the UK 2-year yield falling 15 basis points to around 3.68%, the biggest drop since December.
That's closer to $90. So unless that quarter that they report at the end of this month, so we have many weeks to see yet, is of the same nature, there could be some more consolidation ahead for NVIDIA that right now in an official correction and touch and go with the bear market, Katie.
Now, a lot to look forward to when we do eventually get to those NVIDIA earnings in late August. Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, a busy week for investors wraps up tomorrow with that jobs report. Up next, we'll hear from MIT economist Kristen Forbes. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
MIT economist Kristen Forbes says that rates may not come down as much as expected. Forbes spoke with Wall Street Week host David Weston at the Aspen Economic Strategy Group's annual meeting.
There had been a leaning before the pandemic and the post-pandemic inflation to wait till you saw inflation, till you saw the whites of the eyes of inflation. And I think the lesson is learned. We need to allow central banks to be preemptive. They need to be able to start raising interest rates ahead of time when they think prices are going to pick up quickly. Related to that, I think an important lesson we've learned is that as economists, central bankers, we focus on inflation. So there's a lot of discussion now on how inflation is coming back. It's heading back to 2%. This has been a remarkably pain-free recovery, but it hasn't been pain-free. The price level has increased. It's more expensive for consumers to buy what they need to buy to keep their households afloat. And as economists, we forget that this price of a basket of goods matters to people. Things are more expensive. It's the price level that matters to people, not just the rate of change of prices. So I think we've learned an important lesson that the level of prices does matter. Even if inflation comes back down, the increase in inflation in the interim can be painful.
You're an economist, of course, not a politician, but I wonder what you just said, well, that might help explain something that I find remarkable. The economy is quite strong in the United States right now, and yet a lot of people don't feel good about it. And we keep saying, well, inflation is coming down, we're getting under control, and it doesn't seem to be registering.
Yeah, and I think that's exactly why, is that as economists, we see inflation coming down, heading to 2%. They think everything's fine. If you look at actually where we are in this cycle, it's quite remarkable. We have had remarkable swings where unemployment increased, and now it's come back down. We saw GDP growth collapse, and now it's come back. So things look good in terms of the finish point. Inflation is coming down too. But yet in the interim, we saw the price level increase, and everything just costs more. So even though the end point looks good, there's been a lot of pain to get there.
You've done research and analysis about the sort of rate cycles going back quite a ways. Was this one different from all the others?
Yeah. Great question. what's fascinating is when you look at this most recent rate cycle, there's some ways this is unique and unprecedented. There's other ways it's just like rate cycles from the 1980s and 1990s. I recently wrote a long paper on this for Sintra with a couple co-authors at the World Bank, and we described this rate cycle as similar to the parable of the blind man and the elephant. I don't know if you've heard this one, but according to the parable, several blind men are told they're going to be introduced to a mysterious new beast, and each of them can only touch one part of this mysterious new beast, which is an elephant. And depending on which part they touch, they come up with completely different conclusions. You know, if you touch the trunk of an elephant, you think it's a snake. If you touch the leg, you think it's like a tree. If you touch the ear, you think it's like a fan. And similarly, when you look at this rate cycle, in some ways it's like nothing that's come before. In some ways it's a lot like past cycles. But let me give you a concrete example of some ways this is unique that we haven't seen before. One is just the swings in economic activity, the collapse in activity, the collapse in employment, and then also the rebound. We've never seen such a quick rebound in the labor market, in activity, and in inflation. Another way this cycle has been unique is that central banks, on average, across the advanced economies, were slow to respond to the pickup in inflation and recovery, but then they responded by being unusually aggressive to make up for being slow. So it's the most synchronized period of rate hikes we have ever had, at least in the data I've looked at since 1970. And it was also followed by central banks keeping rates on hold for longer, on average, than they ever have at their peaks. So unusually slow start, but then aggressive response, hold rates at their peaks for longer. And what's remarkable, despite all those unprecedented characteristics of the cycle, we're now settling about where you settle 2.5 to 3 years after you start hiking rates.
Well, I'm curious about that very point. There's a lot of debate about when the Fed is going to cut and how much they're going to cut and things like that. Maybe more important is where they end up, where it ends up, whenever that period of time is. And given your study of rate cycles, do you have a sense? Because some people think we're going to end up at a higher level than we were before, where you call it R-star, neutral rate, or whatever. Other people say, no, we're going to go back down to lower rates. Do you have a view on that?
So based on my study of historic rate cycles, what it suggests is rates may not go down as low as most people are expecting, or as, say, the Fed's dot plot is predicting. You know, based on this historical comparison, looks like things are largely normalizing now where you would at this point in a rate cycle, which means rates are probably settling not far off where they're going to settle. And rates now are about 5.25%. Which means they would not be going all the way down to the sort of 3, 2.25%, 3.5% that is in the Fed's dot plot right now, given where all the other measures of economic activity are.
And that was Kristen Forbes, MIT professor of economics, speaking with Wall Street Week host David Weston. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, it's time now for the Trading Diary. What you need to be watching this week, which is just tomorrow. Big tech earnings continue today. We get earnings after the bell from Apple, along with Amazon and Intel after the bell this afternoon. Stock is down 40% year to date, so we'll see what they can deliver. Of course, we round out the week tomorrow with earnings from Exxon and Chevron. And of course, before we get there, the jobs report at 8:30 a.m. Eastern. Shanali.
And Katie, we're going to look ahead to those earnings after the close because investors are awaiting details on AI developments from Apple, Amazon, and Intel as Wall Street gets more hawkish about CapEx into new tech. Bloomberg Intelligence senior analyst Anurag Rana is with us now. And you think about the expectations for Amazon. What are you lining up for them?
Yeah, I think AWS growth is really critical for the momentum of the stock, which has done really well over the last 12 months. When we saw results from Google, we really thought that you will see good cloud results from both Microsoft and Amazon. When Microsoft reported, they basically got a good AI print in terms of AI contribution, but their non-AI cloud business decelerated a little bit. So that really puts a big question mark for what's going to happen with AWS going in tonight. We do expect some lift up because of AI, but guidance is going to be very, very important for them in order to maintain this momentum that they have.
Yes, so a lot of focus on the cloud when it comes to Amazon in particular. Let's talk a little bit about Apple, of course. We were speaking with Tom Forte a little bit earlier, and he made the point that you think about the AI upgrade cycle, he doesn't think it'll be as meaningful as maybe some of the other ones that we've seen.
Yeah, we are still very early in that. We haven't even seen them, launch the new phone with the capabilities. That's going to only happen sometime in the, September timeframe. So this is a seasonally weak quarter. You're not going to see major uplift over here. But I think China remains more important right now for the next 6 months than AI for Apple, because we saw a good relief rally when they reported good China numbers back in April. And we really need to see some commentary whether what's their position right now, whether they have been gaining market share or whether they are going to see a slowdown in China. So I think guidance from them on the China market is far more critical than anything else at this point.
At the end of the day, how much room is there for an upset? You think about how the other stocks have been reacting this season.
Yeah, I think, if they give a good, framework of growth in the next 6 to 12 months, and that's without the AI push. See, the question is not the AI push is going to come. It'll come for Apple, but the question is whether that's going to be over the next 12 months or 24 months. That's a big question. So, it's more a question of timing than the actual the refresh cycle. But I think China really drives the stock over the next 6 to 12 months.
All right, Anurag, really appreciate the preview. That is Bloomberg Intelligence senior analyst Anurag Rana. Meanwhile, we take a look at markets taking a bit of a dive right now. The S&P 500 giving back its gains, now down 0.5%, even more so. You take a look at big tech, currently off by about 0.7%. Of course, that's even with Meta's results yesterday. We'll see if we can change the narrative today when we get Apple and Amazon, and that bond market rally continuing. Now, coming up tomorrow on Open Interest, we have Rick Reeder of BlackRock, Savita Subramanian of Bank of America, and Acting Labor Secretary Julie Su. A lot to look forward to tomorrow. That does it for us. This is Bloomberg Open Interest, and this is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a Dean, who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
So the US is to sell 76 billion in 3-month bills and 70 billion in 6-month bills on August 5th, settling on August 8th. 52-week bills are selling 46 billion, that's settling on August 8th as well.
Details to come, and ARM slumps as the chip company holds off boosting its outlook. We speak to the CEO, Rene Haas. Plus, NVIDIA shatters records, adding $329 billion to its market cap in a single session. Full coverage ahead. I want to start on that Meta story. This is what the stock looks like. You know, it's basically trading as it stands on track for its biggest jump since February. We know all about the capital expenditures commitment, slightly boosting the bottom end of the range, but it looks like this whole AI thing is helping the top line, at least if you look at the sales outlook for the current period. Throughout the show, we're going to get a lot more on Meta. Now, one stock that's going in the other direction is the chip design firm ARM. I think we're down around 15% as it stands. They smashed it in the quarter gone relative to street expectations. But the story around ARM, as we bring up the stock here, down more than 15%, is simply that they resisted the urge to boost their outlook. And that raises some questions. The questions should be answered now. We have ARM CEO Rene Haas standing by, joining us here on Bloomberg Technology. I mean, Rene, good morning to you. That is the story. What were the factors behind you not boosting the outlook? What were the factors that made you cautious? Maybe it's specific end markets. Maybe it's your view of the macro situation around the world.
Yeah, thank you, Ed, and great question to kick off with. The way I think about it is as follows. This is our fourth quarter as a public company. It is our fourth quarter of record revenues. As you said, we smashed it last quarter, over $930 million of revenue. So super happy about the quarter. Last quarter, 90 days ago, we raised the annual guidance about 8 to 10%. So when we looked at the outlook for the year, 90 days later, coming off a great quarter, we just didn't feel the need to raise expectations again. So that's really just the backdrop. It's quite simple. We raised the guidance for the year last quarter, record quarter this quarter, and we're maintaining at this point.
Rene, is there anything you can tell me about specific markets that you serve where you see some caution or some hesitation, but you're also able to see whatever it is holding you back working itself out?
Yeah, remember, Ed, that we have two components to our business. We have the licensing business and the royalty business. The licensing business, which is really the forward indicator of demand for ARM technology, never been stronger. The licensing revenue year on year up 70%. What's driving that? That's demand for building new complex chips, more demand for ARM, more compute capability. So that is a harbinger of forward type of demand. Royalties were also up year on year, almost 20%, largely driven by smartphone growth, where units have been modest, but our new version 9 is driving high royalty growth. So in general, we're very, very optimistic about the long-term outlook, particularly because of the licensing activity being so strong.
One of the areas, Rene, you know that I cover a bit more deeply is automotive technology, and I'm just trying to draw parallels with different names out there, understand what's happening. Mobileye told us this morning, for example, that particularly in China, but globally, some of their customers just stopped making orders for the second half of this year.
Germany's 10-year government bond yield drops to the lowest since early February, last down around 7 basis points.
Specific chip that you're involved in the design of, it's much further afield, longer term. But do you see in that industry in particular any sort of either cyclical process happening or some specific weakness?
Yeah, I think the way we think about the automotive market is we are growing faster in terms of demand for our technology than the market itself. So we were actually up double digits last quarter in automotive royalties. And that's really a function of A, gaining market share.
US stocks extending their fall now, the Dow Jones down 1%, the S&P nearly down 1% as well.
More complex compute platform devices. They run a lot of software, whether it's for IVI, EV, autonomous. So we're very, very bullish about the long-term automotive outlook. The near-term inventory issues that go back and forth, we haven't been impacted by that so much because, as I said, we're gaining share, and the complexity of our own technology being used just keeps going up.
Rene, I don't know if you'd agree, but I think the sort of common theme of this earnings season is capital expenditures relating to infrastructure for AI. And my question simply is, what direct benefit does ARM get from any of that process or investment cycle?
Yeah, thank you for the question. We get a bit of a dual benefit. There is a lot of CapEx going into overall infrastructure scale out. There's general purpose compute. ARM benefits there because our low-cost, low-power processors are very, very efficient in terms of building data centers. You have AWS, you have Microsoft, you have Google. They've all announced products based on ARM. And then you have the AI data centers, which are very, very complex, require a high degree of customization, power efficiency even more important there. And that's been a great tailwind for our business. Just look at what NVIDIA announced with Grace Blackwell, a very, very complex, not only chip, but platform based on ARM using their most advanced GPUs to drive the most complex AI data centers. So for us, we broadly view this AI CapEx expenditures as a tailwind for the business.
Rene, you mentioned Grace Blackwell. It takes me to one of our audience questions. So when I said you were coming on the show on social media, I actually got quite a number of submissions for you. And one is straightforward. Does ARM plan to design its own accelerator to compete, I guess, against some of the partners that you're with out in the marketplace?
Yeah, no product announcements today, Ed. Sorry, we're just here to kind of talk about the past quarter and our outlook going forward.
No product announcement, but that would indicate from a sort of, I suppose, academic or R&D standpoint that you at least think about it.
We think about a lot of things, right? I mean, our technology, as broad as it is, as many markets as we can play in, my job is to think about a lot of things. So I think that's a safe statement.
Away from the sort of scale of infrastructure and data centers, I think the AI PC is something that's pretty much dominated the news cycle so far in 2024. One of the other audience questions was, when do we see sort of a truly competitive ARM-based Windows product that can take on the performance of Macs or Apple's own silicon that goes into a Mac? I know that you think about this field a lot, but on the competition side, what do you make of that question?
Yeah, so I want to be respectful of my great partner Apple and their ecosystem, but there are some great products out there today. Dell XPS has some amazing technology. The battery life, I think I was reading online. In fact, I was looking to buy one of them. The advertised battery life is 19 hours. Now, for a Windows machine, that's rather unprecedented in terms of battery life, all-day use, don't need a brick. So Dell and Michael and his team have done an amazing job developing some great products. So I think there are great products out there today.
For all of the AI PC announcements, are there any examples of things that actually sort of translate into revenue for ARM?
Well, again, when you think about AI PCs running on ARM, that's revenue for ARM. And I think the way we think about the AI PC Windows on ARM market is probably less about the shipments this quarter, but the long-term trajectory. I think what you're now seeing is single suppliers that are in the market today. We've heard from a lot of sources that in the upcoming years, there's going to be more and more vendors building chips for the Windows on ARM market. That's just going to be great for us because not only does it fill out the choices of units for the end market, but it's going to drive growth for us. So I said a few months ago that I thought ARM could be a 50% market share in the Windows market in 5 years. I do believe that. We're about 100% of the Apple operating system, so 50% of the Windows market doesn't seem too ambitious in 5 years.
4 quarters ago, probably a number of years ago, you and I might have started a conversation talking about the smartphone market. So we'll end there. What's going on in the smartphone market right now? And whatever is happening as sort of an industry-wide level, is there anything specific relating to ARM at the high end of the smartphone market, vis-a-vis sort of lower-end models, the middle market, that you can tell me about?
Yeah, I don't want to sound like a broken record saying the trends that are going on in the smartphone market are good for ARM, but I'm going to say that because what we're seeing in the smartphone market is while unit growth has been modest single digits, there's been significant growth in the premium segment, the high end. And for ARM, that's where we draw the highest level of revenue. The reason for that is we use version 9 up in that area of the stack. That's a much higher royalty rate than the previous version. And those version 9 smartphones in the premium space, they use a lot of ARM processors, in some cases 12, 4, 14, 16, depending on the mix. So it's a true compute platform solution, which drives growth for us, which is why in the last quarter, where units were single digits, our smartphone royalties were up 50% year on year.
I had a similar conversation with Lisa Su of AMD yesterday, but is that reflective of a broad market movement, or is it something special ARM's doing to outperform in the market?
I think it's a combination of both. A number of years ago with version 9, we added some significant compute capability that was really to drive performance. Now what we're seeing, particularly in the near term and going forward, is the SKUs that are being built, people are trying to put as much compute performance as possible in those phones. For example, when you think about the large language models such as Llama or Gemini, when those phones were developed, those models didn't even exist. So not only are you having to run all the complex software, the camera apps, but now you want to run an AI workload. So people are just putting as much compute as possible into those high-end chips, which is good for us.
Rene Haas, CEO of ARM, thank you very much. And for what it's worth, the stock hit session low, down 16.2% during that conversation, but a lot learned. Let's stick with earnings and look at Etsy, which released their second quarter earnings on Wednesday after the closing bell. Etsy CEO Josh Silverman joined me earlier to talk about it. Have a listen to this.
We're really proud of the fact that in an environment where we're really swimming upstream with a really tough macro, and I think the story of this quarter has been, for discretionary products in particular, it's a tough time.
And that's hitting the consumer directly, basically.
It's hitting the consumer directly. Wells Fargo published a report just recently saying 60% of Americans say that by the time they're done paying their essential bills, they have very little money left over for anything else. And yet we are actually maintaining, we have roughly the same number of active buyers as our all-time high, 91.5 million. We came in actually above the top of our guide or at the top of our guide on every metric. So we're really proud of how we're doing, and we're aware that it's a super volatile macro. But in this time when we're swimming upstream and maintaining, we're building muscle that we know is going to make us stronger. And most importantly, we're not letting ourselves be dragged down. We're in a moment where there's a race to the bottom right now around who can sell things the cheapest. And Etsy is not focused on that. We're focused on making Etsy even more Etsy, leaning into our point of differentiation. And to your point about AI is going to be so helpful for us because, as you know, there's over 120 million things for sale on Etsy, and every single one of them is unique. Every single one of them is made just for you. So organizing that in a way that's easy to navigate is a very tough challenge. There's no army of humans you could hire to do that. But LLMs are really good at organizing huge amounts of information in a way that's easy for humans to understand.
That was Etsy CEO Josh Silverman. Now coming up, Meta to the rescue, delivering on earnings and easing some of those big tech growth concerns, stock up almost 7%. A lot to talk about. This is Bloomberg Technology.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killing, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Fed bids for 4-week bills total $281.7 million.
There are all the jokes about how all the tech CEOs get on these earnings calls and just talk about AI the whole time. It's because it's actually super exciting and it's going to change all these different things over multiple time horizons.
I think we should probably update that photo. That was Mark Zuckerberg, the Meta CEO. He doesn't look like that anymore. Meta posting better than expected Q2 results, and it signals that the company's AI investments are starting to pay off, triggering the stock's biggest one-day rally in around 5 months. That level, 7% gain, on track for its biggest jump since February. Let's get right out to our Meta reporter, Kurt Wagner. I mean, that was the question. You spend all this money, and the CapEx number at the bottom end of the range slightly boosted, but does it help you make money in the sort of normal areas of your business? Did it?
Well, this is the story that they're trying to tell, right? Which is that AI investment is impacting their current ads business. It's making their ads more relevant. It's making, it's helping advertisers even create new ads with Gen AI tools. It's helping the timeline. It's giving people more relevant content, so they're sticking around longer. This is the narrative that they're trying to tell on the more immediate side. And the challenge, of course, is, as you point out, they're investing very heavily in the future as well. And so they're trying to balance, like, hey, the AI is paying off now, but it will also pay off in a couple of years when these glasses, these large language models, the metaverse comes to fruition. It's a tough balance for them, but they were able to sort of do that with the Q2 earnings this week.
We're just showing the numbers or the revenue numbers by business line. And I think that's the bit that we're trying to understand. You and I have all these conversations with very smart people outside of Meta who give them a lot of credit for their work in the field of large language models and the future applications of generative AI. But it seems like the story here is that it's really helping advertising, which is what they've been basing their business on all along.
Yeah, and it's not as sexy of a story, right? Because it's like, hey, investing billions and billions of dollars into these large language models is going to, improve the ROI on our ads product is not really the exciting AI story that a lot of people want to hear. That's chatbots, that's AI smart glasses and assistants and things like that. But I do think there is an element of this investment that is paying off more in the short term. We heard a lot about that yesterday. But I don't think that's what gets Mark Zuckerberg as excited, right? That's a necessity. That's what's going to fuel and fund these bigger visions he has. But I really think, when he talks about AI, he's predominantly talking about this futuristic technology, this next wave, this next computing platform that he really wants Meta to own.
Just really quick, our audience around the world will have different relationships with Meta and its products. But I found the data on growth across the family of apps or family of products really interesting. Why is that going well?
Well, I mean, they have WhatsApp, I think, is sort of a secret weapon that a lot of people don't think about because it's not as big a part of the business, right? But I think this is also just to the staying power of the core network, Facebook and Instagram. It's like these are products that are still growing, that are still finding new people despite years and decades of existence. And, they're adding Threads to the mix now, too. I don't think that's counted in that daily active people tally, but eventually it will be. And Mark Zuckerberg was talking about that with a lot of praise yesterday on the earnings call.
Bloomberg's Kurt Wagner, thank you very much. Now, the other sector we're looking at is chips. The US is weighing unilateral restrictions on China's access to AI memory chips and equipment capable of making those semiconductors as soon as next month. Back with her latest reporting, Bloomberg's Mackenzie Hawkins. We actually talk quite a lot about this on Bloomberg Technology, that, for all the hype around AI and the GPU, you've got to have that high bandwidth memory access as well to make it competitive. Just give me the basics of what you've reported and when it's happening.
So the US government recognizes that too, that you can't make an NVIDIA GPU work without access to memory. And officials have been considering for months adding to the restrictions that they've already replaced on China's access to logic chips, which are the brains of devices, to attack the memory side, which handles data storage. And they're working on this massive export controls package, probably the most significant one that we've seen since the October 2022 rules initially rolled out and sort of changed the global landscape for semiconductors. This list could include restrictions on high bandwidth memory above the 2.0 generation, so capturing Samsung, SK Hynix, and Micron's latest models. Also on the tools used to make those
In 10 minutes' time now,
Then
at the
there's
bottom
a
of the hour,
separate
the US is
massive
due to sell
restriction on
$90 billion
additional tools and
in 4-week
equipment used
bills.
across
The prior high
industry,
yield was 5.285%, with a prior bid cover of
companies, so
2.77.
think Lam, Applied Materials, and KLA, with carve-outs for their Japanese and Dutch rivals. So this is really a massive package. It's what will probably be the Biden administration's last big swing in this space, and it could be unveiled as soon as a couple weeks from now.
The strategy to make US chip sector more competitive is two sides: restrictions, like you just outlined, and incentives. And the other big story you reported was one name, Applied Materials, not getting access to funds in incentives.
Right. So we have the export control side of the coin, and we also have the CHIPS Act, which is a $39 billion subsidy program designed to bring chip manufacturing back to U.S. soil. And so far, we've seen over almost 90% of the funding committed to names like Intel, Samsung, TSMC, and Micron for these massive commercial fabrication facilities. But more than 670 companies expressed interest in the funding. So there were always going to be companies that didn't get it. The biggest name perhaps among them is Applied Materials. They have this $4 billion research and development project that they're working on in Sunnyvale, and they had hoped to get government support for that. Unfortunately, that didn't work out for them after the U.S. scrapped part of that grant program that was specifically designated for commercial R&D because of infighting about a separate program on military chips. So not a great piece of news for Applied Materials, and they've always said that the scope of that project will depend on U.S. government support.
Mackenzie, just very quickly, is there any money left then from the CHIPS Act, or it's now all accounted for?
There's a bit left, something on the order of $6 billion to allocate. We should expect to see, Commerce Secretary Raimondo has said that we'll see announcements through the end of the year eating up all of that funding. And after we've seen announcements to the major big foundries, we'll probably expect to see a lot of smaller supply chain investments between now and the end of the year.
Bloomberg's Mackenzie Hawkins very busy with a lot of reporting. Thank you. Now, coming up, Reddit makes an AI purchase. More behind how the social media platform is set to integrate AI. That's next. This is Bloomberg Technology.
Reporting from our world headquarters in New York, I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's time now for Talking Tech. First up, Olympic partner Atos reported a loss of $2.1 billion for the first half of the year on weaker customer demand. The French IT company has struggled with debt, accounting errors, and industry-wide headwinds that has wiped out nearly $14 billion of its market value over the past 7 years. Plus, Reddit acquires startup Memorable AI in its first acquisition since going public in March. The startup uses generative AI to help
So in 5 minutes time now, at the bottom of the hour, the US is due to sell $90 billion in 4-week bills. The prior high yield 5.285%, with a prior bid to cover of 2.77.
Issues a warning, saying the company could be at risk of getting caught in a quote vicious cycle if it doesn't revamp its workplace culture. In an unusually harsh memo to employees, the head of the chip division said Samsung must take steps to eradicate communication barriers and stop, quote, hiding or avoiding problems. The letter comes after recent missteps by the company in supplying memory chips for AI. Now, coming up, we're going to be joined by Denny Fish, portfolio manager at Janus Henderson, to dive deeper into Meta and the other tech earnings. Real quick check on shares of Mobileye. So this is the Jerusalem, Israel-based maker of chips for advanced driver assistance systems. That stock down 20%, trading at a record low. Why? Because 2H, it downgraded its revenue outlook. Its automotive customers stopped placing orders. This is Bloomberg Technology.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates...
Shortly expecting the results from the 4-week bill auction.
Prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Welcome back to Bloomberg Technology. Ed Ludlow here in New York. We're going to check in on the markets. Big tech earnings in focus this week. Meta posting better than expected quarterly results, helped by new investments in AI. The attention now turning to Apple, Amazon, both reporting after the closing bell. But let's stick with the equity story. The NASDAQ 100 pulling back after a monster rally led by NVIDIA on Wednesday. The stock recording its biggest advance in over 5 months. And here's the bit, adding a record $329 billion to its market cap, destroying the single-day record that it had previously already owned. There's a lot to talk about. Let's keep the conversation going. Denny Fish is portfolio manager at Janus Henderson Investors. And let's start with NVIDIA. We say it's a moment in markets history. It broke its own record, but it's one of the bigger positions you hold, Denny. So when you see the red headline on the Bloomberg terminal, how do you react? How does that make you think?
Well, I think, you know, NVIDIA has been a remarkable stock for the last year and a half, and that's primarily been because of the financial performance. I mean, the ramp in revenues that we've seen with its AI chips and GPUs is like nothing we've ever seen before. And, you know, where the market's at right now, it's really this push and pull. And what we've seen, if you just look at the hyperscaler earnings so far, and particularly the CapEx forecasts, the market is just really hinging on every word that we're hearing. And, you know, effectively what we've heard is that nobody's blinking. And you have seen CapEx go up at Google, you've seen CapEx go up at Microsoft, and you're seeing CapEx go up at Meta, and all of those companies seem to be implying that there's no end in sight, at least, you know, through 2025, and that should be good for NVIDIA. And you know, it's, you know, if we actually look at the other data points in the industry, you know, AMD just reported, and
high rate of 5.285%, 5.285%, the bid cover of 2.87, 2.87. So the US sold $90 billion, awarding 9.37% of bids at high.
It's probably its most significant product cycle ever with Blackwell as it goes to a full systems approach this fall.
So actually, I ask you about that specific point. You know, I've discussed with Jensen Huang the annual cadence of new product refresh. But the bit that's kind of concerning or hard to understand is, what about all those companies, the hyperscalers, but also others, that invested at the H100 generation, and they may have only just got that capacity online, and then suddenly they have the option or choice of whether they buy the next cutting edge generation of chip, upgrade. And I think that Jensen's probably talked to you as well, right, about the ability to swap and in and out those generation of GPU quite easily. But it's hard to fathom, really.
Yeah, well, what's really interesting, and I'll give you a couple data points. Last night, Mark Zuckerberg announced this publicly. He talked about that Llama 4, which is the next iteration of their open source large language model that they just, have been evolving, is going to require 10x the compute that Llama 3 required. And why that's important is, if you talk to the leaders in industry, you'll hear a comment, and that comment is, we want tomorrow's GPUs. And the reason you hear that comment is because one of the single biggest bottlenecks to actually advancing these large language models, whether it's OpenAI, Anthropic, Google with Gemini, Llama, whatever it might be, you need increased compute power. And that is exactly what Blackwell brings. And so the important part for these companies is making sure that they have the ability to actually create fungibility with the GPUs so that when you use H100s and then you're going to move to Blackwell, you can actually use those H100s for inference, or you can use them for other parts of your company. Whether for Microsoft that could be to support Office 365 and Copilot, or GitHub Copilot, or in Meta's case to support the recommendation engine, or content creation, or whatever it may be. And so having that fungibility of the GPUs, but then also having the ability to lean in hard to the latest generation so that you can push the envelope with these frontier models.
So Denny, this is a good point to go to Apple, because it's a different story, right? They are not a hyperscaler. They don't make the same direct investment in infrastructure. The CapEx has always been low. But the AI story is the same. It's a smaller position for you, but your approach going into this evening?
Well, it's always hard going, you just never know, right?
Okay.
We're here on the day of earnings. But here's what I can say. We were really impressed
Bank of England's Bailey says it's reasonable that Bank of England forecasts are based on the current market curve.
Going to deliver. It's not ready for prime time yet. This is unlikely to be a massive cycle, with the 16. But as we start looking into next year, and if they get Siri right, and they're actually, here's the beauty of the Apple model. All this CapEx, this $200 billion plus that the hyperscalers are deploying into CapEx, Apple gets to leverage that because they are the gateway to the AI-enabled internet, through the iPhone interface. And I think that's really underappreciated as it's related to Apple. It's a very capital-efficient model.
And Denny, sorry to jump around, but Amazon, I think with the focus then switches back to AWS and whether the CapEx story and the investment cycle is still intact.
Yeah, so, Amazon's a little different. And the reason it's a little different is, as I mentioned, if you think about Alphabet, you think about Microsoft, you think about Meta, and that fungibility element of GPUs and capital expenditures. Amazon doesn't quite have that. They can't really repurpose a bunch of GPUs into their core business because it's not a daily engagement app like Office 365 or Copilot or Meta or Search. And it really does hinge on their ability to provide the underlying compute for other companies. And so they're really in a push and pull of, having been the dominant provider of cloud computing services for the last 15 years, and now pivoting their business to try to compete as aggressively with Microsoft and Alphabet in this next generation of cloud compute, which is AI enabled.
Denny Fish, Portfolio Manager over at Janus Henderson. Really appreciate it. Thank you. Some breaking news crossing the wire. We're getting more details on the prisoner swap between the US and Russia, where Wall Street Journal reporter Evan Gershkovich and former US Marine Paul Whelan are being returned. Vladimir Krasikov will be released in the historic 7-count prisoner swap. Krasikov was serving a life sentence in Germany for the 2019 killing of a former Chechen rebel in Berlin. We'll bring you any additional updates as they cross the wire. President Biden plans to deliver remarks at noon about the Americans freed from Russia. Okay, back to one of Bloomberg Technology stories. Amazon is showing interest in robot software maker Covariant. That's according to sources. The company, which was founded in 2017, has raised $245 million from investors, and it was valued at $625 million in a 2023 funding round. Joining me is Bloomberg's Katie Roof. And Katie, you and I broke this story together last night, along with Bloomberg's Spencer Soper. It's very in line with what Amazon's focused on. Give me the details that we know.
Exactly, and so this is a warehouse robot software maker using AI. For those who've been paying attention for a while, it reminds of Amazon's acquisition of Kiva Systems in 2012, where they bought a warehouse robot maker. But this is obviously, modern technology in this space, and it could sync with other, warehouse type robots that, can put things together and package things, which is exactly what Amazon needs.
We should point out that Amazon and Covariant both declined to comment on the story. Amazon's at a stage where it has more than 750,000 robots around the world doing all sorts of things. One source kind of outlined to me, Covariant, even though it's raised all this money, is a little bit of more of an R&D, research project, and you kind of need Amazon to get going. The market is interesting because is money hard to come by, Katie? Do you need kind of a savior like an Amazon to come in if you're a smaller startup that's still kind of building out your tech?
Sure. I mean, there's certainly capital available for the very cream of the crop top startups right now, but a lot of investors are a little skittish given that we've been, there were a couple years of a correction. So having a, large strategic like Amazon, provide resources would certainly help this startup continue to grow in-house inside Amazon.
And Katie, real quick, we're short on time. XAI looking at character, Musk weighed in. What's going on?
Sure. This is another AI acquisition rumor. We've heard there have been some sort of interaction between Character AI and XAI about a potential acquisition. Obviously, a deal is not yet done, and that is what Elon is weighing in about. But, we have heard that there is something going on there. So remains to be seen whether a deal actually happens.
Yeah, I heard there's something going on there too. Bloomberg's Katie Roof, thank you very much. Okay, before we head to break, we want to turn our attention to the Bank of England for a moment. The Bank of England cut interest rates for the first time since early 2020 and signaled further cautious reductions ahead. Moments ago, we sat down with Governor Andrew Bailey. Have a listen.
Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis, then obviously COVID as well. I think to get there, something really bad has to happen that we're not currently expecting. We'll be lower than where we are today, but I think it's very clear that we're not going back.
Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Why does this business model work? Because it's virgin space. It's
never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at bloomberglive.com/powerplayers.
I want to talk about GitHub, a leading AI-powered developer platform. The company announced expansions in their AI strategy with increased access to and new extensions of their Copilot models. GitHub CEO Thomas Dohmke joins us now for more. And you've been very busy on social media. You've been hinting at what you've been working on. Now's the opportunity for you to talk about it a bit more explicitly. What's going on?
It's an exciting day. I'm so full of energy this morning. With GitHub Models, we're bringing the power of industry-leading AI models, small and large, open and closed directly to the over 100 million users on our platform. And, developers are no longer just writing back-end and front-end code. They have to integrate different machine learning models right into their apps. And we want to catch them early in the developer lifecycle. So we're giving them access to popular models like Llama 3.1 or Mistral, large tune, of course, the OpenAI GPT models, Microsoft's models for free right on GitHub. So to enable them to explore, to play with these models and put them into their apps. And when they're ready to go to production, to give them a glide path into Azure AI.
You said on X that hint, it's not Copilot, but it's not AI. Just explain in layman's terms what you were trying to get at with that.
Yeah, in the past, when I was on the show or when I was on media, we talked with an AI at GitHub mostly about Copilot, our AI pair programmer that helps developers write code. It helps them, to do the work on a day-to-day basis. With GitHub Models, we're giving them a component to put into their app. We're giving them access to models like Llama, Cohere, AI 21 Labs that they can play with, that they can send prompts to, and then put that model, into their application code and run their own scenarios on top of these models. So it's not Copilot, but it's AI and it's machine learning models readily available for developers.
The other big news of the week came during Microsoft's earnings and the discussion around GitHub. It's your growth. I think the number to go to is the annual revenue run rate of $2 billion. For you, Thomas, that seemed like a really important milestone. Why?
It's important, from two perspectives. One, 6 years ago, I was part of the team at Microsoft that acquired GitHub, and we had high hopes for this to be a successful acquisition. So I think, the 2 billion revenue run rate shows that we have done a good deal at Microsoft. We not only bought a company, but we actually invested into GitHub. We set on the power of this developer community to create, an ever-growing revenue stream. In the earnings before this one, we said we are growing 45% year over year. This time we announced that the run rate is now over $2 billion. And more so, in the last year, 40% of our growth came from Copilot. 77,000 organizations are now on Copilot. It's no longer, about the early adopters, Copilot has crossed the chasm. The question really everybody needs to ask themselves, am I part of the early majority, or am I going to wait and become, the laggards of adopting AI technology in my developer lifecycle?
Thomas Dumke, CEO of GitHub. It's great to have you back on the show. Great to catch up. Thank you very much. Now, coming up, we're going to be joined by Rachel Tipograph, CEO of MicMac, to dive a bit deeper into Meta's ad performance and try and join the AI story to the advertising story. That's next. This is Bloomberg Technology.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
It's in 10 minutes time now at the top of the hour. We do expect comments from Bank of England's chief economist, Pill. So Pill does a virtual Q&A after the latest interest rate decision.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude, encore presentation this weekend, only on Bloomberg.
Let's get back to Meta and Meta's results. The stock, by the way, off session highs, but still up 6%. The tech giant beating estimates on its advertising growth. In particular, Rachel Tipograph, founder and CEO of the e-commerce marketing platform MicMac, joins us now. And Rachel, you have this rich data set tracking where advertisers invest their dollars across not just Meta, but its competitive landscape as well. And I think what's interesting is that the data you track was basically justified by their forecast for sales in the current period. Just your response to that?
Yeah, thanks Meta for verifying our data. So yesterday, Zuckerberg reported 11% year-over-year revenue growth. MicMac works with over 1,700 of the biggest brands in the world, powering their commerce media. What did we see in our data? We saw 10% year-over-year revenue growth. So it's absolutely spot on. Meta remains the most trafficked brand advertising channel at MicMac. On any given day, it represents about 40% of our total traffic.
So what's interesting is you have the data, and then what you need to do is find the reasons behind the data, right? And we went into the earnings print solely focused on artificial intelligence. It seems like the early work and investment Meta's made in AI is just making their ads more competitive. Is that fair?
AI is part of it, but I actually think something comes before it. For the last 2.5 years, Meta has stopped focusing on shiny objects like the metaverse and it got back to business and focused on its core revenue stream, which is advertising. Meta had to respond to Apple's privacy changes, and it responded in a big way. Meta did a huge campaign to every big global advertiser and essentially encouraged them to integrate with their event attribution API, which bulletproofed the effectiveness of the ads. That was number one. Number two, Meta's also made a concerted effort to partner with retailers and essentially enable off-site retail media within the Meta platform. That also improves the effectiveness of their ads. I would argue that AI is number three. What AI is doing for Meta and for really all advertising platforms is lowering the barrier to entry. One of the major barriers to entry in advertising is creative. And so if Meta can remove that barrier, it actually opens themselves up to any business on the planet. So I suspect with the investments in AI, you will see their small, medium business advertising grow.
So I want to linger on that point a moment longer. We just showed the pie chart breaking down where advertisers are placing their money. The story is the one that you're telling at least, is so similar to last week with Alphabet. Again, we went into it really focused on AI, but the biggest contributor to growth was just the search business, the legacy business.
100%. It's all about making every dollar stretch for the biggest advertisers in the world. You know, on top of the big tech earnings, you've also had the big CPG earnings in the past few days. And what they're struggling with is top-line growth. Where is top-line growth going to come from for these advertisers? Investing in channels like Meta, Google, and TikTok. Going back to that pie chart, what you also see is, yes, Meta is the most traffic source within the MicMac platform. But what's number two? TikTok. TikTok now represents 20% of our total traffic. If we were speaking 4 years ago, TikTok wouldn't even be in that pie chart. So if I was Meta, I think the big headwind that they now need to worry about is TikTok. And they alluded to that in their earnings as well.
They did allude to it. Okay, so let's look at it from the opposite perspective. TikTok faces a divest or ban scenario in the United States. If you're an advertiser, why would you keep putting dollars into that?
In 5 minutes' time now at the top of the hour, expecting possible comments from Bank of England's chief economist, Pill, who does a virtual Q&A after the latest interest rate decision.
The reality is with advertising, it's very easy to move dollars from channel to channel. We've been on the show. We've talked about X in the past. We saw a 100% decline in X traffic. Did that matter to advertisers? No. They just reallocated the dollars elsewhere. So until something actually happens with TikTok, you will continue to see brands invest in that platform because of the effectiveness of the ads. In 1 year, we've seen 190% year-over-year increase in TikTok traffic. We only saw 10% in Meta. Again, if I was Meta, I would be very concerned about TikTok right now.
Rachel Tivergraf, founder and CEO of MicMac, excellent breakdown of your data and linking it to Meta's own data. Thank you very much. That does it for this edition of Bloomberg Technology. There is one big earnings evening left to go, but so much to recap on the podcast. You know exactly where to find it. Apple, Spotify, also on iHeart. This is what's to come, right? And this is the picture of the markets right now. We await Apple, which is down 0.9%. We await Amazon, which is down 0.9%. AI is going to be the story, but as our guests outline in the show, in very different ways. Meta off session highs, but continues to trade on track for its biggest jump since February of this year, with at the index level, the NASDAQ 100 down significantly now, down 1.5%. Nvidia a part of it. This is Bloomberg Technology.
loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment
Shortly expecting the Freddie Mac mortgage rates.
brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome to Bloomberg Markets. I'm Scarlett Food. The equity market takes a big turn south.
US 30-year fixed-rate mortgages down slightly to 6.73% for August first week from 6.78% the prior week, according to Freddie Mac.
Bad economic news is being interpreted, is being seen as bad for stocks, no matter the size. So you look at the S&P 500 and the NASDAQ 100 stocked with the biggest companies in the U.S., each down by at least 1%. They're at session lows. And of course, for the NASDAQ 100 and the S&P, we should mention this comes before Apple and Amazon report their earnings after the bell. The Russell 2000, of course, stuffed with small companies. They had been the beneficiaries of rotation away from tech. They're the weakest link today, off by 2.9%. But chip makers are getting hit the hardest there by more than 5%. By the way, the VIX is also moving higher, approaching 18. Today's data points included weekly jobless claims hitting an almost one-year high in manufacturing, shrinking the most in 8 months. Bonds rose, and that pushed yields lower as traders are now more convinced the Fed will cut rates in September. They're now pricing in 3 rate cuts this year. So to put that all into context for us, let's go now to Natalia Knežević to give us some equity movers and some more details on what we're seeing in today's trade. Natalia?
Hi, Scarlett. Let's start with those bets on interest rate cuts. We now see that the market is pricing in 3 rate cuts by the end of this year. Of course, that came on the back of yesterday's Federal Reserve's meeting. Today, we also got, as you mentioned, weaker than expected economic data, jobless claims, and ISM manufacturing. But now some traders, if we look at the price reaction in the stock market, are
Noting European gas prices settling at the highest this year on supply risks.
Bad for the stock market. Let's flip up the board and look at some of the biggest movers today. Of course, Tesla, it is up by 6%. The key takeaways from the earnings report is that sales came better than expected, and targeted investments in AI will be helping the company to sell advertising in a more targeted way for its consumers. So we got a couple upgrades on the stock. It keeps moving higher. Let's take a look at consumers segment. We got really interesting reports from 2 burger chains. So the first one is Wendy's. The stock is down by almost 1%. The company cut its guidance, and it posted weaker sales across all chains. And this is another indicator that higher prices are hurting U.S. consumers. But on the flip side, we got Shake Shack. This stock is absolutely soaring. It's up by 15%. The company raised its full-year guidance, and analysts are pretty optimistic about the stock. Let's look at positioning and flows. It's also important when we look at market moves. So this chart shows CTAs, commodity trading advisors, positioning. Typically, the way they operate, when the market moves up, CTAs and other systematic funds, they increase exposure. When market goes down, what happened last week, they reduce exposure dramatically, and the stock market really feels this pain. So this chart shows that last week they reduced exposure by about 50%. That's one of the biggest declines over the past year and a half. And as of now, the biggest question is, will they keep decreasing their leverage to U.S. stocks or not? And some analysts I spoke with, they say, yes, there is still room to run, and now everything depends on fundamentals, such as earnings.
It all comes back to earnings. Natalia, thank you so much, as always. Fantastic wrap-up of their equity movers, as well as the positioning we see in the broader equity market. Now, it is a big, big week for central banks. The Bank of Japan and the Fed yesterday, of course, and the Bank of England today. And for the BOE, today's decision featured the first rate cut since early 2020. Investors snapped up UK bonds, and higher price means lower yields. That means the yield on the 2-year was down the most since last December, as investors brace for further easing from the central bank. Bloomberg's Francine Lacqua sat down with Bank of England Governor Andrew Bailey. Take a listen.
Well, we were looking for, in a sense, for sort of confirmatory evidence. We weren't looking for something to change necessarily. It was confirmatory evidence. And we had that. I think we had, certainly in my own view, is we had that. But we will be looking at this framework and saying, are we seeing this sort of rather more benign process which we can sort of further confirm? Or does this sort of structural issue, which is why we've put this sort of risk in, that maybe COVID, for instance, has changed some elements of the structure of the economy, which is going to make the thing more sort of resistant, if you like, to measures to get inflation down. And that's the judgment we will have to keep coming back to.
Where do you think rates settle? Is 4% restrictive?
We don't have a number on it. What I would say is this. I think it's reasonable. Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis, then obviously COVID as well. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Governor, the government has said it will borrow an extra £16 billion this year. Does that change the calculus around rates?
Well, I'm going to wait for the budgets on the 30th of October to see the full picture, because we always condition on an announced fiscal policy. That's what we will see at the end of October, and we'll sort of put it through the machinery at that point.
So the Fed, the ECB, the BOJ are all adjusting policy, and that's very clear, and that's trying to make some big change in foreign exchange markets. What are those, what of those elements are actually important to you and BOE policy?
Well, we obviously don't have any target for the exchange rate. That's all a long way in the past in terms of that sort of thinking. But obviously the exchange rate feeds through in terms of financial conditions. We've seen some appreciation of sterling since we did the last report and forecast in May. Sterling has appreciated. We fed that through, as it were, so it changes import prices and so on. And that's how we tend to look at it, actually. I would say recently, over the last 4 or 5 years, actually, in the sort of transmission of mechanism of monetary policy, exchange rates have not played a very large role. And I think the reason for that is because we've all been facing essentially global shocks. So these are not sort of specific shocks that affect one central bank but not another. We're all in the same place, really.
And of course, that was the BOE governor. So let's discuss this further now with Bloomberg Opinion's Marcus Ashworth in London. Marcus, I've read commentary from a currency strategist calling this a hawkish cut, yet we also see traders betting on 2 more rate cuts by December. Which one is it?
It's a rather dull, cautious cut, because they're trying to slot in between the European Central Bank has already done this. They've copied their template. Everyone's waiting for the Federal Reserve. Come on. If the Fed cuts in September, and more importantly, signals are going to keep on cutting, you'll hear the mood music change instantly.
The TASS news reports today fire breaks out at the Russia's Omsk oil refinery.
Because the economies are so much weaker. And it's evident that inflation is beaten in the UK. Yes, there's some sticky service inflation. There's always going to be something which is sticky. But really, they couldn't. And it's only 5-4 decision, which bewilders me. But nonetheless, thank the Lord, they've actually managed to have the courage to cut. We're down from 5.25% to 5%. It's still, as they admit, very restrictive. They're expecting inflation at 1.5% in 2 years' time. This is obviously a disconnect here with policy, that they just don't want to make any mistakes. They'd rather be proved wrong, should we say, on the fact that growth collapses rather than inflation rises.
Yeah, and of course they're waiting, as you mentioned, for the Fed to take the leap. What does a rate cut mean, Marcus, for the new Labour-led government?
It means, it means thank you very much. Welcome to your new home and have a lovely day, because that's really what it's all about. I mean, look, it's just, if there was any doubt that Rishi Sunak calling the election early was a bad decision, this just completely, totally compounds it. And I guess that the Labour government will go, thank you very much, put that in the pocket and move on nicely, because they're doing some things which are slightly odd for their alleged growth agenda, by both cutting public spending and very clearly signaling taxes are rising, particularly on wealth, entrepreneurial type growth strategies. So they need a rate cut here, and they need several rate cuts. So they'll be very happy indeed, I suspect.
So we know that the BOE economist Hugh Pill will be speaking tomorrow. What will you be listening for from him, given that so much of what happens next depends on how the Fed proceeds? Hugh
Pill slightly borders me. He's just been confirmed again for another term as chief economist. He was one of the only internals, should we call them, who voted against a rate cut. Very odd. He had made a speech a while back, in June, which had said that he was clearly leaning towards a hold. So that's fair enough. But I can't understand. This is a guy last summer, a year ago, basically saying, looking at the market rate pattern, that we should be cutting rates. And then now he's saying we should be holding. And when it's evident inflation's collapsed from 11% down to 2% target. I don't get him, and I don't get his understanding of where he thinks the economy is. I respect why he's wanting to be cautious, but at some point you have to understand the economy. You can overdo restrictive monetary policy. I think the Bank of England is starting to appreciate that they are at risk of doing that. That will be a policy mistake. Their chief economist, who should be leading the charge here, is in a different field. I don't understand. So I'll be interested to see what he thinks.
Yeah, well, we'll see if we detect any change in tone from him then. Marcus Ashworth, Bloomberg opinion writer, thank you so much for joining us as always. Really appreciate it. Coming up on Bloomberg Markets, we turn to the great rotation out of big tech with Youngmoo Ma of BMO. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
So just an update here on the Russian Omsk refinery. So Gazprom's Neft's Omsk refinery operates normally after the fire, and they're saying that the fire has been extinguished.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From business's most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
A day after the Fed held off on cutting rates, we're getting evidence of weak economic data in both manufacturing and jobs. Now, that is sinking stocks but lifting bonds. The 10-year yield falling below 4%. Young-Yu Ma is BMO Wealth Management Chief Investment Officer, and he joins us now. Young-Yu, can you explain to me the dynamic here? Because bad economic news was once seen as good for stocks and bonds. Today, though, it's good for bonds but not good for stocks.
Yeah, thanks, Scarlett. It's great to be here. The bad news is good news for stocks is a very fine line to walk. It works until it doesn't. We do think that there is some possibility with the uncertainty that's out there that we'll get some continued soft economic data between now and the next Fed meeting. And there's a lot of time between now and then. There's a lot of time for the market to think the Fed's behind the curve. If that happens, there's a lot of prospect for even the labor market to weaken more over the next 2 months. So we think that uncertainty is really going to, at least has potential to weigh on the markets here. Okay, and as a result of the data that we've seen today, we're now seeing bond traders pricing in 3 Fed rate cuts this year. Previously, there was a lot of talk of 1 to 2, and most people kind of settled at around 1 to 2. Now it's 3 rate cuts. How do you see this playing out for the rest of the year? I mean, Jay Powell made clear that he's keeping September on his calendar as the next point because that is the next FOMC meeting, and he'll probably use Jackson Hole as an opportunity to shore up that kind of messaging. But how do you see it playing out in terms of actual cuts? Is it 25 basis point cuts over the next couple months? Yeah, that's a very good question. We've actually been talking for the past few weeks that there's a real possibility that the Fed could cut rates by 50 basis points at the September meeting. The market, I think just today, is putting in that probability at around 20%. Before, when we started talking about that, the market was having that probability around 5%, which we thought was a gross underestimation of the possibility for labor market or other economic weakness between now and September. The Fed just wasn't in the mindset of cutting rates at this meeting yesterday, although when you look at the arguments and the questions that Chair Powell received from reporters, really there's a lot of potential to even start rate cuts then, or at least the arguments for starting rate cuts yesterday were quite sound. So we think that adds the potential for the possibility of a 50 basis point rate cut in September, but we don't think that 3 rate cuts this year.
So according to Sky News, Bank of England's Governor Bailey says, I would caution against the view that the Bank of England would cut rates continually in successive meetings from here. So again, just to repeat that there on Sky News, Bank of England's Governor Bailey says, I would caution against the view that the Bank of England would cut rates continually in successive meetings from here.
Extra importance on tomorrow's jobs report. Right now, the consensus estimate is for an addition of 175,000 jobs after 206,000 jobs were recorded for the month of June. So put this all together, Young-Yu, and talk to us about how this fits in with the mindset in equity markets right now. We have this great rotation that is still kind of in play, even as the Russell 2000 is underperforming the big caps. But there's a hunt for weakness. People seem to be biased towards worrying about big cap tech names and whether the earnings they're releasing are justifying recent gains.
We do think that the market really is trying to sniff out weakness in areas anywhere it exists, really focusing on that weakness. We don't think momentum will build to the downside. So to the extent we do see mixed data or some weak data over the next few months before the Fed's rate cutting campaign kicks in, we do think it's going to be a campaign, by the way. We think that rate cutting is going to continue throughout 2025 as well. So we think that the big picture items are still relatively sound But the market, amid the uncertainty that we have, especially before the election, the market could get a little bit jittery here, especially given the run-up that we had last year and the first half of this year. So, the rotation we think is going to continue to happen, or at least the small caps and mid caps having a bit of a catch-up trade. But that could pause for a bit until the rate cuts get underway. We think that's a possible scenario as well.
Gotcha. By the way, we're looking at a live shot of the White House right now as we await President Biden to come out and make some remarks on the prisoner swap with Russia. We'll bring you there when he does come out to speak. But Young-Yu, I want to go back to you on the markets. You talked about how the catch-up trade in small caps is probably still intact. It still has some room to run, even if it does pause for now. Where are we in this rotation trade overall? Are we in the first inning? Are we in the ninth inning? Because I'm curious to get your take on how much distinction investors are making between different sectors within small caps.
Yeah, in the early stages, everything's going to rally, but we're possibly in the third or fourth inning, but it's going to depend on the extent of rate cuts. And we do have small cap earnings expected to accelerate by the end of the year and into next year. If that continues, the rotation or the catch-up trade, as we probably should say, is likely to continue well into 2025. And then there's a question of whether or not we get tariffs if former President Trump should win the White House. That could add a little bit more fuel to the fire.
Got it. All right, Young-Yu, really appreciate your joining us. Young-Yu Ma joining us, the Chief Investment Officer at BMO Wealth Management. Let's go now to the White House, where President Biden is delivering remarks. Let's listen in.
You got everybody? Well, good afternoon. And this is a very good afternoon. A very good afternoon. Today, we're bringing home Paul, Evan, Alsu, and Vladimir. 3 American citizens and 1 American green card holder. All 4 have been imprisoned unjustly in Russia. Paul for nearly 6 years. Vladimir since 2022. Evan since March of 2023. And Alsu since October of 2023. Russian authorities arrested them, convicted them in show trials, and sentenced them to long prison terms with absolutely no legitimate reason whatsoever, none. Paul, a former Marine, was in Russia for a wedding. Evan, a journalist with a Russian, in Russia, was in Russia, assigned by the Wall Street Journal. Alsu, also a journalist, was in Russia to see family. All 3 falsely accused of being spies. And Vladimir, who is a Russian citizen by birth and holds an American green card, is a Pulitzer Prize-winning journalist and was a pallbearer at my friend John McCain's funeral with me. He spoke out against Putin's regime, and for that he was convicted of treason. And now, their brutal ordeal is over, and they're free. Moments ago, the families and I were able to speak to them on the telephone from the Oval Office. They're out of Russia. Earlier today, they were flown to Turkey, and soon they'll be wheels up on their way home to see their families. This is an incredible relief for all the family members gathered here. It's a relief to the friends and colleagues all across the country who've been praying for this day for a long time. The deal that made this possible was a feat of diplomacy and friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request, and I personally thank them all again. And I've thanked them personally, and I'll thank them again. All told, Russia has released 16 prisoners. 8 Russians who are being held in the West will be sent home as well. These 16 prisoners from Russia that Russia has released include 4 Americans, 5 Germans, 7 Russian citizens who are political prisoners in their own country. One of those Russians runs a human rights organization, Memorial, which won a Nobel Prize in 2022. Putin threw him in prison for voicing opposition to the war in Ukraine. 4 others work with Alexei Navalny, a political opposition leader who died in Russian prison this year. Now they can live safely abroad and continue their work of advocating for democracy if they so choose. This deal would not have been made possible without our allies. Germany, Poland, Slovenia, Norway, and Turkey, they all stepped up, and they stood with us. They stood with us. And they made bold and brave decisions release prisoners being held in their countries who are justifiably being held, and provide logistical support to get the Americans home. So for anyone who questions whether allies matter, they do. They matter. And today is a powerful example of why it's vital to have friends in this world. Friends you can trust, work with, and depend upon, especially on matters of great consequence and sensitivity like this. Our alliances make our people safer, and we began to see that again today. Let me say this. It says a lot about the United States that we work relentlessly to free Americans who are unjustly held around the world. It also says a lot about us that this deal includes the release of Russian political prisoners. They stood up for democracy and human rights. Their own leaders threw them in prison. The United States helped secure their release as well. That's who we are in the United States. We stand for freedom, for liberty, for justice, not only for our own people, but for others as well. And that's why all Americans can take pride in what we've achieved today. I want to thank everyone in my administration who helped make this happen. Our work did not start just on day one. It started before day one. During the transition, I instructed our national security team to dig into all the cases of hostages being wrongfully detained, which were inherently, well, we inherited them from the prior administration. I wanted to make sure we hit the ground running, and we did. As of today, my administration has brought home over 70 Americans who were wrongfully detained and held hostage abroad, many since before I took office. Additionally, I issued an executive order in 2022 authorizing penalties like sanctions and travel bans on those who hold Americans against their will. And my State Department has introduced new warnings for Americans about the risk of being wrongfully detained by a foreign government. Deals like this one come with tough calls, and there are never any guarantees. But there's nothing that matters more to me than protecting Americans at home and abroad. And so we'll continue to work for the release of all wrongfully detained Americans around the world. Let me end where I began, with Paul, Evan, and also Vladimir and their families. They never gave up hope. We can't imagine what they've been through, all of you. Matter of fact, this lady right here, I think, was living in the Oval Office with us for a while. All kidding aside, can't imagine their joy right now. They're home. Tomorrow's a big day. The 13th birthday of Miriam. Miriam, where are you? Come here. You all know we have a tradition in the Biden family. We sing happy birthday on any birthday. You ready? All of you. Happy birthday to you. Happy birthday to you. Happy birthday, dear Miriam. Happy birthday to you. Remember, no serious guys till you're 30. God love you. She's Alsu's daughter. Now she gets to celebrate with her mom. That's what this is all about. Families able to be together again, like they should have been all along. So I want to thank you again to everyone who did their part. In just a few hours, we'll welcome home our fellow Americans. We're looking forward to that. God willing, we're going to be out at Andrews and get that done. So thank you, thank you, thank you, and this is a good day.
What did you say to them on the phone, sir? What did you say when they answered the phone on the other side?
I said, welcome almost home.
Countries, these so-called abductor states, from simply taking more Americans in order to get more of their prisoners home. How do you end these perverse incentives, sir?
Well, advising people not to go certain places. Tell them what's at risk, what's at stake.
Mr. President, where do you start these negotiations, and can you speak to the complexity of working with 6 countries to secure these releases?
Well, look, I'm not going to take the time now, but I'll do this later in the week. I particularly own a great sense of gratitude to the Chancellor. The demands they're making of me required me to get some significant concessions from Germany, which they originally concluded they could not do because of the person in question. But everybody stepped up. Poland stepped up. Slovenia stepped up. Turkey stepped up. And it matters to have relationships. It really does. These things matter. Pardon me?
Could this improve relations with Russia? Is there any avenue for that after this prisoner exchange deal?
As my sister might say, your lips to God's ears, man.
Did you speak with Vladimir Putin about this? Or would you be willing to speak with Putin now directly?
I don't need to speak with Putin. Anyway.
How did you weigh that decision of letting somebody out who sounds like got away with murder tonight?
I got home innocent people. Thank you. All right. Thanks, everybody.
President Joe Biden there at the White House making remarks on the prisoner swap that was announced today. An exchange of 24 prisoners. It is the largest since the Cold War era and includes U.S.
Bank of England's Pill says there will be bumps in the road on inflation ahead.
As well as Paul Whelan, a former U.S. Marine who was detained back in 2018. Let's bring in now Kelly Lyons, who is in Washington, to give us a little more context on this. And Kelly, we heard from President Biden that he was thanking allies. He said there were 6 countries involved. He actually gave a shout out to the German chancellor as well, saying it matters. Oh, you know what? Let's go back to President Biden at the White House. He's still speaking.
Help. It matters.
Mr. President, what did Germany ask for in response for their cooperation?
Nothing.
President
What did Chancellor Scholz say?
President Trump has said repeatedly that he could have gotten the hostages out without giving anything in exchange. What do you say to that? What do you say to President Trump now?
And Bank of England's Pill says we are not committing to further interest rate cuts.
Let's go back now to Kelly Lyons. Again, President Biden leaving the White House East Room as he finished making remarks on the prisoner swap, the largest since the Cold War era. 24 prisoners exchanged. Kelly Lyons, the Bloomberg Balance of Power co-host, who's been listening to the news conference as well. Kelly, a lot of those questions at the very end really touched on the relationship between the U.S. and Russia, but also the U.S. Ties with other countries that helped affect this prisoner swap. Can you give us a little more context on the countries that were involved and the level of diplomacy that required?
Well, as we just heard the president say, Scarlett, these were intense and very complicated negotiations with so many countries that needed to be at the table. This wasn't just about Russia and the United States, but other countries as well, which he did there mention by name: Germany, Poland, Slovenia, Turkey, and Norway, all involved in this. And he did, as you alluded to, shout out specifically the German Chancellor Olaf Scholz. We know, of course, that one of the key linchpins in this exchange happening was Vadim Krasikov, who was a Russian who was detained for a life sentence in Germany after killing a Chechen rebel former commander in Berlin in 2019. Vladimir Putin had been advocating for his release in particular for years now, going back to 2021. So convincing Germany to swap him for some of these other individuals was really critical. Of course, as we heard President Biden outline there, this was not just about American prisoners, although 4 of them were released today, including those journalists, also Kurmasheva, and, of course, Evan Gershkovich of the Wall Street Journal. But this also was about freeing some Russian political prisoners who had been advocating for what Biden described as human rights and democracy, which, of course, he says the United States holds very dear. And he said that really speaks to the efforts of the United States. But he really made this not about just this prisoner swap, but about the alliances that allowed it to happen. He said, and this is a quote, "If anyone questioned why allies matter, they do. They matter," talking about how deals like this come with tough calls and, of course, tough negotiations that a lot of countries had to be involved in. I would point out you did hear a question asked of the president when his remarks were finished, talking about criticism, the idea that swaps like this actually encourage Russia to take more prisoners hostage, essentially, in exchange for getting actual former Kremlin officials and others who have been, in the view of the West, properly incarcerated out. This is something that we heard the House Foreign Affairs Committee Chairman Michael McCaul talking about today. He said he remains concerned that continuing to trade innocent Americans for actual Russian criminals held in the U.S. and elsewhere sends a dangerous message to Putin. Of course, when President Biden was asked about that, he said that the way the U.S. is avoiding that is by encouraging people not to go to areas in which it may be dangerous.
Yeah, I liked how this turned into an impromptu news conference there. We didn't necessarily expect that. There was one thing that was thrown President Biden's way, and that was about a comment President Trump had made as well regarding prisoner exchange. Trump basically saying that under him, he would have gotten it done immediately after he won the election in November of 2024, but before he was inaugurated. And President Biden had a pretty good response to that.
Yeah, he basically said, why didn't he do it when he was president? It is worth noting that a lot of those that were detained today have been detained since the time that Donald Trump was in office. One exception is Paul Whelan, that former U.S. Marine who had been incarcerated. Of course, this is the second time we've seen a prisoner exchange of this magnitude done under this administration. The first, of course, being in 2022 when the WNBA star Brittany Griner was freed. They were not able to get Paul out at that time. And Biden has been talking for the last 2 years about wanting to get him, Evan, and others like him freed. And I would point out the president did say today, he said it in his statement as well that was released earlier, this notion that there are still Americans being wrongfully detained abroad, and he wants to continue to work to bring them home.
All right, good stuff. Thank you so much for the wrap up, Kelly. Kelly Lyons, Bloomberg Balance of Power co-host, and of course you can catch her in about 30 minutes time here on Bloomberg Television. Let's just return for a moment to the financial markets here, because we're bumping along the bottom here when it comes to equity markets. The Russell 2000, the underperformer, losing about 2.8%, with all 11 groups in the red, but certainly big caps are lower as well, and tech is pacing the decline. So everyone's giving back some of yesterday's gains. The 10-year yield, you can see there, coming down below 4%. Traders are now pricing in 3 rate cuts this year on the back of some weaker economic data, particularly when it comes to manufacturing, and that puts a larger focus on tomorrow's jobs report due out at 8:30 a.m. Now, of course, the big tech rally is showing signs of sputtering today, as we just showed you with the NASDAQ 100 ahead of earnings out of Apple and Amazon. So let's bring in Bloomberg Opinion's Dave Lee for a little bit more here. And Dave, of course, the focus when it comes to these big cap tech names is their spending on AI and whether it's paying off. And you wrote a recent column that talked about the AI commercials Google is airing right now during the Olympics, and how it's a really good metaphor for what investors are kind of wondering about as well.
Yes, I mean, this was an advert that showed a young girl planning to write a fan letter to an Olympic athlete, and rather than sitting there with her dad and writing it out like you'd imagine, a sort of nice exercise for parent and child, instead she turns to Google's Gemini bot and generates the letter to the athlete. And people were watching that thinking, really? Like, is that really what this is going to be used for? And the reason why I mentioned it in the column is that it could be a metaphor for the entire industry right now. You have investors wondering, all these billions of dollars in capex, which is growing quarter by quarter. Do we really know what people are going to use this for, and is it going to be worth that money? And what we're seeing, particularly in this quarter, and as I sort of mentioned in the column, there's not this sort of satisfying answer just yet. What investors are being told is, sit tight.
Yeah.
But in the meantime, we're going to keep on spending massively. And that's starting to make people, after the huge optimism earlier this year and late last year, people are starting to go, okay, well, when's this going to pay off for us?
Well, the believers say, this will require years of investment and it'll take years to pay off, but it's a long-term benefit. The issue is, what has made people sit up and say, we want to see a return today, or we want to see concrete evidence of something now in the second quarter of 2024?
Well, I mean, there are people that, as you say, there's a sort of long-termist view, but there was some expectation that some of these things were going to start to pay off a bit sooner. So you look at a company like Microsoft, their stock dropped when they announced their earnings earlier in the week, and that's because the cloud growth wasn't quite as big as people thought it was going to be. Now, the issue Microsoft has is sort of showing people that AI is going to be a driver of companies investing more in the cloud. This quarter, they said around 8% of their growth of their Azure cloud unit could be directly attributed to AI. Mm-hmm. That's up from 7% the quarter before. So it is growing, but it's getting slower. What some of the other companies have done, and we saw Meta do this as well, is sort of say, well, look over here at this one thing that is working and ignore the spending over here. So in Meta's case, their advertising unit up 22% year on year. They said much of that was down to AI powering better recommendations for advertising. And that was great for investors, which is why Meta's stock performed much better than Microsoft, because they believed it. They believed that AI was going to help in the short term with advertising.
Or they framed it better. Meta framed it better in terms of it giving an answer that investors wanted to hear. Here is what AI has done for us. But their advertising business was going to do well regardless. I mean, this is an election year, and also you've got a lot of spending on the Olympics.
Yes, exactly. That's always I feel that's a big question here, because Meta has always been an advertising business. Did it need to spend billions of dollars in CapEx in order to continue being a successful advertising business? I mean, possibly not. I mean, in the future, and Mark Zuckerberg talked about this with investors, he said they hope that eventually companies will be able to just describe what they want to achieve with advertising, and AI will do that for them. And then, yes, in years' time, their assistant would be useful for all sorts of things, and AI would bring these sort of long-awaited benefits. But even Mark Zuckerberg, who is one of the biggest optimists on AI in Silicon Valley, was very cautious to say, yes, we're getting some benefits now, but really the payoff will be years. And he reiterated something he said before, which is, Meta's investors have wondered about things paying off before. Yeah. And he says they've always come good, which is a fair thing. They have always kind of come good on that. So he's kind of trying to play both ends here.
Of course, we're going to get earnings from Apple and Amazon. We'll be speaking with an analyst in greater detail about what those numbers might show, but I'm guessing it'll be more of, just be patient, it will come, especially when it comes to Apple's newest iPhone that will be AI enabled. The one company that has seen a flow through to its top line and bottom line is NVIDIA. But that company doesn't report earnings until late August. So we have this long, barren period in which we're just kind of wondering whether we're going to get more concrete evidence that AI is paying off. How do you see this playing out?
Well, I think NVIDIA might end up being the kind of canary in the coal mine of this entire industry, because it's at NVIDIA where the journey to invest in AI begins. People go to NVIDIA and they buy the chips to start training their models, to start running their models when they're ready. So they've been the biggest beneficiary and the earliest beneficiary, but they might end up also being the company that sort of we see suffering, if you like, at an earlier point to some of these other companies. Because every analyst I talk to, they all say, well, the demand's got to tail off at some point. We just don't know when it's going to be. And that's going to be the telling point for NVIDIA,
All right, so watch NVIDIA's earnings August 28th, I believe. Dave Lee, Bloomberg opinion writer Dave Lee, thank you so much for joining, and we'll check in with you later when those companies do report their results. Now, coming up on Bloomberg Markets, let's get into the weeds and look at Apple and Amazon earnings with Laura Martin from Needham. She's going to give us her take on what she's looking for from those companies. This is Bloomberg.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Scarlett Fu. We have the NASDAQ 100 currently at session lows, and within that index, 85 stocks are in the red. So 85% of the members are declining. So a broad retreat here. And of course, Apple, one of the biggest losers, which makes sense given that it's part of the group of companies, the mega cap techs, that are under a little bit of suspicion over whether their investments in AI will pay off. Because after the bell, Apple does report its latest earnings. The stakes are high. It has reported a drop in sales in 5 of the last 6 quarters. Now, for the second quarter, the quarter that just ended, analysts are anticipating a recovery in sales, a gain of 3%. And they're also anticipating details about the Apple Intelligence features that will be included in the latest iPhone. Needham senior analyst Laura Martin, that is, has a buy rating on Apple and joins us now. So, Laura, 3% revenue growth does not sound amazing. What is helping it recover, given that so many people are holding off on buying iPhones, particularly in China, and waiting to hear more details about the iPhone 16 when it does come out?
Right. So I think this stock has gotten much more interesting as a debate topic because you're exactly right. The big issue that's being debated on Wall Street is whether the generative AI features they promised are going to be in the iPhone 16, which gets released next month, or whether we have to wait a year. And if those AI features are enough to drive an iPhone replacement cycle starting this year, or whether people wait. I happen to think it's going to take another year, but their stock has been running on the fact that they think there'll be enough generative AI like efficiencies and tools and features in the current iPhone, the 16, which will be released in September, that people will start replacing their iPhones now. Because of their total revenue of $84 billion in the quarter that we're expecting for this the June quarter, half of that is iPhones. So the iPhone is the only product big enough to actually move the growth rate of Apple from 3% to 4 to 5. Nothing else is big enough by itself, no other product, to move the actual entire revenue growth rate of Apple.
Yeah, it's astounding because products brings in $60 billion on the top line. Services brings in $24 billion. So it's a fraction of products, which, is really the iPhone when it comes down to it. What is Apple doing when it comes to services in the lead up to the rollout of Apple Intelligence? I mean, it's certainly helping to boost margins a bit.
Yeah, because we're looking at 14% growth for services at a 75% margin. So it really helps there. And therefore, that should drive about 100 basis points of margin expansion for the enterprise. So services are really powerful. What they're doing is they're bundling more services together to give you a discount. They're doing family plans. So it's really hard for anybody in your family to exit or to use a Google or an Android phone, actually. So they're doing more and more things to try to lock you into that iPhone ecosystem and then sell you more and more services and products like the Apple Card or Apple Pay, or they're trying to really load you up with services because they have such a high margin for Apple.
Okay, let's shift gears over to Amazon, which I know that you're more excited about. Just on the top line alone, we're anticipating 11% sales growth for the quarter that just ended. A big part of this will be Amazon Web Services, but based on what we heard from Alphabet and from Microsoft, how much optimism can you really fold into what we're going to get from AWS and how much it's monetizing off those AI investments?
Right, so this is the big question we need answered tonight, because Google or Alphabet, when they said they're going to have all this CapEx, the stock was down 3% after a really solid earnings report for the June quarter. Yesterday, Meta said the same thing. They're raising their CapEx guidance. It's going to be up more next year, but the stock's up today. So what we need to see is when Amazon comes out and says they're going to spend a ton more money on building AI infrastructure, we need to see what the stock does, whether investors are giving these companies a pass when they invest in Gen AI, or whether they're going to be mad that their earnings is going to have a headwind because they're investing so billions, tens of billions of dollars in these data centers for generative AI. And I'm really looking for advertising too. We want advertising to grow here at 20% because we think it has 70% margins over at Amazon. So that's a big, important number to us also.
70% margins is pretty incredible. What about the retail business? I don't expect that the margins in retail is as juicy as what we saw in the other parts in advertising, but certainly it's a part of the business that Amazon's focused a lot on making more efficient, and it's starting to pay off, isn't it?
Yes, we're looking for 300 basis points of margin expansion to about 9% operating margins. And cleverly, when they added all those ads to your Amazon Prime Video, they're actually tying those ads to purchases, which means they're getting more purchases. And remember, we had a Prime Day. So I think that we're going to get better e-commerce numbers and maybe at higher margins, thanks to the flywheel of having all of these connected television ad units from Prime Video driving more e-commerce sales on Amazon.
Yeah, it's a tale of ecosystems, whether it's over at Apple or whether it's over at Amazon. Laura, always appreciate your speaking with us. Laura Martin of Needham joining us for a preview there of Apple and Amazon earnings. Coming up, we're going to talk about real estate, why Greg Friedman, whose firm owns more than $6 billion in real estate, says the sector is shifting to normalization. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
DOJ or other authorities
could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
I read a statistic today that Jan Freitag put out that luxury had a 9% demand growth in the month of June. The economy end of the hotel segment, I think, was about a 2% drop. So we're in the right sector.
That was Trinity's Sean Hare explaining how luxury real estate continues to remain strong as we see cracks in other areas of commercial real estate. I'm pleased to say Greg Friedman is joining us. He is managing principal and CEO of Peachtree Group, which owns more than $6 billion in properties, and of course our very own Abigail Doolittle as well. So Greg, thank you so much for coming in. I know that you're visiting from Atlanta, and we'll get to some of your real estate portfolio and what's in there, and much of it in hospitality. But I wanted to just get your state of play on what Peachtree sees in your home base of Atlanta right now.
Yeah, I mean, I think Atlanta's a thriving city, so it's still doing well. But as it relates to commercial real estate, it's definitely a challenge. I think Atlanta represents the U.S. When you look at commercial real estate, it's a very challenging time across the board. And a lot of that challenge, you have the challenge in the office sector, which is really more secular distress. And then you have this balance sheet stress that everyone's dealing with, that's related to just interest costs being so much higher than what it was going back a couple of years ago.
So let's talk about that balance sheet stress, because of course, relative to Peachtree Group, you have about $6 billion worth of real estate, 70% on the credit side. So you really get to see the plumbing of the system. Josh Zegan of Madison Realty Capital joined us not so long ago and said it looks really, really bearish. The folks that we've talked to who are closer to the banks, closer to the financing, thinks that the commercial real estate playbook in terms of this cycle worse for longer as opposed to just the equity side. You happen to see both. So where are we, what inning, how bad is it? How long is it going to take to come out of this?
Yeah, so I think unfortunately, I think it's going to take a couple of years to come out of what's happening right now. We're going through a very sluggish cycle for commercial real estate. It's been that way the last couple of years, and values have come down dramatically across the commercial real estate ecosystem. There's been some stabilization of values over the last 6 months, just given there's still a lot of capital chasing commercial real estate, but the reality is there's a lot of challenges ahead because we've entered this new rate reset that's really impacted real estate values long term. So we went from a decade pre-2022 where we had 0% interest rates and cap rates were much more compressed than what we're seeing today, and where cap rates are probably going to settle out long term.
So before talking about the equity side and specifically hotels, in terms of what Sean Hare was talking about, on the credit side, during the pandemic, you were one of the biggest buyers of loans out there. Are you still buying, and is it easy to get these deals done?
Yeah, I mean, we're still buying debt as we speak. We're very aggressive during the great financial crisis. We bought a bunch of loans. We bought over 50 loans from banks. We bought a bunch of debt during the pandemic. We bought over 180 loans, and we expect that later this year there's going to be an opportunity to buy a lot more paper. We bought about a dozen loans since the end of last year till now. And it's, a lot of banks, as you've probably read, a lot of the regional banks, community banks, even some of the national banks, they have some challenges across their real estate book, on their loans on real estate, and that's causing them to look at selling that paper.
Can you be a little more specific about what kinds of deals you can get out there or are available to you? If you were to buy an office building, for instance, in Buckhead, what kind of discount would you be able to get?
Yeah, I mean, if you're buying an office building, it really depends on the location. It's even in Buckhead, there's different submarkets, different locations. There's, if you're in the building we're located in, it's probably not trading at a huge discount because it's very well located. It's got great amenities. If you're buying an office building that's on the wrong corner, I mean, the discounts could be 50 to 70%, depending on what's the tenants that are in place and when those tenants are leaving that building potentially.
So we would be remiss if we didn't ask you about hospitality, because of course that is the bulk of your equity portfolio. Sean last week telling us that luxury is doing well, but low end, you're right in the middle. What are you seeing, and what does it say about the consumer? Are we seeing a bifurcation that we're seeing everywhere else for consumers?
Yeah, I think, without question, we're seeing that bifurcation today, where you've got the consumers that unfortunately, I would say the consumers that are focused more on the luxury segment, that have a lot of liquidity, they're continuing to travel and spend money. But on the lower side, when you look at just, they're challenged by just the higher interest expense as well as inflation. That's really impacting their ability to continue to spend dollars. So you have seen some pullback in travel. You've seen pullback in them spending money elsewhere in the economy as well. The segment that we're focused on is the mid scale segment within lodging. So it's typically like Hampton Inns, Hilton Garden Inns, Marriott Courtyards, and so forth. They continue to do well. We continue to have positive RevPAR growth across our portfolio. So our revenues per available rooms are still growing, but it's lower single digits. So we're not seeing what Sean's seeing on the higher single digit range.
All right, really appreciate your joining us. Coming in today, Peachtree CEO Greg Friedman, and of course Bloomberg's Abigail Doolittle, who has specialized in real estate day for us. In the meantime, let's just get you a quick check on where things stand with equities. We were at session lows for the S&P and the NASDAQ, and certainly for the Russell 2000 as well. You can see there a decline of 1.2%, with most of the stocks in the S&P 500 lower, 357 decliners, 146 advancers. This comes as we await earnings from Apple and Amazon after the market closes, and of course, before the big jobs report tomorrow at 8:30 a.m. Right now, investors are factoring in 3 full rate cuts for 2024. More Bloomberg just ahead.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
They are free. Alsu, Evan, Paul, and Vladimir. Welcome to the fastest show in politics. Americans released as part of the biggest prisoner swap with Russia since the Cold War, happening today. In fact, it broke just last hour here on Bloomberg. I'm Joe Matthew alongside Kayleigh Lines in Washington, D.C. Kayleigh, some emotional moments as Joe Biden announced the swap from the White House with family members of the prisoners at his side.
Yeah, emotional indeed. At one point, joined by the daughter of Alsu Kurmasheva, who is turning 13 tomorrow, Miriam. He sung happy birthday to her. And what a birthday to have your mom come home after
Can't imagine.
months imprisoned in Russia, over a year even.
Alsu's case in particular has been one that we've talked about a lot because her husband, Pavel, and her other daughter, Bibi, spent time with us here on the broadcast. Pavel has spoken with us a couple of times. Kayleigh, the last time we sat down, the four of us, was the same day that she was convicted. And they couldn't have imagined that we would be talking about this today.
Yeah, and of course, as we heard President Biden outlined, it took a lot of statecraft and tough negotiations involving many countries. This was not just the U.S. and Russia, but Poland, Slovenia, Norway, Turkey, Germany, all involved here. And of course, the German Chancellor Olaf Scholz receiving a specific shout out from President Biden when he was answering questions after.
Of course, someone who's had a strained relationship with Donald Trump And the former president did come up in reporters' questions about this because, of course, he said he could accomplish this in a day. Joe Biden responding, why didn't he do it when he was president? We're going to put together this story, of course, and all the latest from the campaign trail. We have a lot to cover over the next hour here on Bloomberg.
Indeed. We'll be joined by Bloomberg's Josh Wingrove, his White House correspondent, from us in just a moment. But first, of course, we got to start with a check on the markets, too. Charlie Pellet has that for us.
Right now, we are looking at a lot of red on the screen with the Dow, the S&P, NASDAQ bouncing off the bottom, but very close to session lows. Right to the numbers with the Dow Jones Industrial Average now trading down 548 points. That is a drop of 1.3%. S&P 500 index a day after the Fed down 68, drop right now of 1.2%. And NASDAQ is down 333 points for the NASDAQ Composite Index, a drop now of 1.9%. The NASDAQ 100 index down 2%, and the Russell 2000 even harder hit right now, that index down by roughly 3.1%. The 10-year below 4%, 10-year yield right now at 3.98%, the 2-year 4.19%, gold down $5 the ounce, down 0.2%, 24.42, and West Texas Intermediate crude down 0.9%, 77.21 a barrel on WTI. Stocks getting hit as bonds rallied after weak economic data this morning spurred concern that the Fed is waiting too long to start cutting rates. Earnings news, lots of reports. Meta Platforms up 5.1% right now. We've got Meta trading higher by $24. Apple will be reporting after the close of trading today. Apple down 1.5%, 218.70 right now on Apple. Amazon also reporting after the close of trading, down 1%. And Intel, right now we've got Intel lower by just about down by now by 4.5%. Some of the other companies we're keeping an eye on after earnings: Shake Shack shares surging. We've got Shake Shack up now by 16.1%, and burger rival Wendy's down now by 1.4%. So again, recapping here, the Dow, the S&P, NASDAQ all lower. S&P down 77, a drop right now of 1.3%. That 10-year bears repeating 3.98%. Balance of Power continues now. Back we go to Washington, and once again, your hosts, here they are, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lines alongside Joe Matthew here in Washington. Welcome to Balance of Power on Bloomberg TV and radio, where we woke up to some pretty incredible news this morning. The release of 4 Americans in a prisoner swap with Russia. 2 journalists, of course, included Evan Gershkovich and also Kurmasheva, who have been imprisoned in Russia for some time now. We heard President Biden speaking about this at the White House just in the last hour.
This deal would not have been made possible without our allies. Germany, Poland, Slovenia, Norway, and Turkey, they all stepped up. The deal that made this possible was a feat of diplomacy and friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request, and I personally thank them all again.
Joe Biden speaking from the White House a short time ago in remarks that we brought you live here on Bloomberg TV and radio. As we mentioned a short time ago, he was joined by family members of the prisoners being released. And glad to say we're joined here at the desk today by Bloomberg White House correspondent Josh Wingrove. Josh, we understand that this was of remarkable scale. 24 people, about a half dozen countries, the president speaking to the benefits of allies, of having friends around the world. How did he put this together?
This looks like it was weeks in the making, Joe. Biden feels strongly about this one. He arguably kind of deviates a little bit from mean with his predecessors on the priority of just simply bringing people home, and was happy to be up there today announcing it. This involved pressure campaigns, or at least pleas to the German chancellor in particular, but as well as other leaders, to put together this ordeal that they've announced today. We'll hear more details in the coming couple of hours here as well from the White House. But it's being celebrated as a big day. Paul Whelan in particular had been there for years and had been sort of the one that got away in previous deals that Biden had made, and had to make the tough call back then about whether to, take what they could then and try to get a deal later for Whelan. That's right. Yeah. And then, of course, Evan Gershkovich had been there as well, and pretty high-profile case, particularly, of course, among all of us in the press. So this is a bit of fraught ordeal. You can only imagine the relief all the families feel, and details still coming out.
Yeah, certainly an emotional day as those families were flanking Biden when he gave this first speech that turned into a bit of a impromptu news conference. He was asked at one point about remarks that former President Trump has made, that he would have been able to get a better deal, that he could have done this in one day. The president's response was a pretty short, why didn't he do it when he was president? And it is worth pointing out, Paul Whelan in particular has been in Russia incarcerated since 2018.
Yeah, that's right. And Trump has been saying on the campaign trail that Gershkovich would come out, almost a gift to Trump, or at least like Putin would be scared of what Trump would do, would let him out. It's been a lot of rhetoric on this file. Some of the reporting is that Biden had been working on this, including on the very day that he announced that he would not run again. Just to give you a sense of the sort of priority that he was putting on this, on a day when he was making arguably the most consequential decision of his political life, he was also working the phones to put together this deal. So just a very big moment for him. And Biden has, in the past, brushed aside the concerns from national security experts who raised the sort of question of whether trades like these create an incentive for more Americans to be grabbed. Yes. You heard Biden allude to that a little bit today, saying the travel advisories are how they hope that fewer Americans go to places where that could be the case, including Russia. But it's a delicate issue. But if you go up to the think tanks, not so many blocks from here, that's the tension in this community of what you're willing to pay and how you balance getting people home with creating or managing the risk that bad actors will simply grab more Americans as bargaining chips.
Well, there's a lot to talk about here about the political implications of this, questions about whether it would have happened if Joe Biden had not stepped down. That's the direction the Trump campaign is taking, that just the impression of a potential Trump presidency was enough for Putin to let these guys go. Is there a lasting effect for Democrats or for just Joe Biden alone?
I think this is exactly the kind of stuff that Biden wants to do with his last 6 months. And it's not clear whether him not being on the campaign trail gave him the elbow room to sort of get this done, seal the deal. Time will tell, I suppose. But this is the kind of thing that he wants to do to drive contrast. And he's always said to Kamala Harris, I'll do whatever you want to do. Well, so far that's been kind of staying a little bit out of the limelight, being president in the Oval, but not necessarily in front of a lot of TV cameras. That could always change. But Harris has really been the one out there touring. So I think Biden will drive Trump contrast wherever he can, and certainly we'll see that there. But I don't want to leave the impression that I'm saying that was his guiding light on this. Joe Biden believes in his bones about this stuff, and he really dislikes what I alluded to earlier, the conversations about the other side of the coin or the potential trade-offs. He doesn't see it that way. He thinks that whatever the price to bring an American home is the price you pay. Just
while we're talking about Vice President Harris, do we know what role she played in all of this? If she was in the room for these negotiations, how was she involved? There's some reporting that she was involved in particular with the talks with the German Chancellor at the Munich Security Conference, if memory is serving me. They're, of course, trying to bolster her foreign affairs cred as she sort of steps into the mantle of Democratic standard bearer. So it looks like it was a sort of full court press, other top Biden officials involved with it as well. The VP, I think, will claim rightfully some credit from this, or at least get some credit from this. But it was these kind of things are just complicated. They take months to put together. So I don't think I think if Joe Biden himself were sitting here, he said no one person gets all the credit, including himself. But this is it's a big day, and again, those families just must be feeling such relief, including the 13-year-old girl who also had to balance the embarrassment of being. So I remember being 13. That's a tough moment. A tough moment. There were
it was
a lot
sweet
of emotions
moment.
she was feeling.
That's right. Yeah, that's right. A lot of things going through her head.
Watching, try that.
Yeah.
Spending time with Josh Wingrove, Bloomberg White House correspondent, who of course always has his eyes on the campaign trail, and some important reporting that you've had on the vetting for a running mate. This is all we're going to talk about for the next couple of days, save a wonderful story like this. I won't press you on a timing for an announcement. Everyone's got a take on this, but some actual meetings are taking place now, we've understood, including one with the governor of Pennsylvania. A lot of folks think he's already got the job.
Certainly, we expect an announcement in the coming days. I mean, she has said she's going to start a tour with her pick Tuesday.
Yeah.
So
And where are they
doing that?
Starting in Philly.
Interesting.
So, yes. However, I will note that previous picks have launched in states that aren't their own. So there are people that are downplaying the tea leaf reading. There's one big tea leaf here, right? You know, will the home state governor be there for the launch of her VP tour on Tuesday? Now, our reporting is that Josh Shapiro, the Pennsylvania governor, is one of the top tier candidates and met yesterday, not clear whether virtually or not, with members of the Harris team as opposed to the vice president herself. This is both a milestone, but also being cast as part of the process. The other two are Minnesota Governor Tim Walz and Arizona Senator Mark Kelly. That our reporting is that they are sort of the top tier, or at least have been the top tier. So right now, it looks like this is proceeding apace. Harris has said as recently as Tuesday that she hasn't made a decision. Of course, she was on the road yesterday, gave a speech in Texas responding to Donald Trump at a black sorority of all places, given the day that Donald Trump had yesterday. And so, you know, it's not clear that she's like done face-to-face interviews. I can't imagine how they would have pulled that off in the last 24 hours, but interviews are progressing. Certainly Shapiro seems to be the top of the ticket. Here are the cases for all three. For Shapiro, it's more or less delivering Pennsylvania, arguably the most important of all the swing states, but also strong on the stump as well, strong a record as a governor. Walz, similarly, governor, a bit more of a fan, or a bit more popular among progressives, has done a lot of things there that Democrats wish would happen federally, things like, you know, school lunches and sort of kitchen table type progressive movements. He also is pretty skilled on TV in a way. He's kind of talked himself into the top tier a little bit. Senator Kelly, of course, bipartisan appeal, comes from a swing state himself, just like Shapiro, and in particular on the border, which is a weakness for Kamala Harris, that she's going on the offense on in the last couple of days, trying to hit Trump over killing that border bill, which of course he did. That would signal an emphasis that she wants to fight back on the border as well. So that's the issue. The Senate seats are tough to give up. That's definitely, as we ask,
especially what people in the battleground.
Yeah, exactly. So that has to be part of the calculus, I think, a little bit. But I think we'll know. We certainly will know before Tuesday. I hope my phone isn't blowing up as I say this, and that I'm missing something right now. But I don't.
I'm checking. No red.
I see no headlines, Josh.
Right,
I think we're good for now.
Right.
Will we have a full weekend? Jury's probably out. On
what
that
is a
one.
full weekend anymore, Kelly?
There is no such
It's
thing.
been
Wild
a while
summer.
since
Not
we've
in
experienced
July.
that. Josh Wingrove, Bloomberg White House
Thank you.
correspondent, working through the weekends all the time for us here at Bloomberg. We appreciate it. And of course, working for us all the time as well, our Bloomberg Politics contributors, Rick Davis and Jeannie Shanzano, who are with us now. So, Rick, we just heard Josh outlining there that our reporting indicates Kamala Harris has got this list down to 3 people. You've been part of this process. How hard is it to go from 3 to 1 to the final selection, and to do so in the span of really less than 2 weeks we're talking here?
Yeah, I think that's actually the hardest process. And it's not always 3. Sometimes it's 4 and sometimes it's 6. But going from like 25 to 12 is the easiest. 12 to the smaller number is usually kind of the next iteration. And that's hard, right? Because that's a lot of data and information. But this is really about the relationship at this stage between the potential vice presidential choice and the candidate herself. And that requires some, direct conversations, whether that's a telephone call or a series of meetings. It can vary depending upon how much time you have. Kamala Harris does not have a lot of time. If you believe what they're trying to accomplish is a rollout between Monday, Tuesday, but by Wednesday in order to be able to be nominated telephonically, then they're right against the wall now. And so my guess is speeches are being written for whoever the ultimate nominee is. These conversations are critical to sort of rounding it down.
So we're shortly expecting the results from the Fed reverse repo operation.
Are eminently qualified to be on the ticket, and so I think the personal dynamic is probably the key differentiator at this stage.
Got some new polling here from Republican pollster Public Opinion Strategies, Jeannie, conducted for the Competitiveness Coalition. Pennsylvania, Harris at 48%, Trump at 45%. In fact, she's looking pretty good in Wisconsin. She's beating Trump by 5 in Arizona, 48 to 43. Maybe the states, maybe geography has nothing to do with this, and maybe to Rick's point, this is all about chemistry. Is that what we should be looking for?
You know, I think it's a combination of both. Nobody knows better than Kamala Harris.
66 counterparties take $348.885 billion at the Fed Reverse Repo operation.
Who she has chemistry with, can work with, and is loyal to her. She was loyal to Joe Biden, and look where she is now. So that's going to be important. But the states are arguably important. And, you know, as we look at these states, you know, the idea that she would go outside of some of these really key states, I think if she doesn't do as well in the end as she wants to and win, people would blame her for that choice. So it's an important pick. And so I think she is going to stick with the list that you're reporting on and that everybody has said are these top tier candidates who, as Josh was just saying, all bring some really positive things to her, whether they are states, whether they're chemistry, whether they're the ability to go on the media, to take the case to Trump. There's a whole host of things that these candidates bring for her.
Jeannie, we just have a minute left, but something else we were discussing with Josh is the involvement of the vice president in these negotiations, this prisoner swap with Russia we saw take place today. Do any of these individuals help burnish Harris tickets, foreign policy credentials, national security questions?
Yeah, I think they will. I don't think it's going to be a huge issue in the campaign, but I think definitely the fact that she is in the room, so to speak, the fact that she has a part of this, and this is a big win for the Biden administration, of which she is a part. All of those things will matter to voters.
Jeannie Sheehan Zaino and Rick Davis, our signature panel, in place on a breaking news Thursday with the prisoner swap being made official that Kaylee's referring to just in the last hour from the White House. 4 Americans, including Evan Gershkovich, set free today, which we'll be talking more about as we make our way forward, and certainly as well on the campaign trail. Kaylee, there's been a heck of a lot of news. And after Donald Trump's visit to the NABJ yesterday, Kamala Harris had a chance to speak. He doubled down, and so did J.D. Vance. We'll get into that coming up with the panel.
Yeah, questions of racial identity not escapable right now if you're the Trump-Vance campaign. And of course, we'll look to see how Kamala Harris herself handles this going forward. She talked about divisiveness yesterday. We'll have more ahead with our political panel right here on Bloomberg TV and radio.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
Culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
Inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the day once again on the Dow, the S&P, and NASDAQ. The selling is intensifying with the S&P now down 1.5%, falling 84 points. The Dow is down 619, a drop there of 1.5%. NASDAQ is now down 2.3%, declining by 412 points, while the NASDAQ 100 index is down 2.5%. The Russell 2000 lower by 3.4%, broad-based selling here. 10-year below 4%, with the 10-year now yielding 3.97%. The 2-year 4.18%. Gold down 0.3%, 24.30 the ounce, and West Texas Intermediate crude now lower by 1.2%, 76.99 for a barrel of WTI. Stocks getting hit as bonds rallied after weak economic data spurred concern that the Fed is waiting too long to start cutting interest rates. Earnings news, we heard from Shake Shack this morning, and Shake Shack shares, they're up 16%. Wendy's down now by 1.8%. Again, recapping, stocks lower across the board. The Dow, the S&P, NASDAQ all in the red. S&P down by 1.5%. Apple and Amazon, of course, after the close of trading. Balance of Power continues now. Back we go to Washington. And once again, your hosts, here they are, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at where things stand in the trading day as of 1:23 p.m. Eastern time. Thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, where nearly 24 hours ago, we were all captivated watching the screen as Donald Trump took part in a mediated conversation at the National Association of Black Journalists Conference in Chicago and made a few remarks that stood out. But of course, let's remind you of the big one.
I've known her a long time indirectly, not directly very much, and she was always of Indian heritage, and she was only promoting Indian heritage. I didn't know she was black until a number of years ago when she happened to turn black, and now she wants to be known as black. So I don't know, is she Indian or is she black?
That was yesterday, and we had a conversation a short time later with the congressman from Missouri, Emanuel Cleaver, a Democrat, of course, who was once chair of the Congressional Black Caucus. His reaction.
We are in a really awful situation. I mean, what the president said, and I don't think he gets it, and I hope somebody close to him will explain it. It was offensive, it was racially raunchy, and it was not becoming of a head of state.
Move forward a couple of hours, and Donald Trump doubles down on Truth Social. Quote, crazy Kamala is saying she's Indian, not black. This is a big deal. Stone cold phony, unquote. J.D. Vance, his running mate, on the stump last night, referring to Kamala Harris as a phony, having a chameleon-like nature. And so there are many questions about where this rhetoric is going and exactly how Kamala Harris should respond to it, what it means about the political discourse in this country. And we're joined right now by a Democratic member of Congress from the important swing state of Wisconsin. Gwen Moore is with us from
VIX hit session highs, last up 2.39 points at 18.75.
TV and radio. What do you make of this conversation in 2024?
Well, thanks for having me. You know, I think, to be fair to Donald Trump, with the black journalists, it was a hard crowd. And to be fair to the journalists, They had a very hard respondent. I think Donald Trump, we have to give him credit for really hitting all of his messaging points to keep people in fear of losing their jobs because of, the immigrants are overrunning the border and taking black jobs, and that they are overrunning the borders, that they're criminals and rapists, that they're killing people. A real exaggeration. And I wish this fact check in real time had been the journalist interrupting him, because people believe that. And I think fear and xenophobia and a fear of white people being overrun by others. He was able to stay on message despite the very tough crowd that he was talking with, and of course the black journalists themselves were scratching their heads, wondering why they had even invited him. So,
certainly,
I don't think it changed anybody's minds either way.
Well, certainly, Congresswoman, we saw things get combative a few times, specifically with Rachel Scott of ABC, who did try to fact check the former president at multiple times throughout the conversation. And it actually did seem that what set the whole thing off was her introductory question, in which she repeated a number of statements around black individuals, black journalists that Donald Trump had made, and asked him essentially why someone considering, a black voter considering whether or not to cast that vote for him in November should make of that kind of rhetoric. What would you tell a black voter considering whether or not to vote for Donald Trump or instead to choose Kamala Harris?
Well, what the black journalists were trying to demonstrate. Just listen to what he says. It has me scratching my heads as to why any black person would vote for him, except for those people who are exceptionally wealthy, or except for those rappers and so on who expect to be pardoned. But it's a curiosity. It's a curiosity why he even accepted the invitation to come. You have to give him credit for showing up for that very tough crowd. But again, I don't think anybody's minds were changed, and I think black voters who saw it probably that increased their resolve to vote for Kamala Harris.
I'm struck by your approach here, Congresswoman. I'm trying to follow what you're saying as closely as I can. I don't know if this is a little bit of reverse psychology, but are you giving Donald Trump credit for having continuity in being racist?
Yeah, absolutely. I think that he sounded like a true believer that Mexicans and other people, criminals, were overrunning the border and taking black jobs. I doubt that they were taking any of the black journalists' jobs that were sitting in that room. But he did have a huge platform for scaring other black people who may be marginalized and inappropriately blame people who crossed the border. I mean, he had message discipline. He never got off of his big hits. He even when he said that Kamala, he didn't realize she was black until recently. She was pretending to not be black. Even then, he was sort of appealing to some segment of the black community who may not feel like she's black enough, even though she went to Howard University, had a black father. She joined the first black sorority installed in the United States. People, some black people who might have some very nationalistic views about what a black person ought to look like and be like and sound like. So he stuck with the grievance message. He stuck with the
U.S. crude futures fall by $1 a barrel to $76.91.
Message, and that unfortunately has appeal to some people. I do think he was talking to his supporters. His supporters might have been gleeful about him pushing back against these black women and talking over them. Yeah. And I'm sure that they were very pleased with his performance.
Okay, so that's Donald Trump's message, Congresswoman. I also would like to ask you about The message the vice president could be bringing next week when she's planning to visit your home state of Wisconsin alongside her vice presidential pick, whomever that may be. What message wins Wisconsin for her? And is there a vice presidential pick that you think would be most likely to aid her in that effort in Wisconsin?
You know, I think Wisconsin is very willing and able statewide to elect a Democrat to the presidency. I think that we have had enough of Donald Trump, and even the Republicans, and we have seen the performance in so-called Republican areas improve for Democrats statewide. So I do think that Kamala, with whomever she picks, is going to be welcomed in Wisconsin. You know, there's a lot of talk back and forth about who she ought to pick. I hope she picks someone with whom she has a good rapport, someone that she trusts, somebody that shares her vision. And I think there are a lot of great candidates of whom we've heard discussed over the networks in the past few days. I think any one of them would be very welcomed in Wisconsin.
All right. Well, we should find out within the next few days. Congresswoman, thank you so much for joining us here on Bloomberg TV and radio. We always appreciate your time. That is Congresswoman Gwen Moore of Wisconsin. Thank you. And let's turn back now in our final moments with our political panel. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, are still with us. So, Jeannie, I would love to just get your reaction to what we just heard from Congresswoman Moore. This idea that Donald Trump may have been racist yesterday, but at least he was consistent and disciplined about that message. What do you think?
Yeah, I was surprised to hear that. I think, my impression, and I would assume the representative might agree with this, is it was the old Donald Trump we've all gotten used to. There was nothing new there. He's struggling in the polls. He's struggling to find a way to go after the Democrats and Kamala Harris in particular. And he needed to get the news back on him. And so he did his typical, whether it's birtherism or attacking somebody, he did that yesterday. And so there was nothing new. In fact, Kaylee, I kept thinking, I think the Democrats should adopt a new slogan, which is, it's not 2016 anymore. This is old. We need something new from him, and they're not getting it. So that was my take on it.
Rick, I mentioned what Donald Trump posted on Truth Social after he made the remarks at the NABJ. Crazy Kamala saying she's Indian, not black. This is a big deal, stone cold phony. Is this the path to losing the election?
Look, I know there are a lot of Republicans. John Thune mentioned this. These are inappropriate comments, and that we ought to be talking about the issues that Republicans have an advantage on, the economy, the border, and why he would go on a show like that, which would be seen by a lot of black voters and be disparaging of someone's, ethnic background, regardless of how you call it, is phenomenal to me. And of course, he uses the same trope that, well, I barely know her, except that he wrote a campaign contribution to her when she was a Democrat as a black candidate. And so I think he knows a lot more than he leads on. And so, I think the Republican Party would rather him be talking about the issues of the day that advantage the campaign than going down this sort of rabbit hole on, frankly, kind of reverse woke cultural battles that, nobody thinks is actually as relevant today as it was maybe back in 2016.
Reverse woke. That's a good one. That's a new one. Even Senator Tommy Tuberville didn't want anything to do with this. The coach from Alabama, quote, "I ain't getting involved in that. Let him talk about what he wants to talk about," unquote. That's where we are in American politics today, Kaylee. But I will point everyone back to the remarkable news that we started this hour with, and that is the release of 4 Americans as part of a huge prisoner swap with Russia. That also happened today.
Yeah, and as the president said, good news, and especially good news for the families that were with him at the White House. So a remarkable day in Washington. We're glad to spend some of it, as always, with our political panel, Rick Davis and Jeannie Shanzano. Thank you both so much, and we'll have more ahead here on Bloomberg TV and radio.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number one, they do everything in teams.
Brent crude futures fall by more than $1 a barrel to $79.82 a barrel.
Number 2, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number 3, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ deeply in the red again. Worst level of the day. S&P 500 index down 95 right now at 54.26 for the S&P, a decline of 1.7%. Dow Jones Industrial Average down 633 points for the Dow, a drop right now of 1.5%, while the NASDAQ Composite Index is down 490 for the NASDAQ, a decline now of 2.8%. The Russell 2000 Index of small cap shares, by far the underperformer, down now by 3.4%. The 10-year below 4%. 3.97%, with a 2-year that's yielding 4.17%. Spot gold down $9 the ounce, down 0.4%, 24.37 on gold, while West Texas Intermediate crude down 1.5%, 76.73 for a barrel of WTI. Meta Platform shares, though, on a down day for the rest of the market. We've got Meta holding on to a gain now of 3.9%. After the close of trading, we will be hearing from Apple, down now by 2%, Amazon down 1.8%, and also reporting will be Intel. That stock now lower by 5.3%. So again, recapping here, 10-year Treasury yields breaking below 4%. The Dow, the S&P, NASDAQ deeply in the red, with the S&P now down by 1.7%. Balance of Power continues now, the Thursday edition. Lots going on. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington. Thanks for joining us on Balance of Power on Bloomberg TV and radio, where today we have been talking a lot about some pretty momentous news. A prisoner exchange with Russia involving dozens of individuals, including 4 Americans who had been detained, who are now on their way home. That includes journalists also Kumasheva, Evan Gershkovich, and of course former U.S. Marine Paul Whelan. We're just hearing now from U.S. National Security Advisor Jake Sullivan, who is speaking to reporters. He says that Evan and Paul are expected back on American soil tonight. He says that President Biden and Vice President Kamala Harris will greet them after they were released in this swap. But also some interesting news from Jake Sullivan when it pertains to the other thing we're watching, which is escalating tensions in the Middle East. Joe, Jake Sullivan says that President Biden will be speaking with Israeli Prime Minister Benjamin Netanyahu later today.
Once again, Joe Biden finding himself in a position to call for calm and a proportionate response. In this case, coming from Iran, Kaylee, the IDF, we're told, is bracing for revenge right now, gaming out options on what might come back to Israel from Iran following the strike that killed the political leader of Hamas in Tehran itself. They have vowed revenge. It's not a question of whether this will happen, but to what extent it will happen. And we want to talk to Kelly Grieco about this, among some of the other geopolitical stories that we're following. F-16s have just started arriving in Ukraine, for instance. Kelly, senior fellow at the Stimson Center's Reimagining U.S. Grand Strategy program, and it's great to have you back. Kelly, you talked to us back in April about the risk of a wider regional conflict when Israel was bracing at that point for retaliation, once again, from Iran. Will the U.S. and Israel be able to diffuse it like they did back in April?
Well, thank you for having me. Certainly deja vu all over again. We're rolling the dice again. I think there are a couple of things. This is similar in some ways to what happened in April, that we're bracing for another attack, likely an attack directly on Israel. But there are some really important differences that make me more concerned about being able to manage it. One is that from Iran's perspective, this is a massive deterrence failure. They had hoped when they launched the April attack in response to when Israel conducted strikes against an embassy compound, killing some Iranian senior commanders. They had hoped that massive 300 drones and missile barrage would act as a deterrent, preventing Israel from doing something else, particularly something against Iran directly, and that hasn't worked. So they're going to feel a need to do something more escalatory to send that signal, that message to deter Iran moving forward. And of course, that makes this very dangerous. And then we add to it the humiliation piece for Iran, that this happened right in Tehran, in the senior government. They're celebrating an inauguration, and that's a dangerous combination.
Well, so Kelly, if we are comparing this moment to what we saw back in April, there was also a narrative after that failed attack that Iran sent, those drones and missiles pretty much all intercepted by Israel, the U.S., and other allies, that it showed a failure on the part of Iran. What else does Iran potentially have to throw at Israel here? Have we seen the full extent of their capability?
Yeah, so I would say two things. I think we should be cautious about what happened in April, because as someone who studies air power really closely, that looked a lot like what I would call operational theater. If they were serious about penetrating Israeli airspace, air defenses, you do not send your slowest drones first, alerting us that we have a 4-hour, 6-hour, notification that there's an attack starting, right? They would have started with ballistic missiles. They did quite the opposite, starting with the slowest thing. And so I think they were actually intending to a large degree for these things to be intercepted, sort of a display of force. I don't know if we're going to see that this time. This might be, a much more serious, sophisticated attack that's harder to defend against. And then I think we add to that, which is, as you're saying, which is there's other options here. This was calibrated last time. They did not involve proxy actors, whether that's in Lebanon or Syria or Yemen. So that's another option as well. It could be a more sophisticated attack. It could be a larger coordinated attack with proxies in the region.
Will we see the U.S. and allies providing the same defense role that we saw last time, actually knocking missiles out of the air on behalf of Israel?
Yeah, so yesterday Secretary Austin was asked about it, and he said that we would again stand by Israel and defend it. It sounds like the United States is prepared to do that again. I do think there are real questions, though, about whether we'll see the same kind of coordination we saw last time with Saudi Arabia and Jordan in particular that allowed us to intercept things in their airspace. They've all sent out statements condemning Israel's actions. I think this makes it harder for them to repeat that from last time. And the other thing I just add is this is very expensive for us, the United States, when we're using these kinds of interceptor missiles that we really need in other theaters, whether it's Ukraine or it's the Indo-Pacific. So I think there's a question, too, just about how many more times are we going to actually be able to do this in support of Israel?
Well, which gets us back to our own defense industrial base, which was so much the question in the debate over aid for Ukraine. And certainly we've even heard the likes of vice presidential nominee on the Republican side, J.D. Vance, talking about how the U.S. should be reserving more of its ammunitions and power for other areas in need other than Ukraine. On that subject, though, Kelly, of course, in addition to the theater we're talking about in the Middle East, there's still the ongoing war between Ukraine and Russia. And we got the news yesterday that the first round of F-16 deliveries has made it to Ukraine from NATO allies. How quickly will those jets make a difference?
I don't think they're going to make much of a difference. And that's, we know that there are probably about 6 or so pilots that are graduating this summer. By the end of the year, it'll be about 20. And usually it's 2 pilots per aircraft is sort of the rule of thumb. So maybe about 10 aircraft at most will be operating by the end of the year. It's a fairly small number. But I also just think that the F-16 capabilities, you see the Ukrainians kind of walking back some of their earlier statements about how impactful these would be, that they're not going to be able to use these to sort of gain air superiority and be able to, support ground troops on the ground close to the front lines because of Russian air defenses. So it's going to be really limited to more of an air defense role, perhaps, intercepting some cruise missiles and drones if they're able to successfully do that. It's expensive, these F-16s, but the actual impact on the battlefield, I fear, will be quite limited.
I don't know if my eyes are right, Kelly, but for our listeners on Bloomberg Radio, that appears to be a picture of a Spitfire you have framed behind you there in your office. And of course, the legendary aircraft that helped to win the Battle of Britain. What then is Ukraine's Spitfire, if not these?
You have a very good eye, first of all, because you are correct. It's a Spitfire. I would say it's mobile ground-based air defenses. Things like the Patriot, the NASAMs that we've sent. Those have been critical for them in keeping back most of Russia's Air Force at bay because they can move them and they can shoot and they can scoot. Of course, the challenge is we only have so many interceptor missiles. We were just talking about this in reference to Israel. So there is some idea that perhaps the F-16s can help to take a little bit of that, doing it in an air-to-air role. It's a very expensive way to do that. But it's really been these mobile ground-based air defenses. And I would just say, looking at how important they have been, and they've been a challenge for the United States to find these kinds of things in other war zones and locate them and destroy them. We should be thinking about this. We don't have enough, clearly, on the United States side, getting back to the defense industrial base. And we really need to start making smart investments, prioritizing air and missile defense.
How long does it take for those investments to actually come to fruition, though, Kelly? What kind of timeline realistically are we considering here, and what kind of resources?
Yeah, I mean, this is a real concern, right? We're talking multi-years. The number of, they're trying right now for the Patriot, for example, to increase the number of interceptors at around 500, maybe to get to 750. But already they're starting to find, even with that goal, things that they're not supply shortages, like very particular parts there are shortages. And, Japan was trying to ramp up some of the missile production, and the same thing, like they can't do it because of a certain part having a shortage. And so there are all these bottlenecks in the defense industrial base, all the components, and not just the assembling of the part itself. And so this is really a multi-year effort to figure out how to resolve this and where to prioritize those efforts as well. Like, where are the central areas that we should really be trying to ramp up the defense industrial base? And I would just argue that air and missile defense is certainly one of those top priority areas.
Kelly, I just want to get back to where we started here before we let you go, and that's, of course, the situation in Israel. What's the critical window here? Do you give this the weekend to resolve? When will we see something?
Yeah, so I think there's a likelihood we could see it this weekend. I think the longer this gets delayed, the better. The one concern that I have is I feel like the Biden administration's response has been a bit sluggish to these events. And I don't know if it's because of the swap of prisoners with Russia, that a lot of the team was focused on that. But, we haven't seen, as far as I know, no one's been sent to the region to try to, do shuttle diplomacy like last time. And so I'm hoping, very quickly we're going to see some of that might even buy us some time before Iran responds. But it could be as soon as this weekend.
Well, we do know, as I mentioned at the top of this segment, Jake Sullivan says President Biden will be speaking with Prime Minister Benjamin Netanyahu. Is that likely to be an advice call, Kelly, or is that a reassurance call that the U.S. will be there for Israel, whatever comes its way?
Yeah. I feel like it should probably be a grievance call first. Perspective. I mean, he's been working, and his team has been working to try to get a ceasefire to release hostages, and it seems to have been very, very close. And in fact, Israel seems to be the party that pulled back away from it. And of course, Israel has now effectively killed one of the people that was involved in the negotiations. And so I think it's going to be really hard to get a ceasefire deal. And I think that's something the administration really wanted. And now not only is there not a ceasefire probably, but we're back at the real danger of a regional war. And I can't imagine the Biden administration is particularly happy, but they've also tied themselves so closely to Netanyahu that they don't really have as much of a choice but in some ways to support him. And it seems like that is something Biden administration is prepared to do, including defending with U.S. military power.
All right, Kelly Grieco, sobering conversation, but thank you so much, as always, for joining us from the Stimson Center, where she is a senior fellow with the Reimagining the U.S. Grand Strategy Program. Obviously, a lot of the day today, Joe, taken up by considerations of geopolitics with what's happening in the Middle East, but also, of course, the prisoner swap with Russia. And there's still much more ahead today, including after the bell, earnings from some big tech titans.
Big time. Apple, Amazon, Intel, all the same day. Our friends at Bloomberg Business Week have their work cut out for them. We're going to leave you in good hands because the building is going to shake around 4 o'clock. Tim Stenevik, Carol Masser, what are you guys watching? Carol, what's the big one that matters?
Well, I think both of them matter. And both, strategists are thinking about Apple and Amazon. We're first going to get Amazon just after 4 o'clock and then Apple at about 4:30. But both of these have the power to basically shape the trade of the NASDAQ 100, which right, Tim, it's been whipsawed as of late.
Yeah, it really has. I mean, we got a dose of earnings last week from 2 of the Mag 7, 4 more this week. With Apple, big questions around Apple Intelligence and what that's going to do for iPhone sales when that new model is released come September, or announced come September. So investors and analysts will be looking to that, and also looking at what's going on in China, guys.
Oh, yeah, we're always looking at what's going on in China, too. So that'll be pretty revealing. Tim Stenevik and Carol Masser on Bloomberg Business Week. Looking forward to the conversations. And, of course, we're going to have more coverage of that in the 5 p.m. hour when Joe and I will be back for the late edition of Balance of Power, in addition to, of course, talking more about the prisoner swap today and the ongoing presidential campaign, which has been completely upended in the last 11 days, Joe.
Not a lot of optimism at the moment. Apple's down 2%. Same for Amazon. We'll find out in a bit. And as Kaylee mentions, meet you back here at 5 p.m. for the late edition of Balance of Power. Thanks for spending time with us, as always, on the fastest show in politics on Bloomberg TV and radio.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week for this Thursday, August 1st. First trading day in the month of August. And it's an interesting one, Tim.
Yeah, a lot of red across the screen. We're going to get an update from Charlie Pellet in just a second. Suffice it to say, though, we see the NASDAQ composite down more than 2.3%.
We do indeed. And we've got some big tech earnings coming after the closing bell. Just talking about with Joe and Kaylee. Apple and Amazon reporting after the market close. Keep in mind, as Tim just mentioned, we do see stocks under pressure today. We've also seen some significant moves. Investors moving into bonds at 10-year, moving below 4%. Haven't seen that in some time. This is after some weak economic data. So top of mind, we're going to ask, is the Fed maybe waiting too long to cut interest rates?
Also, on the equity side, we're watching Meta buck the sell-off and soar on upbeat earnings. And despite lots of spending, turns out it's a bread and butter business. That would be selling ads on those apps that so many people use each and every day. Is doing just fine.
Doing just fine. Also a good day, according to President Biden. This, as we look at the geopolitical front, a major prisoner swap between Russia and the United States. So we ask, what is Russian President Vladimir Putin up to? We're going to get an update on that in just a moment.
And Bill Ackman's IPO dream implodes. We give you the latest on that.
It's one of our most read stories on this Thursday. First up, guys, let's get to the trade and the selling that we're seeing on Wall Street. Let's turn things over to Charlie Pellet.
Right, thank you very much indeed. We got lots going on, and we got you covered here on Bloomberg with the Dow, the S&P, NASDAQ, very much in the red. We are off session lows, but still on the S&P, down by 83 points, a drop right now of 1.5%. Dow Industrials dropping 612 points, down 1.5%. Tech stocks faring a lot worse. NASDAQ, the composite index, down 2.39%, with the NASDAQ 100 index now down by 2.5%. Broad-based selling today, the Russell 2000 index of small cap shares, that index now tumbling by about about 3.2% on the Russell 2000. 10-year, as Carol mentioned, below 4%, 3.97%. The 2-year, 4.17%. Gold, lower a little change, down $7 the ounce to $24.40. West Texas Intermediate crude down 1.4% now, $76.79 a barrel on WTI. Earnings front and center. Meta Platforms still holding on to a 4.5% gain. Rest of the market selling off, and those big tech names after the close of trading. Apple right now down 1.6%. Amazon also down 1.5%, and Intel tumbling by 4.6%. Recapping, stocks lower, close to session lows. S&P down 1.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. All right, Charlie, with the overview on the financial trade, got to get back to Treasury yields falling after the latest batch of economic figures signaled further cooling. It did prompt traders to project 3 Federal Reserve cuts this year. As for the U.S. Treasury, that 10-year yield falling below 4%, Tim, to its lowest since the month of February.
Just 24 hours ahead of the U.S. jobs report, data showed unemployment claims hit an almost one-year high, and worker productivity beat forecast. It did help temper growth in labor costs.
U.S. Treasury 3 and 5 and 7-year yields falling below 4% here.
U.S. manufacturing activity shrank in July, Carol, by the most in 8 months.
Yeah, there's a lot coming at investors. All right, so let's get to it, to the economic and U.S. rate backdrop. That's where we go. Back with us is Bloomberg Economics U.S. economist Stuart Paul. He's right here in our studio, along with Bloomberg Intelligence Chief U.S. interest rate strategist Ira Jersey. He's out there at BI headquarters in Princeton, New Jersey. Ira, let's talk about this move, first of all, on that 10-year note, below 4%. How significant is it technically and fundamentally, and is there maybe momentum to push even yields lower?
So I would say that 4% itself is more of a psychological number, but there was a technical level just above that when we broke through, you definitely saw some shorts basically needing to unwind and probably some stops getting hit as well in some futures. And yeah, I do think we have more to go. It's very possible, you know, our forecast for the end of the year is for the 10-year to end at 3.8%. And that's predicated, you know, not only on do we get 2 or 3 cuts this year, but it's more what is the path then beyond that? You know, do we wind up getting a much deeper cutting cycle by the Fed, and do we have a weaker economy? And I think that both of those things are possible, and it's one of the reasons you know, we do think that Treasury yields will be lower at the end of next year as well as the end of this year from where they are today.
So Stuart, come in on this and talk a little bit about the U.S. economic data story today that's actually driving the trade lower, specifically when it comes to the labor market. The Fed and Jay Powell reminded us yesterday, it's watching this data. Is the Fed behind the curve? Is it behind the ball a little bit with not cutting rates yet?
If we're looking strictly from a labor market perspective, the Fed is a little bit behind the ball. We have seen the unemployment rate rising, now reaching for 4.1%. It's pretty close to crossing that SOM rule threshold, that real-time recession indicator that folks look at. We saw ADP data this week that was pretty dismal. The employment line item within the ISM manufacturing survey was also a real drag on the headline index this week, again indicating that manufacturing payrolls are getting hit, and all ahead of the jobs report tomorrow, which we're expecting is going to show a material slowdown in the pace of hiring to about 140,000 jobs added in July. Now, July can be a little bit chunky with auto retooling, and we think that that's probably playing into some of the manufacturing numbers. We also had the effect of the Hurricane Beryl, early in the month. We saw that contribute pretty meaningfully to jobless claims in Texas. But even if you just zoom out and you just look at the trend and you look at the change in the unemployment rate over the last year or so, the Fed does look to be a touch behind the ball. So we do expect to see 2 cuts this year.
Does Jay Powell pay attention to the SOM rule? He was asked about it. He said, I'm aware of it, calls it a statistical regularity. I don't know what that means.
So it's an empirical observation. There's no theoretical basis for any explanation as to why the 3-month moving average of the unemployment rate rising 0.5 percentage point above the 12-month low would mean that it accelerates thereafter, but it happens, right? It happens very regularly. In fact, every time it's happened in the post-war period, it's been an indicator that we're in the early months of a recession. So I'm sure he's very aware that the real-time indicator is just, 0.07%, away from crossing that recession threshold. So even if he sort of fades it during the press conference, it matters.
Hey, Ira, today's rate moves, the economic reports that keep coming at us and coming just 24 hours after the latest Fed decision lead you to what conclusions about, you talked to us about your expectations in terms of the U.S. rate environment, but, are you concerned that, the Fed could be behind and that we could see a little bit of a recession here?
So I think that we will have a recession. We've actually been in that camp for most of the year. It's a matter of when. It's and how severe it is. And I think that that's the worry that the Fed has to have. But at the same time, like until the very recent data, if you look at the whole mosaic of all of the data that's been coming out, until the last month or so, you haven't seen the kind of slowing that really concerned you that we were heading into a recession. Like everything else looked a little bit more like it could be a mid-cycle slowdown, it could be a recession. We're not quite sure, but I think the data the last couple of weeks in particular has been pretty clear that we are, like Stuart mentioned, in the early months of a recession, and that means that the Fed is going to have to respond to that. And in fairness, he did yesterday, right? So even though Jay Powell's opening remarks were reasonably balanced, the Q&A was, at least the way that I listened to it, was unequivocally dovish, and basically saying like, look, we're going to cut unless we have a reason not to cut, and so that means that September's now in play, regardless of the potential political ramifications. And if we continue to have weak data, like we had today with ISM unemployment, which was like Stuart said, abysmal. The prices paid index went up a little bit. The market kind of looked through that and looked at things like new orders, which again slipped. So all of this, all of the incoming data, at least recently, has really been a bit disappointing, except for one or two very lagged indicators like GDP, which you're looking at April, right? We're well beyond April.
Okay, well, before we get to the next data point in August, at least the next time we hear from Fed Chair Jay Powell, in the context of Jackson Hole, which would be August. Stuart, we have tomorrow the employment report, the July jobs numbers. What do we need to know? What does our investing audience need to know? And how could a number that comes in particularly hot or particularly weak change the outlook for the Fed come September?
So we're expecting to see about 140,000 jobs added. We're a bit more pessimistic than most folks out there on Wall Street who on average expect 175,000 jobs added. In any event, it's a material slowdown from 206,000 jobs added in June.
It's a different tone, different trend, right?
That's right, it is. And we're not seeing the sort of major revisions to past month data that we saw throughout 2023 and a bit in 2022. So we are seeing this material slowdown in the pace of hiring. Hiring is getting to be a little bit more chunky. Some of it's affected by things like weather, some of it's affected by things like auto retooling, but the trend is for softening. We see that most in the household survey where the unemployment rate has been rising, and so we're expecting wage pressures to fade.
One thing I want to ask both of you, and let me go to you, Ira, first, that when things start to deteriorate economically, whether it's in the labor market or, the U.S. statistics that track the economy, do they start to kind of, okay, and then start to fall apart? I mean, and is this cycle potentially a little bit different than other cycles, dare I ask?
Well, I think every cycle has its unique qualities, and then also rhymes with some past cycle, right? So that's always going to be the case. There is the potential that things could fall off the cliff very quickly, right? So if you have animal spirits, and maybe one reason why the SOM rule tends to work is when people see that their customers are starting to lose their jobs, that businesses are loath to hire and might even lay off people, right? So it winds up being the whole animal spirits debate that occurs. Now, from the market perspective, the market is already anticipating a meaningful slowdown and Federal Reserve cuts. And my view just happens to be, and maybe I'm a little bit more pessimistic than my colleagues at Bloomberg Economics like Stuart and Anna, but at the end of the day, if we do go into a deeper recession, the market will probably reprice, at least for some period of time, even lower interest rates than it is now, right? Right now, the market's expecting the Fed to cut to around 3.5%, 3.25%, but I suspect that eventually at some point in the cycle, handle, it'll have a 2 handle on the Fed funds rate expectations.
Hey, Stuart, last 30 seconds. I mean, when things start to come undone, is it going to happen like all of a sudden things are going to fall off a cliff?
There is usually a little bit of convexity, as Ira said. I mean, I'm going to actually steal a turn of phrase from George Soros. The idea is reflexivity. Once you start seeing the unemployment rate rising and you start seeing it rise notably, folks start reining in their spending, businesses get a little bit nervous, maybe they start being a little bit more cautious about their expansion plans, and so an increase in the unemployment rate can beget further increases in the unemployment rate. And I think that that's what the major worry is. I think that's what it means when you cross that threshold. So.
Reflexivity. I haven't heard that in a while, but yeah, that's a favorite. Hey guys, thank you so much. Stuart Paul here in studio, U.S. economist at Bloomberg Economics, and Ira Jersey, of course, our chief U.S. interest rate strategist at Bloomberg Intelligence out there at BI headquarters in Princeton. Now, that's your macro and rates world setup. Now we're going to talk a little bit about the equity world.
Yeah, as the big tech earnings parade continues, shares of Meta Platforms off and running at its high, up 11%, up right now by 4.4%, the most in 6 months earlier. The nearly $1.3 trillion market cap mega cap reported better than expected sales in the second quarter, the fourth quarter in a row of more than 20% growth. It also gave an upbeat sales forecast after the close yesterday, signaling, Carol, that the company's investments in AI are helping it sell more targeted ads.
Yeah, their CapEx spend too, by the way, also moved up. With a roundup of the quarter and the AI trade that investors are obsessed about but increasingly scrutinizing. Back with us is Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh right here in studio. Great to have you here. So is the rally, which at its high was up about 11%, we saw it in the aftermarket. We were trying to understand because we're like the CapEx spend is up, but what they are showing in terms of what they're making on ads, that delivered, and is that why investors are happy?
I think a couple of things to call out here. One is Meta is uniquely positioned now with their large language model. And, you know, it's hard to put it in numbers in terms of how much really that drove the growth in the quarter. But when you hear their earnings call, it wasn't about Metaverse. Metaverse is like not even in the reference once.
It's amazing.
It was all AI. And the fact that they have their own large language model and they are able to apply it to their family of apps, whether it's the Blue app, Instagram, WhatsApp, that was called, you know, big adoption in the US here, and how they see that monetization. I mean, that was, to me, the standout thing. And that was a complete shift from, you know, 12 months back when they were just so upbeat on Metaverse. So clearly changing narrative. And look, you may say Reality Labs still lost $4.5 billion, but a lot of those investments are going towards integrating AI within their Ray-Ban glasses. So they are looking at the AI opportunity everywhere they are operating because of their own large language model.
Go ahead, Carol.
Well, but if advertising revenue had disappointed, still their bread and butter, we'd be having a different conversation.
Absolutely. But that's the thing about AI. It's all about data and compute. And Meta has a lot of that because of their scale. So that's why they're doing so well with that ad revenue, because they're applying that in their products, in their ad stack. I mean, they called out how their ad campaign management has become so much easier with generative AI tools, and advertisers are finding a lot of ROI in that.
It's very clear that the company has done a very good job pivoting to AI, but my question for you, Mandeep, is, was it a strategic mistake to rename this company Meta Platforms and publicly say, we're going all in on the metaverse, when it seems like they've made, at least internally, a real pivot to AI? And look, I know they're related, but you know, we're not doing this in the metaverse yet.
I think the name change is all gone now. I mean, clearly they got a lot of slack for, you know, the metaverse spend and the shift for a while. And look, we're still going through those easy comps. Second half, the comps get much tougher. So it'll be hard to sustain that 20% plus top line growth. But it was music to everyone's ears, the fact that, you know, they've moved on from the metaverse, it seems.
Yeah, it really does seem like that. Yeah. One thing that they did call out, one thing that Mark Zuckerberg called out right at the beginning of the press release was these Ray-Ban glasses that you alluded to. How big of a product is that? How do you think about that product at Bloomberg Intelligence?
I mean, look, Meta's strategy is very clear. They want to have vertical integration where they own the hardware and the operating system and then deploy their AI on top of that. What they don't like is deploying their AI on Apple's iPhone or on Android. They want to own everything, which is why, you know, Mark Zuckerberg had this big pivot towards AR, VR. And with AR, they find that opening that even though the addressable market will not be as big as the smartphones and PCs, but it'll still be a good chunk of people who may want, like a glass-based voice assistant. And that could have a lot of use cases. It may not serve as a full-fledged phone, but it could still be pretty handy in terms of driving productivity.
Another platform to read all those ads that are going to come at you through AI. Having said that, when I think about, we kind of keep having these conversations, Mandeep, about Gen AI and large language models and the application, the productivity. Is it easy, the application, in terms of ads? Is that why they're having such a big payoff? Like, is that an easy application? Do you know what I'm saying?
Well, so
we're trying to figure out how Gen AI impacts our world, right? It makes us more productive, how it pays off in terms of financial returns.
Yeah,
is this the easy route?
The best way to contrast it is with Microsoft. You look, they are making a big bet on AI, and they are monetizing it through their, the ad stack, the cloud infrastructure,
right,
and also the co-pilots. So everyone is looking for what are the big applications of generative AI. Co-pilots, and the other one is chatbot. Chatbot is where, Meta has a lot of room because, one, they have engagement. People spend maybe 2 hours across their family of apps.
If you're Matt Miller, maybe 8 hours, but anyway.
So that's where if you deploy AI capabilities and then they have the most sophisticated ad stack, it becomes, such a huge revenue opportunity.
Just 20 seconds. What are the questions that people are asking of these virtual assistants in Meta's family of apps that it's able to answer?
Well, all sorts of things that you are looking at, let's say a marketplace or groups where people already had a conversation. The chatbot has become so sophisticated that it can answer any basic question that people may have on a Facebook group, or any sort of interaction you have had on WhatsApp Messenger. The chatbot can understand that.
Really cool stuff. Meta up 4% today. It's up almost 40% here in 2024. Mandeep Singh, always amazing. All right, coming up, geopolitical and a prisoner swap. That's coming up.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs, taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we are convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
Power, money, culture. As Linda Ammon tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here.
inspired by the fusion of East and West,
I'm like the ambassador of the tour.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivian, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend, only on Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are sinking as economic jitters fuel a rush to bonds. S&P 500 index now lower by 96 points, a drop now of 1.75%. The Dow is down 643 points, a decline of 1.6%. The NASDAQ Composite Index down 478 now, a drop there of 2.7%. The Russell 2000 Index of small cap shares now lower by 3.1%. We have got the Dow, the S&P, NASDAQ all in the red. 10-year yield below 4%, 3.97%. The 2-year, 4.17%. Spot gold down $8 the ounce, $24.39, a decline of 0.1%. And West Texas Intermediate crude down 1.8%, $76.55 a barrel. Shake Shack shares are surging after the burger chain forecasts that for the first time since 2017, it will generate positive free cash flow on an annual basis. Shake Shack shares, they're up now by 16.7%. Wendy's cutting its annual sales guidance following a retreat by diners in the second quarter. Wendy's down 1.9%. Among other burger chains, we have got Wendy's, McDonald's higher by 0.1%. And another quick service restaurant worth mentioning, Starbucks, it is down now by 4.6%. So again, recapping, the Dow, the S&P, NASDAQ, all in the red. S&P down 95, down 1.7% with a 10-year 3.97%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie. So market certainly front and center, but also front and center is geopolitical news. And this has to do with Russia freeing Wall Street Journal reporter Evan Gershkovich, as well as jailed Kremlin critics in the largest prisoner exchange with the West in decades in return for a prized assassin sought by President Vladimir Putin. President Biden addressing the exchange, calling it a good day earlier from the White House. He was surrounded by family members of the 4 prisoners who are now coming home to the U.S.
This deal would not have been made possible without our allies. Germany, Poland, Slovenia, Norway, and Turkey, they all stepped up. The deal that made this possible was a feat of diplomacy and friendship. Friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request, and I personally thank them all again.
That was President Biden earlier today from the White House. With more, we're joined by Dr. Angela Stent, Senior Fellow at Brookings Institution, also the author of Putin's World, Russia Against the West and With the Rest. She's a former National Intelligence Officer for Russia and Eurasia at the National Intelligence Council. Also served in the Office of Policy Planning at the U.S. Department of State. She joins us now from Nantucket. Dr. Stent, always appreciate you taking the time and joining us on Bloomberg Business Week. Why is this swap happening right now?
So I think, first of all, we have to congratulate the Biden administration, the White House, the State Department, all the people who worked very, very hard and tirelessly to get this done. I think it's happening now because Putin really wanted this assassin from Germany back. I think the message that he's trying to send to his own people when they try and recruit them to join the intelligence services, you know, we have your back and we're not going to let you die in some other prison. You know, we're going to take care of you. So I think it was very important for him to get this particular man back. But also, I think it's partly to show that, hey, you can negotiate with us. We're reasonable. And to sort of make the Ukrainians look as if they're not reasonable, because right now, of course, the Ukrainians are saying they're not going to negotiate with Russia because there's nothing to negotiate. So I suspect there are a number of reasons for this. And Putin obviously decided not to wait until the U.S. election to do this, but to do this now.
That's what I wondered. Why not wait until the next administration? Is there any, you think, strategizing around that in terms of who might ultimately, we know we're going to get a change. We know it's not going to be President Biden. It's either going to be, we assume at this point, either Donald Trump or Kamala Harris. Do you think any of that played in to his thinking, Angela?
Well, I think when the Kremlin looks at what's happening in the U.S., they see all the polarization and the chaos here, and they're actually not quite sure what's going to happen after November. Don't forget, Germany was a key country in this because Chancellor Scholz had to agree to release an assassin who was in a German prison as part of a U.S. deal, essentially, with Russia, although it was multinational, as President Biden said today in his remarks. But they just weren't sure what was going to happen. And at least they knew that at this point, and apparently Vice President Harris also was negotiating earlier on with Chancellor Scholz, so she was involved in this. So they knew that it could happen with the current people in the administration, but they just weren't sure about what would happen after November. And I think at that point, Putin, he got back a number of spies. The Russians got from the Western countries spies, and what the West got was 16 people who were essentially political prisoners. It was probably viewed to be a better deal for Russia.
Better deal for Russia. So talk to us a little bit about Vadim Krasikov, who was serving a life sentence in Germany for a 2019 killing of a Chechen separatist in a Berlin park. What do we need to know about him?
So what you need to know about him was that, he joined the Russian security services. He was a trained assassin. He had assassinated other people before, and he very methodically planned how he got to Germany. The man he killed was a Georgian citizen, but an ethnic Chechen who was a rebel and who'd been involved in fighting the Russian government. And so he was sent to assassinate him. He had, of course, a false passport. He traveled to Germany via various other countries. He posed as a tourist, and he shot the man in broad daylight in the Tiergarten, one of the main parks in Berlin. He was apprehended shortly thereafter. For years, he wouldn't tell them who he really was. It took the German police, obviously, in conjunction with other services, trying to figure out who the man was. And he was in prison in Germany, having been convicted of this. So he is a trained assassin, and from everything we know, Putin really wanted him back. He was the number one person that Russia wanted back.
So if this is maybe a show of faith on the part of Russia and Russian President Vladimir Putin, Angela, is it also showing that he might be open to some kind of negotiation to end this war?
It's possible, but if you listen to what National Security Advisor Jake Sullivan said earlier today, there really is no connection between this prisoner swap, which was meticulously worked out over months, and which is a kind of a finite negotiation, and the much broader question of how would you begin negotiations to have a ceasefire or to see an end to the war with Ukraine? And we do know that what Putin would like to do is to sit down with the U.S. president if there are going to be negotiations. And President Biden was also asked that briefly today. That's not going to happen with this administration. We don't know about what would happen after January.
Dr. Sten, if Americans who travel to Russia understand that they could be arrested and held and indeed convicted for things that they have no connection to or did not do, what are the implications of that for a relationship that is certainly already strained? I mean, I think about the freedom of the press and the lack of reporting that we see from Russia. Very few news organizations have a lot of journalists in Russia currently.
So it's very dangerous to be a Western journalist in Russia now, and I think most Western journalists have left. There are a few Americans there. I think going forward, and the State Department has already warned people for months, Americans, think twice about going to Russia because we do know that this is a modus operandi that Putin has. Some of the people who were released today were arrested before the full-scale invasion of Ukraine, almost because Putin was planning this to take hostages. So Russia does this. It's not the only country. Iran, there are a number of other countries clearly that do this, but is to arrest people and hold them hostages. So I think the message is whatever the negotiation was that produced this success today, it's still very dangerous for an American to travel to Russia without knowing exactly, what they should be doing and without really keeping their mouths shut.
So no doubt about it, in your view, I mean, U.S. officials have accused Moscow of basically, taking American hostages to basically release or win the release of their own Russian agents and others. Moscow says that's not the case. But do you believe that is their mode, as you just kind of said?
Oh, I think it is. I think if you look at the Americans who were released, 3 with U.S. citizenship and 1 Vladimir Karamurza who has a green card. These are not spies. These were people who were legitimately in Russia doing other things. In Karamurza's case, he certainly criticized the government. The other 3 Americans were there either doing reporting or in Paul Whelan's case, I guess, on vacation. And the Russians who were released today are all political opposition people. And then the German nationals and 1 man from Belarus who were released, none of these people are remotely spies. So this is clearly a political hostage taking. Whereas, of course, the people who were released to Russia, most of them were spies and criminals.
So how does it make you nervous that the people that were released back to
NYMEX WTI crude September futures settle at $76.31 a barrel. That's down $1.60 or 2.05%. NYMEX gasoline September futures settle at $2.39 a gallon. NYMEX diesel September futures settling at $2.40 a gallon.
The Russians we know have heightened their espionage activities in Europe, in the United States for some years now already. And so I think it doesn't really change the view of Russia as seeing the West as its enemy, of believing it can win in Ukraine, that it can outlast the U.S. and the European countries. I think what it means is there were practical reasons for Putin to
and NYMEX natural gas September futures settle at $1.96.
But not much is going to change in the near future.
Right.
Dr. Stent, 30 seconds left on what happens in November when there is a change at the White House come January 20th. How does that impact relations between Russia and the U.S., if it's Harris, if it's Trump?
Well, I think if it's Harris, there's going to be continuity. We know the people who
US stocks extend their fall. That's the NASDAQ down over 3% now.
Office, so I think there would be continuity. If it's Donald Trump, we don't know. He has said a number of things. He said that he's going to end the war, in 48 hours, and a number of other things. But we really don't have any sense of what he would actually do. So I think that's a big unknown. And I think, again, coming back to what we discussed before, this is probably why this exchange has taken place now.
All right. So appreciate it. Everything just explained so clearly. Angela Stent, thank you so much. Really appreciate it. Senior fellow over at the Brookings Institution. Her book, check it out, Putin's World, joining us from Washington, D.C. Hey, coming up, we're going to get to one of the most read stories, deals with Bill Ackman and an IPO. Not happening.
Before that, though, a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nancy.
Thanks, Tim. President Biden says the ordeal is over for the families of Wall Street Journal reporter Evan Gershkovich and former U.S. Marine Paul Whelan. They were released today as part of a major prisoner swap with Russia. President Biden says the deal was a feat of diplomacy.
Deals like this one come with tough calls, and there are never any guarantees. But there's nothing that matters more to me than protecting Americans at home and abroad.
Biden says the deal means the U.S. and its allies will return 8 prisoners to Russia. The swap took place on the airport tarmac in Ankara, Turkey. Transportation Secretary Pete Buttigieg says the administration is proposing a new rule for parents who travel with small kids.
We are requiring that an airline not charge you extra to sit next to your kids or your grandkids. It applies to any accompanying adults.
Buttigieg spoke with CBS Mornings about the proposal. He says airlines must offer parents alternatives, including a full refund or the option to wait for seats to become available before the flight's departure. Carriers would also face penalties for violating the rules. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Saturday mornings, I understand you have off.
Yeah, Saturdays is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. The selling is intensifying. Again, lows of the day right now on the Dow, the S&P, and NASDAQ. For the S&P, now looking at a drop of 101 points, down 1.8%. That stock chart going from left to right and lower. The Dow now down 694 points, a drop for the Dow of 1.7%, while the NASDAQ Composite Index down 492, down 2.8%. The NASDAQ 100 500 index down 2.9%, with the Russell 2000 index of small cap shares now lower by 3.4%. 10-year at 3.98%, the 2-year 4.18%. Spot gold down $10 the ounce, down 0.4%. West Texas Intermediate crude now down 1.7%, 76.57 a barrel. Stocks got hit as bonds rallied after weak economic data spurred concern that the Fed is waiting too long to start cutting rates. So again, the S&P 500 index down 99 right now, a drop of 1.8%. Earnings news, Meta holding on to a gain of 4.6%. Lots of mega cap names after the close of trading. Apple down 2.1% right now. We've got Amazon lower by 2.2%. And Intel also reporting after the close of trading. That stock hard hit today. We've got Intel shares now down by 5.1%. So again, recapping, steep losses for the U.S. equity market. S&P now down by 1.8%. That 10-year worth repeating below 4%, 3.98% right now on the 10-year. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thanks for the update. Carol Masser along with Tim Stanovic live here on Bloomberg Business Week. All right, let's get to one of the most read stories on the Bloomberg on this Thursday. It's something we actually talked about with our own Bailey Lipschultz earlier this week about the IPO dream of a hedge fund billionaire. We're talking about Bill Ackman. It apparently, Tim, is no more.
Yeah, how in the space of just a few weeks, Ackman's bold plan to steer a new investment fund onto the venerable New York Stock Exchange has collapsed around him. The story by Bloomberg's Annie Massa and Catherine Burton. Annie, Bloomberg News wealth reporter, she joins us from New York City with the story. So Annie, Bill Ackman, a well-known individual to the Bloomberg audience, his plan for this new investment fund's a $25 billion IPO, his relationship with social media. Before we get to the undoing of his plans, remind everyone who he is, how he's spoiled for a fight in the past, and what this new investment fund was all about.
Absolutely. The new investment fund is something that Ackman has been kind of chasing after for the past couple of months and really has ramped up in the past few weeks fundraising for it until yesterday when the whole thing was scrapped in very dramatic fashion. What had happened was Ackman kind of came into this fund wanting to bring a $25 billion closed-end fund to market, which was a huge target. It would have been the largest of its kind in the U.S. ever. Then that target was slowly lowered, almost like a deflating balloon, to $10 billion, then $4 billion, then $2 billion, and finally the entire IPO was tossed out yesterday and scrapped by Pershing Square.
I feel like whiplash, Annie. And it's all kind of played out on social media, right?
That's right. I think that this has been a more recent change for Bill Ackman. He's gathered this Twitter following of over 1 million followers, and you really saw it when he last year and into early this year when he went on kind of a crusade against diversity and inclusion initiatives on college campuses and rallied against some of the Ivy League presidents and kind of successfully managed to rally against Claudine Gay, who left Harvard University, who was former president of Harvard. And so he gathered this big following on social media. And part of the pitch for this fund was that he has such a great presence on social media and such an ardent following on Twitter or X that he could kind of parlay that into investment dollars in Pershing Square USA, which is what the fund would have been called. Ultimately, that didn't materialize, though.
What were the first signs, Annie, that this wasn't going to materialize, that this was going to unravel, that this was falling apart, things weren't going in Ackman's favor?
There was a kind of strange occurrence that happened in the middle of all of this. A letter, Pershing Square published a letter that Bill had sent out to some of his wealthy investors that he didn't necessarily know was going to be published publicly to everyone. And he was kind of saying, get your orders in now as quickly as you can. And it didn't convey, let's say, the certainty that this IPO could raise as much as he originally wanted. And even in that letter, he was lowering his target. So that was an early sign that things weren't quite as sensational as he had originally anticipated. And from there, it was really all downhill with the target fundraising grinding lower and lower until the IPO was ultimately tossed.
Well, he ticked off one major backer, right? A fellow hedge fundy guy.
That's right. So Seth Klarman from Baupost wound up withdrawing his support. He had been planning to invest $150 million into this IPO, and in kind of dramatic fashion, Bill had named a couple of large investors in that letter, and Seth Klarman was one of them. And ultimately, what we reported is that Seth Klarman decided to withdraw that support, which was pretty meaningful and ultimately a big moment in the downfall of this IPO.
Annie, help us understand what exactly this fund was going to do. What investors who followed Ackman on X, if they invested in it, what they would have exposure to?
That's right. So it was going to be a group of securities that Bill and the Pershing team would have picked, about a dozen securities, and almost like a basket of these securities. But a closed-end fund works a bit differently, where the capital in that vehicle is permanent. So it makes a great vehicle for a hedge fund manager like a Bill Ackman, who gets a more permanent source of money in that pool. But for an investor thinking about putting money into this pre-IPO, these kinds of funds often trade at a discount to the overall value of the assets that they've raised. So ultimately, this was a question that hung over this IPO and really helped to hobble it, was why invest in this thing pre-IPO if you're concerned that it could trade like most of these funds do at a discount to the value of its assets.
So, Annie,
and this was something.
Oh no, go ahead,
sorry.
please. No, please finish.
That was a question that was ultimately raised in yesterday when the IPO was scrapped.
What I wanted to jump in, forgive me, was it so ultimately a bad idea, or did investors kind of wake up and didn't love some of his activism?
To seeing Brent crude futures settle at $79.52 a barrel, which is down $1.32 or 1.63% on the session.
Rivals alike say the debacle highlights one of Ackman's signature traits, a personal conviction, sometimes veering towards hubris, which has been central to his success in activist investing. So what makes him a good investor at times can also be a flaw. So was it kind of a rejection of him?
That's right. So something that really characterizes Bill Ackman is his bravado and belief in his own ideas, almost, some would say, to the point of fault. But I mean, to be an activist investor, you have to have extreme conviction, and he built his entire career this way, with obviously some very high highs and great bets and some huge failures and devastating losses along the way. And what's marked his career is that extreme conviction in whatever he goes into. And in this case, going in with the conviction that he'd be able to raise $25 billion for this fund that was quite a lofty goal. And part of the pitch was that, this will be a success and take off because of Bill's huge social media following. And what wound up happening was transforming that following into really wedging it into the kind of stuffy world of securities product. It didn't ultimately work out in the end. But he went in with that huge conviction, that huge expectation that just kept grinding lower and lower.
So, Annie, 5 seconds. Does he try again, or is this over?
The filing yesterday said that they might come back, but it's certainly not going to be in this form.
All right. Annie Massa, thank you so much. Bloomberg News Wealth Reporter. Hey, coming up, everybody, no college degree, don't worry. Turns out you're better off today. We're going to explain one more thing coming your way.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Broad-based tech sell-off today. Applied Materials shares among those names declining. AMAT, Applied Materials, down now by 8.9%. It has been informed by U.S. officials that it will not be getting CHIPS Act money for a long-anticipated research and development center, dealing a critical blow to a much-touted project in the heart of Silicon Valley. So right now we are looking at Applied Materials down by 8.8%. ARM Holdings held off on boosting its annual forecast, raising concerns that it's not confident in its growth prospects. Shares of ARM Holdings, they're down now by 16.5%. Qualcomm shares among the other big tech names declining today. Right now, Qualcomm down by 10.5% after analysts noted some weakness in the chipmaker's forecast. The reiteration of the company's full-year outlook is also seen as a potential disappointment. Again, we've got Qualcomm trading lower now. Qualcomm down by 10.5%. Roblox shares lower by 6.5%. The operator of a popular video game platform for kids projected third-quarter bookings that beat analyst estimates, but the stock is trading lower. Roblox shares today down now by just about 6.6%. Hertz Global Holdings reported a worse-than-expected loss after its failed bet on Tesla EVs weighed on the value of cars in its fleet. Under new CEO Gil West, a former Delta executive, Hertz is trying to unwind the Tesla debacle by selling off the vehicles at a loss and revamping the management team. Hertz shares now lower by 8.7%. So it is a down day for the Dow, the S&P, NASDAQ. I'm Charlie Pellet, and those are some of our top company stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. Let's get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. President Biden says today is a happy day. He says the U.S. has completed a prisoner swap with Russia that includes the release of Wall Street Journal reporter Evan Gershkovich and former U.S. Marine Paul Whelan. Both men have been jailed in Russia on espionage charges that the U.S. called bogus. President Biden was surrounded by their families as he announced the deal.
The deal that made this possible was a feat of diplomacy and friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request, and I personally thank them all again. And I've thanked them personally, and I'll thank them again. All told, Russia has released 16 prisoners. 8 Russians were being held in the West. will be sent home as well.
Biden says the deal would not have happened without our allies. Wildfires are burning in many parts of the western U.S. The Park Fire in Northern California is the largest in that state's history, burning more than 392,000 acres. Meanwhile, 2 fires in Colorado have spread to within just miles of one another in an area north of Denver. There's also fire burning in Washington state, one burning more than 30,000 acres northeast of Seattle. At the Paris Games, Simone Biles has won another gold for the U.S., this time in the women's all-around gymnastics competition. She becomes the oldest Olympic women's gymnastics champ since 1952. America's Suni Lee won bronze. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Carol and Tim.
Nancy, thanks so much for that update.
I don't want to know the Olympics.
Carol, here's what you got to do.
I set my DVR.
You got to take next week.
Gonna go home and
off.
watch.
You got to take next week completely off and just stay home and watch the Olympics
because
it's
the gymnastics stuff I care about.
Hey, well, sorry.
All right. Moving on. Let's get to one more thing because the story popped up on our radar. It has to do with Americans without college degrees. Some research found out that they are doing better off than they were pre-COVID.
Yeah, it's really interesting. Generous government support in the early days of the COVID outbreak and intense competition for workers afterward actually helped boost wages and wealth for workers without a college education at a faster pace than for graduates. This is according to a report published Thursday by the left-leaning think tank Third Way.
Yeah, and while the onset of the pandemic, drove up unemployment disproportionately for those without college degrees, as services and retail jobs all but disappeared, the reopening of the economy created such demand for these workers that companies had to significantly raise wages to attract them back, and that has certainly helped them out.
Okay, so let's talk numbers here. Earnings for those aged 25 to 64 without a 4-year college degree, those rose 4.6% from the fourth
Treasury
quarter of
10-year yield falls 10
March
basis points on the day to around 4.15%.
3.3% increase for workers with a bachelor's degree or higher, according to the analysis. Those gains followed years of wage stagnation before and after the financial crisis of 2007 to 2009. That was for both groups.
So we talk a lot about income, but really what's important, right? We talk about wealth, increasing wealth. So wealth, too, grew more for non-college households, rising 5.5% over that period compared to a 4.8% increase for households with college graduates, driven by higher savings and rising home values. So just an interesting twist as we continue to evolve in this post-pandemic world.
It's also notable because the gains for those without a college degree, it kind of bucks a trend that we've seen following other recessions when job recovery for lower wage workers was slow. So after the financial crisis, for example, the unemployment rate for those without a college education surged above 10%, whereas joblessness for college grads never surpassed 5%.
Well, it's interesting that we're talking about this. Remember, tomorrow, 8:30 a.m. Wall Street time, we're going to get another read on the U.S. jobs picture. We got a weaker read today, and that is certainly what's dragging down the markets. We continue to track that over the next couple of hours. Coming up for those on TV, the close. Tim and I continuing on Bloomberg Business Week. A great lineup, including a check-in with our Gina Martin Adams on the trade.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Commodities sliding, small caps slumping, Treasury yields near the lowest levels of the year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. A truly ugly day if you're long equities in the market.
Absolutely, and it's intensifying as we get closer to those bells.
Yeah, it's sort of a bad news is bad news situation. The sell-off really picked up steam after the ISM manufacturing data came in. We fell the lowest, or the most, since November of 2022. Here's what we see. The S&P down a full 2 percentage points. Tech getting hit down over 3 percentage points. Where does the money go? The money goes into the bond market, particularly that front end. This is just no better way to tell this story, Romaine. Bad news is bad news. You sell equities, you buy bonds.
Yeah, that chart really does say it all. And you think about where we are right now, 24 hours after the Fed decided, and less than 24 hours away from the next U.S. jobs report, and benchmark yields continuing that drift downward towards the lowest levels going back to January. The 10-year Treasury posting its first tick below 4% in about 6 months. That's part of an almost 80 basis point slide from year-to-date highs, a drop that Sakjen Subhadra Rajapaksa says might be too far, too fast.
To me, it feels like at least the front end of the bond market is overpriced for cuts given the general health of the economy.
But ask yourself, how healthy is that economy really? What, when you have a report today showing U.S. manufacturing activity shrinking the most in 8 months, or another report showing the number of Americans on continuing unemployment benefits hitting the highest since 2021? Or how about those earnings reports from Wendy's, Cheesecake Factory, Starbucks, Hershey's, all noting a retreat in consumer spending as inflation really does take a toll? And of course, that puts even more pressure on big tech to show and prove that their recent run-up in valuation was indeed justified. Earnings after the bell from Apple, Amazon, and Intel. Apple under a lot of pressure to give more information about demand for its next iPhone, while contributions, Alex, from AI is going to be front and center for Amazon.
Yeah, and it's a tough tape. It's going to be a tough tape to report into. So the idea is if you get bad news actually equals bad news, does that wind up meaning that the Fed will cut sooner rather than later, or at this point just cut more? The market, at least the swaps market, is saying they're actually going to be cutting more. So this shows the amount of quarter-point rate cuts by December. And you can see now that number is going up to 3. So it looks like the market's now pricing in 3 cuts for this year. All of that really propelling Romaine after we got that very, very weak ISM manufacturing number. We talked to Tim Fiore actually on radio about this, and he's like, demand is non-existent. He said, if you need a reason for the Fed to cut rates, this is the data.
All right, let's kick things off. Ed Al-Husseini joining us, senior interest rate and currency analyst at Columbia Threadneedle, as we kick you off to the close here on this Thursday afternoon. Ed, you saw the reaction in the Treasury market. Obviously, a lot of that stems from what we learned yesterday out of the FOMC, but of course, getting that manufacturing data this morning, those unemployment claims numbers this morning, certainly not helping the case. And it raises the question, Ed, as what exactly are people pricing in when it comes to this drop in rates? Is it about the Fed, or is it about weaker macro conditions?
It's a little bit of both. I think it's a recognition that the Fed is now in a very uncomfortable spot, that the status quo is unlikely to hold into the end of the year, and more questions about whether the Fed will actually have to provide accommodation to the economy and stimulate the economy at some point next year. And that's where the entire rates curve is pricing at the moment.
Were you surprised that the Fed wasn't a little bit more dovish in the statement as well as in Jay Powell's press conference yesterday? And would you be surprised if they did not cut rates at their next meeting on September 18th?
Yeah, let me put it this way. You know, the Fed's been operating with a fair amount of inertia. They've internalized the fact that data over the course of the past 3 years has been evolving in the right direction, but relatively slowly, with a lot of surprises along the way. So this inertia is built into their strategy. And what we're seeing right now is this inertia starting to come into conflict with the fact that the data appears to be turning. The risks, particularly to the labor market, are increasing pretty rapidly. Would I be surprised if they did not cut in September? Yes, that would be quite dramatic. Obviously, they're aware that market expectations are very elevated, and not cutting into the end of the year would really tighten financial conditions and put them into an even more uncomfortable spot at the beginning of next year.
Hey, Ed, the word in the street is that the systemic funds have more equity positions to sell. They've reduced a bunch, but they still have more to sell. Does that mean equivalently we're going to see more money go into the bond market?
Yeah, you know, money's been coming into the bond market pretty much on a systematic basis since really the second half of 2023. Right, we had that big dislocation in 2022, significant drawdowns and outflows, and people have been recovering from that for the better part of the last 12 to 18 months. I think what this really reflects is the fact that the starting level of yields across the fixed income landscape remains very attractive. A lot of those spreads are gone. The wide spreads that we had in the middle of last year have compressed significantly. But the outright level of yields is still very attractive. And so the incentive to rebalance out of risk and into bonds remains, I think, quite compelling.
3.5 on the 10-year by the end of the year? What do you think?
Eminently doable, right? We started the year at 3.8, and that was in an environment where the economy was still very hot. The labor market was in better shape. 3.5% on 10-year yields through the end of this year, absolutely within the realm of possibility.
When you look at the economic picture here, Ed, and I'm just curious as to what's going to be the data point that you, as an investor, from an investment perspective, not as a Fed chief, not as an economist, what's the one that you're going to track the most to give you a sense here of maybe what the directionality of the Fed or really the speed of those rate cuts, how that might shake out?
Yeah, look, as investors, we're very sensitive to financial conditions and credit spreads. And credit spreads are very tight, reflecting the fact that underlying corporate fundamentals are really good, and to some extent extrapolating the growth and the demand story into next year. If that starts to pull back and we see more of a disorderly widening in credit spreads, a pickup in rate volatility, that to me would be a really strong signal that the pressure on the Fed to move not just in 25 basis point increments, but potentially faster to get policy into a more neutral stance will definitely rise.
Is your expectation, if we do get that first rate cut, that is the actual start of a cycle, Ed, meaning that they keep going with this, or do you think this is going to be a cut and then wait and see?
No, I think we're past the possibility that it will be sort of incremental adjustments. It makes sense for this to be a cycle to at least take us to neutral. So think about 3.5% on the Fed funds, and then very quickly pivot to the question of, do we need to provide accommodation to this economy? Have things deteriorated? Have risks elevated to the point that we need to provide assistance to the economy and stimulus to the economy? I think that's business. To that neutral stance will definitely require sequence over the next 6 months.
All right, Ed, always great to talk to you. Ed Al-Husseini, Senior Interest Rate and Currency Analyst at Columbia Threadneedle, kicking us off to the close with the focus on the market as stocks right now hitting session lows. When we come back after the break, we're going to talk about one of the most remarkable turnarounds for a publicly traded company, Carvana. The shares higher today after the used car retailer posted a surprise profit. A conversation with the CEO, Ernie Garcia.
Plus, another take from the C-suite. The CEO of Contour Brands, behind the likes of Wrangler and Lee, joins us after strong earnings print. His view on the durability of the consumer.
And pricing is not the way to drive sales. Those are the comments from the CEO of Shake Shack. That company actually having a pretty good day. The shares moving higher as the burger chain offering up a surprisingly big beat in the most recent quarter and an even more surprise read on its guidance going forward. We'll explain in our Stock of the Hour. All that and more coming up in a second, right here on The Close on Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
We're looking at some retail movers to the downside. It has been a rough go when it comes to retail stocks, right? You got Wayfair, Canada Goose, Etsy, all down quite significantly. The consumer is just really struggling at the end of the day for some of these guys.
I wonder how much of this is linked, how much of it is idiosyncratic, because we get so much of this anecdotal evidence, whether it's out of the retailers, the apparel makers, and we're going to talk a little bit later about some of the restaurant chains here, and they're all kind of saying the same thing, that people are just a lot more cost conscious and, of course, making decisions. Either they're not buying anything at all or they're just buying less.
And also just, not terrible isn't even enough today to support some of these guys.
Yeah.
Like for eBay, for example, when analysts said not sexy but not ugly, then even that stock is still down like 9%.
Yeah, but then it's kind of interesting, too, to see the brands and, more importantly, the companies that really are somehow managing to buck that trend. And the big question is why? Why are they different?
I'm so happy we have one of them with us right now. Let's stay with retail for a second and go to Contour Brands. It is bucking that negative trend. They're the brand behind Lee, Wrangler, and Rock & Republic, reporting earnings that beat expectations and raised its full-year outlook. CEO Scott Baxter joining us there. Let's just pick up on that, Scott. What led to your outperformance? I mean, is it top line? Is it margin expansion? Is it pricing power? What is it?
It's all of the above. It's new products that are really resonating with the consumer. In addition to that, it's real estate gains with our biggest wholesale customers. And the fact that our products are working in the marketplace, obviously, work is really important to our products and people are still working. And we have a really great product line that has a really great value. So people can afford our products and we're seeing them choose us.
So when you say value proposition there, does that mean that you have to compete on price and there's a value war in your area, or you have that pricing power?
No, we have that pricing power with where we sit. Our consumers look at us like they can go ahead and buy a really good brand, the three that you've shown here today, Wrangler, Lee, and Rock & Republic, and they can buy it at a really fair price. And they can also shop for it in the channels that people are shopping in right now because of our wide distribution. So for all those reasons, we're really, really clicking with the consumer right now. In addition to the fact that we've done a really nice job from a marketing standpoint with some of our collaborations that we've done with like Hey Dude this quarter and some of our entertainers. We have Lainey Wilson and Cody Johnson. Cody's new line kicks off next month. Lainey's kicks off in September in the country music arena. So we're making a lot of really good moves right now with the brands.
Talk a little bit more about that marketing. How much of that was kind of the kernel that came out of the company itself, or was some of this opportunistic? Where did it come from?
It's a little bit of both. It was also a really sharp turn relative to how we're marketing now. We're listening to our consumer much more. We've got a much more broad-based consumer. Many more females are into our brands now versus before. It was a little bit more male-dominated, especially with Wrangler. But that's really pivoted, and we're really in a good place right now. So I think that and the fact that we're kicking off our first national broadcast media TV commercial. We haven't done one in a few years with Wrangler here in September, which, it's tested extremely well, and we're really looking forward to that coming out in September. It'll be really exciting.
Yeah.
We're really pivoting to a really interesting time in our company right now.
I'm curious. I'm not familiar with the new commercial push here. Where is that going to air? Is that just going to be on normal shows, or are you pivoting this around a specific event, or what?
No, it's going to be on normal shows. It'll be in broadcast TV, normal shows, cable, and then it'll also be with a lot of focus on live sports, too.
Okay.
Going into some of the other areas, though, I want to ask you about Asia. It does seem like you are experiencing some headwinds there. You are definitely not alone. If I've learned anything from conference calls, it's that China is a seriously big problem across all sectors. Can you talk a little bit about demand in China?
We had a little bit of lumpy demand over the last couple of years as their recovery, and we've talked about this a lot, has been uneven. But now we're starting to see that kind of get a little bit even, and the consumer is responding. We've cleaned up our distribution and inventory in the marketplace, which was really critical for us. And we believe we're going to inflect positive for the second half of this year, and talked about that today in our call. So we feel better about Asia than we have in a long time.
What do you feel like is the difference? Do you feel like you just got the inventory out of the way and therefore China feels a little bit more sturdy? Or do you think that the actual consumer is changing its tune?
A little bit of both, but both were really important. And so the fact that they both are now happening at the exact same time is really important.
I am curious about how you sell to folks, Scott. There was a lot of talk coming out of the last earnings about the direct-to-consumer strategy, the growth in that strategy that we've seen. How much of a push are you making deeper into that?
Really big. One of our focus has been e-commerce. It's been a focus for a few years now. We've got a really good team in place. And now we're pivoting a little bit because we have made really good inroads there with all of our brands. And we're starting to do a little bit more from a physical store standpoint. We have about 600 physical stores in Asia right now. We have about 150 in Europe. And we only have about 40 in the United States. And that's going to change. And we've talked about that going forward. We think there's an opportunity for the consumer because you know what we found? We found that the consumer loves to shop from a physical standpoint, touch and feel and be there, and also have the option for e-commerce. So we're going to go down that path.
Just real quickly, with the expansion, particularly here in the U.S. side, with the physical stores here, does that cost work out for you? I mean, there's a reason why we've seen a lot of other of your competitors kind of shy away from having too many retail locations.
Yeah, it really does. You know, for us, you know, we're in outlet malls right now, and it works really, really well for us and our consumer. As long as we get the throughput, which we're getting the throughput in the stores, and we're really thoughtful about how many stores we open, where we open them, and when we open them, and really strong strategic marketplaces for us. So yeah, it works really well for us.
All right, Scott, really appreciate you taking time for us. Scott Baxter there is the CEO over at Contour Brands, which of course includes Lee and Wrangler jeans. One of the few bright spots in a day, Alex, where we're basically seeing almost everything down. Some of the worst declines that we've seen all year long for some of the major indices. And Abigail Doolittle just flagged the Philadelphia Semiconductor Index, down more than 8%, the worst day for that index since the onset of the pandemic in 2020.
Yep, Qualcomm, AMD, the like. The NASDAQ now down almost a full 3 percentage points. Also, the Russell down 3.6%. The Russell outperformance picture that we talked about sort of pausing definitely today. It's just sort of selling most of the equity market is how it definitely feels.
And of course, that big drop in benchmark yields, the VIX elevated on the day, a sell-off in commodities, and of course a push ahead to after the bell, where hopefully maybe this market, the equity market, gets some relief from big tech. Amazon among the big companies reporting after the bell, and is sure to be a critical look at
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killing, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations, and we start off today with MGM Resorts. City cutting its price target to $59, down from $65. This after the casino operator hinted of softer room bookings around that Formula One race in Las Vegas in November. The analyst now thinks F1 could be an earnings headwind. He's also warning investors that the company's BetMGM service may need more investments. Those shares having a worst day in quite some time, down about 14%. Next up, let's take a look at Datadog. The software company upgraded to buy over at BTIG. 143 is your price target. And this comes after near-term checks on the demand environment with enterprise partners was found by the analysts to be encouraging. The analyst also says Datadog is best positioned to win business from Splunk following its acquisition by Cisco. And finally, let's take a look at Reddit. Raised to buy from hold over at Loop Capital, analyst Alan Gold expecting the social media company to beat on users, revenue, and adjusted EBITDA when it reports next week. And while Reddit is trading at almost twice its March IPO price, Gould says he's comfortable with that valuation. Reddit shares nevertheless getting caught up in the downdraft today, down about 2%, and those are some of our top calls. We do want to stay in the tech space as we do get Apple and Amazon results after the bell tonight. Investors really are hoping to get promising data out of Amazon to lift the negative sentiment, bogging down tech stocks. Joining us right now is Shweta Kajuria, Wolf Research Managing Director covering the global internet sector. She's got an outperform rating on the shares. All right, this is still a juggernaut, still a cash cow. Give us a sense here, Shweta. I know expectations are high, but give us a sense here as to whether you think that web services side of the business will hold up and whether that will pair well with what we're seeing on the retail side.
Yeah, definitely. First of all, thanks for having me. I've got three things to say. One is that I think that the demand side will likely hold up. Expectations are high, as you said. However, after Microsoft printed, they came in slightly lower just because there's some concern around Azure's cloud revenue growth rate that came in maybe a point or two below, and that caused that rang some bells of caution. What we are gathering from the checks that we have done on cloud, the demand is holding up really nicely. One data point we could also look at is Google, and Google's cloud business accelerated above 29% because they give the cloud, and then GCP was even faster than that. The second is that the industry enterprise customers that we have spoken with continue to say that the demand is doing really nicely. And third is that they have publicly, the company has publicly said, I think it was on Bloomberg, that the growth is accelerating. Yeah. So we have reason to believe that the cloud business for them is set up pretty nicely to accelerate.
Well, let's stop there for a second, because they did say that on Bloomberg, and we're basically talking about a business, at least the web services part, something like almost 50% market share, 47, 48% here, 17% growth rate. At least that's the expectation coming out of this quarter. But there's been a lot of discussion now, Shweta, about CapEx spend and the types of investments that Amazon, as well as the other hyperscalers, are having to make when it comes to AI. And not just AI. AI is kind of a weird word to use because it really goes well beyond that. Are you comfortable with that spend?
With Amazon, yes, I am. Partly because the fact that they are actually spending is potentially a mark for the demand that they're anticipating, and that's a good thing for them in terms of the readiness that they are putting themselves into. The second reason why I think is because they are working really hard, and they've already shown a lot of evidence of it since Andy Jassy came on the helm over the past several quarters, that they're showing operational efficiency gains across their retail business. Their advertising business, which is a higher margin business, is also doing really well. So arguably, Amazon likely will get a bigger pass than perhaps a Meta would, which after yesterday, we saw that their demand is holding up nicely too. But what I'm trying to say is that their margins continue to do really well. They have long runway for growth for their margin expansion. They have strong advertising business. Cloud is on the up and to the right. And so they have some offsets for the DNA that's going to go up because of the CapEx spend. And it's arguably a good sign that they're setting themselves up for demand.
Let's get the really boring stuff. Online retail sales and also their physical store presence. I mean, if you combine those two, it's really double what they're bringing in from cloud. What are going to be some of the drivers that will give them even more market share in the e-commerce workplace right now?
Well, the expectation right now is for low double-digit percentage growth rate, at least for the North America business. For them, there are two things that are happening. What we are hearing is that consumer spend is increasingly getting pressured, and there's a mix shift from discretionary spend to non-discretionary spend. Now, Amazon having more than 40% of the e-commerce market in the United States, they kind of represent the market. But the fact that they also carry non-discretionary items is a plus for them, and from our checks, they seem to be consolidating share, arguably gaining share from other more discretionary skewed retailers. That's point one. And the second thing is that they are increasingly developing faster and faster delivery speed. And we have seen from history that when consumers get faster and faster delivery speed, and they're expanding now also into the suburbs of delivering faster, you are more likely to order more frequently, whether it is for groceries or something else, just habituating to the platform. And that should help them.
All right. We really appreciate it. Thank you so much. Really looking forward to it. Amazon stock now down almost 2% as we head into that tape. Shweta Kajuria, thank you very much for joining us, Managing Director over at Wolfe Research. All right, coming on, let's go back to the C-suite. Carvana finding its stride after another profitable quarter. It's our conversation with Ernie Garcia, founder and CEO. That's coming up next. This is The Close on Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily self-awareness and emotional intelligence. What they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
We are just about half an hour away from the closing bell. It is brutal out there, and it is particularly brutal for one company, Mobileye. That stock down a whopping 23%. Automotive supplier slashing its annual forecast, and a large part of that remain is due to primarily weakness in China.
Yeah, well, weakness in China, but also specifically weakness in this whole idea of, I don't know, this sort of driverless car revolution that we were supposed to get, or whatever we want to call it, autonomous. And the idea that we've seen the retrenchment here by some of the U.S. automakers, we've seen it over in Europe, and now we're starting to see it in the demand coming out of China as well. So I don't know if this is because of the consumer or if it's more because of the automakers themselves deciding that they would rather put that investment somewhere else.
Or maybe a combination of the two. They specifically said one of its customers outside of China delayed a launch for a high-volume advanced driver assistance system. So autonomous, but who knows what that actually winds up meaning.
Yeah.
But didn't Fisker go bankrupt in the last quarter too, and they're a customer?
Yeah, well, and a lot of those other companies too. I mean, it's like they never really gained the traction, and Mobileye's kind of been at the center of it because obviously, you know, they make a lot of the key sensor components for this. And I mean, I know they still have Tesla and a few others on the hook here, but when you see a 25% drop in the stock, and you know, that's not good. Worst day, I think, since they went public.
Yeah. All right, and a lot of other car makers also have not reported a great quarter, in part because of China, but also weakness across the board. One company that bucked that trend again is Carvana. This is a used car retailer reporting stronger than expected vehicle sales and revenue in the second quarter. Also had record gross margins. Joining us now for more on this, Ernie Garcia, founder and CEO of Carvana. Is a super basic question. What is driving the growth? What kind of income level? What kind of car?
Sure. Well, I think, you know, since inception, we've sold cars across the credit spectrum, across the income spectrum, across the age spectrum. So we sell cars to American customers buying all the different types of cars that you'd expect them to buy. Our top seller right now is actually a Tesla Model 3, but we're also selling all the kind of small SUVs that you'd expect. So, you know, we sell all the cars that customers want.
We also obviously track what's happening with the consumer in terms of auto loan delinquencies, credit card delinquencies, et cetera. Are you experiencing any impact from auto loan delinquencies? What are you seeing?
Sure. So as part of our business of selling cars to customers, you know, many customers are looking for financing when they buy a car, and we provide that financing for them as well. So that gives us visibility into the health of the consumer on the credit side as well. And I would say, in general, there's nothing too notable to report there. I think there was obviously incredible performance from a credit perspective, you know, post-pandemic in 2020, late 2020 and 2021. I think in 22 and 23, it probably drifted a little bit negative. Most lenders, ourselves included, tightened up credit quite a bit at the end of 23, and I think so far performance there looks pretty good, so nothing too concrete to discuss there.
When it comes to the demand side of this picture, Ernie, and what people want and what they're coming onto those lots to look for here, are you seeing any benefit here from consumer weakness, meaning the idea that people that might have been in the market for a presumably higher price, newer car are willing to trade down and go for a used car instead?
You know, I think there's probably a ton of macro trends going on. I think affordability definitely drives that kind of behavior. So I think there's no doubt that's true. But I think, you know, most importantly for us, we're trying to give customers the simplest experience we possibly can when they're buying a car. It's a totally new experience. They go to our website, they can click around in a couple minutes, they can find the car they love, choosing from tens of thousands of options. We'll deliver it to their door. They can get financing in seconds. They can sell a trade-in to us in minutes. And so we're offering a really different experience, and I think our focus has been on giving customers the best experience we possibly can, getting more efficient at doing that, and that drove incredible results that we're really proud of, really over the last 2 years. But I think this quarter in particular, where we were both the fastest growing automotive retailer and the most profitable automotive retailer, is, you know, those are two boxes we're very proud to check.
Well, let's talk about fastest growing, because you and the rest of your executives got a lot of criticism over the last few years about the pace of that expansion. And of course, for a certain period of time, it decimated the stock, decimated it. Now, of course, we're looking at what could be probably one of the greatest comeback stories that we've seen for a publicly traded stock in decades. Yet you still got a lot to sort out. You got a lot of locations. Interest expense is still rising here. What's the message to investors here about making sure that this rebound does continue?
Sure. Well, there's a lot in that question. What I would say is I think if you look back at history at any companies that try to build anything that was differentiated, I think it's rarely a perfectly linear path, and it's generally very hard. You know, we've been at this for 11 years. We've spent $10 billion trying to build a completely different supply chain. We've undoubtedly, you know, made some great moves, and we've made some moves that in retrospect weren't perfect. But I think on average, we've always moved forward. And I think that the sum of those moves got us to this spot today, you know, where we're the fastest growing and the most profitable. And not just the most profitable this quarter, but we had, you know, this quarter we had the most profitable quarter of any automotive retailer ever. I think the position we're in now is incredible. I think the team that we have is incredible. I'm forever grateful for them for fighting through the last couple of years the way that they have. And I think from here, the opportunity is really large, right? We're in a huge market. We have a 1% market share, and we've got the team that knows how to go out there and tackle hard problems. So we're going to keep doing that.
If I'm looking at this correctly, your total debt, though, is still $6.2 billion. What are your plans for reducing it?
We'll reduce that over time. I think, this quarter we had $355 million in EBITDA in a single quarter, right? That starts to make that debt look a lot different than it may have looked a year or two ago. And I think if we keep having the gains that we expect to have, we'll keep accumulating cash and we'll keep looking much better from a leverage perspective as well.
I mean, I hear your pitch, right? The issue is it seems like a lot of the analysts still have holds on the stock. So you clearly have a lot of skeptics out there. How do you assuage them of the fear of too much debt and people are still worried about the fact that we'll actually make big purchases online?
I think in the real world, if you wait for everyone to cheer you on, you're going to be waiting a long time. So I think our job is to go out there and do the best job that we can. I think, many analysts, I think, are pretty excited right now. Many analysts are completely fairly, standing by and watching and trying to figure out where this is all going to go. Our job is to make as much progress as we possibly can, and so we're going to stay focused on that.
I am curious, though, when it comes to dealing with the debt load, as well as dealing with other obligations that you have here, any plans right now to go back to financial markets, whether it's equity sales or debt sales?
I think, I'll try not to run back the whole answer I gave you before because you called it a pitch, which was reasonably accurate if we're being honest. But I think the most important thing is just that we keep making progress in the business. The team's done an incredible job. I think we're in a very different spot than we were a couple of years ago. I think that story is still a fair one, but it's a very different story today than it was back then.
All right, Ernie, appreciate you taking time for us. Ernie Garcia, founder and CEO of Carvana, on the heels of those earnings last night. Of course, the stock right now up, I think something like 200% just this year alone. And of course, when you go back to the depths of where they were, a 90+% drop from their all-time highs here, you're talking about one of the biggest turnarounds, at least so far. The question is, does Ernie keep that on pace?
Yeah, and if you take a look at the other car makers, though, it's been really brutal.
Yeah.
Like AutoNation did really well, competitor of Carvana. Hertz also had results out. That didn't go so well for them. But you also have Volkswagen, lower deliveries in China, BMW, warning of China. I mean, the theme continues.
Yeah, and I mean, look, we're just already seeing this in the aggregate data here. I mean, there are going to be fewer cars sold most likely in 2024 than they were in 2023, if you believe what BI puts out here. The question is, where's that mix? And the question is, what's driving that? Is it about affordability? If you have it to finance in a car right now, you probably don't want to do that. And if you were paying for cash, I guess what? As somebody who was in a dealership, cars are still pretty pricey.
Yeah, but I was curious that when he said that a lot of people are buying Teslas, whereas Hertz has like all the Teslas.
Yeah.
and they're having a hard time.
They're trying to get rid of some of those Teslas.
Well, that's what I'm saying, but that clearly then there is a demand.
Deals. Just go knock on Tom Brady's door down there at Indian Creek and see if he's got a few extra things there. So.
You were the one looking for a car? Oh, you got a car.
Yeah, I got a car.
He's done.
Yes,
you're
right.
You can't have two in the city.
At some point, you'll get a ride in the back of my Bentley. But for right now, we're going to move on and talk about some of the other big movers out there. And actually, it's to the upside this time. Shake Shack, an incredible day for the company here. Basically saying, look, it's not trying to compete on price. It's trying to compete on service.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Bloomberg Power Players is back this September. As the top names in tennis take the court over in Queens, we're convening the best of the sports world right here in New York. We'll host some of the most influential voices in the business and identify what happens next for players and fans in this multi-billion-dollar global industry. Bloomberg Power Players, September 5th. Register now at BloombergLive.com/powerplayers.
Time now for our stock of the hour, Shake Shack. Shares up almost 16% here on the day, best day since February. This after the burger chain said it expects to generate positive free cash flow on an annual basis. That'll be the first time it's done that since 2017. Abigail Doolittle joining us right now for more. And what's kind of lost in all this too, Abigail, is not just that Shake Shack is doing well, but all these other fast food chains seem to be struggling. So why is Shake Shack somehow bucking the trend?
Well, they have this new CEO, Rob Lynch, and apparently on the call he was super impressive. He's talking about that he knows what the problems are and here's the solution. So the problem's marketing, which he's really trying to fix. Apparently they didn't talk too much about it because they want to keep it secret. Operations, and then apparently they have a drive-through problem. So those are the big problems. He's fixing it. So when you put that together, they came up with a 4% comp in the quarter that was encouragingly against this backdrop, because I know we're going to be talking about Wendy's in a moment, but the other day we were talking about Texas Roadhouse. That's another one of these companies that's doing well. But so many of these other fast casual, they're really struggling. It seems as though the consumer that trends toward these sorts of restaurants maybe has a little bit less cash, and so there's less demand. But Shake Shack really pulling in some loyal customers.
What I thought was really interesting too is he really poo-pooed the idea of a value war. Which you talk to any fast food analyst, the first thing they say is we're headed into a value war.
Yeah, he said that that's not the approach that you want to do at all. You want to improve service. You want to make sure that the product is great. The operations and the marketing focus on not competing, not think so much about your competitors, but think about what you can do best. And it seems as though it's a good strategy for them. Wendy's, on the other hand, they also have a new CEO, and I guess the call was the exact opposite, that this person did not impress in the way that Rob Lynch did.
Yeah, and I'm curious too, because it's also about differentiation, right? I mean, at the same time, Shake Shack and Wendy's, let's face it, they basically sell the same stuff more or less. Similar with McDonald's. McDonald's clearly going down the value perspective. I think we were joking right before we came on air that one of our cameramen got lunch at McDonald's today.
Oh, which one?
Burger, fries, and a drink. How much do you think that was, Abigail? $16. We only have about a minute left. So, sorry, not to cut you off. $16, which is
he may
insane
have
to me.
I think that's but still.
So I don't know, but it's a long way between the $5 value meal and that. But the question is, where does Shake Shack fit in the middle of that? I guess they've always been more of a premium priced, at least as far as fast food goes.
Yes.
More of a premium priced brand.
I think people really want the actual Shake Shack product.
Careful.
I know, a lot of alliteration there. I've only been there once, but clearly, a higher end burger, the fries, the shake. Right now they have this barbecue burger that apparently is really helping them out. But yes, they're not going down that route in terms of competing on price. And Wendy's, returning to Wendy's, they really cannot. They missed slightly. Their comp not even up 1%. I guess they're apparently still focusing on breakfast, which maybe is taking away firepower that they could put toward their other product. It's interesting, when I was a kid, I haven't been to a Wendy's in probably a few decades, but they had great burgers. Now I'm vegetarian at the time. I wasn't, but they have great
We know,
burgers.
Abigail.
I know. I have to. Whenever we
Can
do
I
these
just tell you
burger
something right
segments-
now? All this time, I really want a Frosty. You remember Frosty?
That's what I was about to say.
I haven't had a Frosty in years.
That's what I was about
like,
to say.
I used to work across from Wendy's, and I would just, I think I must have gained like 30 pounds on that job.
That's fair enough.
Yeah.
I mean,
they're so good.
All right, we're gonna leave it there. Abigail, thanks a lot. Really appreciate that. Abigail,
You would never let a
joining
Frosty
us.
cross your lip, would you?
When I was a kid,
Oh, a kid.
absolutely.
No, now you're Miss Healthy.
Not a chance. Yeah.
We
They all have
were
pizza
trying to
yesterday.
fly her with pizza. She's like, no, I got my salad and my
No, it's not.
greens.
I have my yogurt with nuts and my juice.
Oh, okay. All right. Well,
Let's be clear. All right, we're about 15 minutes away from a pretty brutal day in the market as we accelerate to the downside here. We'll break it all down with Q Nguyen, partner, CIO of Equity Strategies over Research Affiliates.
So seeing the results of a City and the YouGov poll here, 1 year ahead UK inflation expectations at 2.7% in July versus 2.6% in June. And the 5 to 10 year ahead UK inflation expectations up to 3.1% from 3% in June.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude, encore presentation this weekend, only on Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates.
So 1 minute now to expect the market on close imbalance.
What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
So we are looking now to the market on close imbalance. The S&P 500 is 1.6 billion to the buy side. NASDAQ 100 stocks are 1.3 billion to the buy side. Dow 30 stocks 475 million to the buy side. And Mag 7 stocks are 800 million to the buy side.
A secular global industrial renaissance going on. And people talk about AI, but it's also in power, it's also in sustainable energy, it's in the auto sector as well. And when you look at the breadth of capital that's needed from these high quality companies, it really reckons back to what happened in the US in the 1920s and 30s in the build out of railroads and industrial America.
The co-president over at Apollo Asset Management, speaking a little bit earlier right here on Bloomberg Television. 10 minutes until we get to the closing bells. Romaine Bostick alongside Alex Steele, keeping our eyes right now very close on a sell-off going on across all of the tapes.
We're off the lows, so if that's any consolation, but it's pretty brutal. The NASDAQ, for example, up about 2.2%. The Russell, obviously the hardest hit, but now just off by about 3%. Qualcomm doing really poorly. The SOX index, the semi-index, having its heaviest pressure of selling since March of 2020. I mean, it's really brutal. Bad news is bad news right now.
Yeah, the Philly Semiconductor Index actually recouping some of those losses, now only down 7% as opposed to the almost 9% that it was down earlier. And it gets to the thing that Jim Zelter was talking about here in this sort of AI renaissance, if you will. How much life is left in that trade? How much confidence is there in that trade? Koi Wynn joining us right now, partner and CIO of Equity Strategies, Head Research Affiliates, joining us here in studio too. And let's talk about that trade, because that has basically been the equity market, the public equity market, for really the last year or so now. And I do wonder if that is finally running out of steam, or you think this could maybe just be a bit of a reset, and then at some point soon we'll get back to it.
It's not unusual to have a bit of a reset given how much these stocks have rallied. If you look back to the early days of the internet bubble, or just the internet era, you saw Amazon, growing very rapidly, similar to the NVIDIA story, although from a very much smaller base. And I always take a look at between 1998 and 1999, Amazon had drawdowns of between 25 and 50%, 7 times.
Wow.
And look at Amazon now.
Yeah.
So I think that with these growth themes, with these large, themes that leave much to the imagination, you're going to get a lot of excitement and you're going to get a lot of fear.
Let's stick with Amazon for a second, because they do report after the bell, and particularly on the cost side, because this is kind of what Zelter was getting at. He sees this as a positive. But I'm sure you remember, Amazon got widely criticized back in the 90s for the amount of money that it was spending. It was basically just a money loser. And Bezos kept saying over and over again, there's a long-term strategy here, wait it out, it'll pay off. Obviously, it paid off. I feel like that's where we are now, except all the companies that are being criticized for this are now the behemoths of the world. They're not small companies with no cash flow, no revenue, no earnings.
Yes, I mean, that's one of the things that we see that is different, right? I mean, back then you had a lot of the Yahoos, a lot of the web vans. Some of them had capital to survive, some of them didn't. One of the reasons Amazon was able to survive was because they went to the market, raised a lot of capital to back their long-term plan right before the markets closed on the capital raising. But these days, a lot of these companies are self-funding. They're very cash flow positive. They're not going anywhere anytime soon. They may not be the biggest winners over the next 10 to 20 years, but they will be most likely survivors. And so, at Research Affiliates, we're value investors. We've been value investors for the last 20, 25 years, but one of the things we always say is that there still is some intrinsic value in these companies. Don't ignore them. You probably want to own them, but you probably don't want to own them at the weight that they are in the S&P.
Or at the exclusion of anything else, which leads me then to small caps. We're not seeing small caps outperform today. In fact, it's underperformed for small caps. Is that rotation trade done, or are we just pausing out altogether right now?
Anything can happen in the short term, but I do think that small caps are so heavily discounted relative to their large cap brethren. I mean, I think that if you take a look at what their normal relative valuations are and what they are today, small caps are so heavily discounted that if you actually just had a reversion to normal valuation relationships over the next 5 or 6 years, you could see a 7% outperformance annualized during that time. So that just gives you an idea of how cheap they are. These are not companies that are necessarily all terrible. I mean, certainly in small cap, we favor an active approach, something that includes a quality component or even a momentum component to it, I think helps.
Yeah, and some of the earnings, like Sprouts Farmers, for example, have been really solid. To the price action today, Is it fundamentally driven? Bad news is
It's been
bad
5
news
minutes
and
time
everyone's
now.
going
We
to
get the
recover?
cash
Is it a
equity close for the
continuation of
US
sell-off
markets,
from
where
last
earnings
week?
season
Is it
continues.
just
We have
fund
2 Mag
flows?
7
What do you
stocks
attribute it to?
printing after the close
I
today.
attribute it to
So at 4 p.m. Eastern
a little
Time, just under 5 minutes
overzealousness. I
now,
mean,
we're
one of the things
expecting
you're seeing in bond
Amazon to report their
markets
Q2 2024 earnings.
bond traders are
Estimated
pricing
EPS
in
is
three
$1.02
rate
with an
cuts,
estimated
for the
revenue of
rest of the year. I mean, if you actually
$148.78
had
billion.
3 rate cuts, I think that's actually
With
very
this, we
scary
get
because
Intel as
that
well,
would
meant to be
portend
printing
a
at the same
massive economic
time. That's 4
slowdown.
p.m.
Within
Eastern
2 rate
Time.
cuts,
With an
you're
estimated
probably in a
EPS
sweet
of 10
spot.
cents
You
and
know,
an estimated
inflation's
revenue of
easing, work isn't too bad.
$12.95
But 3
billion.
rate cuts is a
Obviously,
little
with this,
bit
I'll be
people are feeling
prioritizing
like,
Amazon's
you know,
earnings.
there might be some problems out there. I think that's the market's getting ahead of itself.
And just keep in
I mean,
mind
we
as
certainly
well,
are
so a
seeing
little bit
negative
past
surprises
the
on the
top of
economic
the hour,
front,
so
more
actually at
so
the bottom of the
than
hour,
we saw earlier
4:30
this
p.m.
year.
Eastern Time.
But we've seen this
Apple
before,
is slated
right?
to
We saw
print
this in
their earnings as
2019,
well,
we saw this in
with an estimated
2016,
EPS of
and those were actually
$1.35 and an
pretty good
estimated
times.
revenue of
Also, I'm curious, what do you
$84.46
see the
billion.
sell-off here that we've had, not just for today, but really over the last couple of weeks here, and how it's formed here? Is this really about the Fed and rates? Is this more about the corporate fundamentals?
You know, I think it's really about expectations. If you look at earnings announcements, you're getting pretty good positive surprises. I think over 3/4 of announcements so far have been positive surprises on earnings. But what you're not necessarily getting is you're not getting the bonus guidance, right? You're not getting guidance above expectations. And so a lot of this is just expectations were inflated, but growth looks like it's actually okay.
Yeah, and so you didn't get too rattled by some of the latest numbers we got this morning on unemployment and manufacturing like that. I mean, you don't really deal with that short-term stuff. I know. I can just tell by the look on your face. You're like, doesn't it go over long-term investors?
You know, one of the things I always say about U.S. equities is that the biggest mistake anybody ever made was actually just sell it. Right, because you know, once you sell it, at some point you have to get back in. Over the long term, equities perform.
All right, Quay, going to have to leave it there. Always great to see you. Quay Nguyen, partner and CIO of Equity Strategies over at Research Affiliates. Of course, we started the discussion off with Amazon. Amazon scheduled to report after the bell. I think that's the 4th highest weighting in the S&P 500, but we also get the #1 highest weighting as well, and that's Apple, also down here on the day by about 1.8%.
Yep, the question is, iPhone sales, particularly in China, is this the time where it's the last leg and the softest quarter, and from here we start to build towards that super cycle? What are those indications? I'm really curious.
We should also point out, this is actually going to be one of the busiest earnings days, at least in the post-market, that we've had this cycle here. Intel scheduled to report, MicroStrategy as well as a slew of smaller companies, including U.S. Steel, Block, Booking, Beazer Homes, Twilio, and quite a few others. So we've got a lot to go through. You definitely don't want to go anywhere. And it raises the question here, do those two big cap names, is that going to save the market if they do surprise to the upside?
Yep, and I'm sorry, exactly, but it's already priced in. Like, is actually selling into it not necessarily a bad thing when you come into the tape. We'll see.
Stick with us. Our full market coverage of all of those earnings is imminent, as they say, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, here to help take you through the closing bell. It's a global simulcast. It starts now with Scarlett Fu joining us in the television studio, Carol Masser and Tim Stenovic coming into us from the radio booth as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube.
Yeah.
A major sell-off going on across all of the major equities, including a 7% drop in the stocks.
Yeah, I love that you went there. First of all, we are seeing some buying here at the close, so we're just rounding off our worst levels of the session, but still down across the board. But yeah, kind of blows my mind.
Shortly
right?
expecting earnings from Amazon and Intel.
Yesterday, well, they gave it all back today, down 7%, as you just said.
Intel, one of the companies, down 5% in the stocks. That company expected to report results in just a few minutes, along with Amazon and, of course, Apple coming at 4:30. We're going to have those numbers for you as soon as they cross.
What's interesting here is volume. Volume is really elevated compared to the 20-day average. For the S&P 500, about 30% above the 20-day average. For the NASDAQ 100, which includes two big companies reporting, it's 40% above the 20-day average.
And here's also the question, too. I understand, as we're going into earnings, there's a fundamental, like the bad news is bad news, but also in general, there's still a lot of equity longs within the systemic funds, volatility-driven funds, CTAs, and is this just a continuation of that selling that was really triggered over the last couple weeks?
Yeah, and then you're also up against the whole seasonality issues as well here, so that's obviously feeding into the price action as well. A significant drop in Treasury yields today with that 10-year 10-year yield looking like it is going to close out the day below 4%. A drop in commodities, elevation in the VIX at 1 point trading above 19. As you get the closing bells here in New York, as we wait some big earnings, let's walk you through the numbers here. Dow Jones Industrial Average looks like it's going to finish the day down by more than 500 points, or about 1.3%. Of course, it takes a few seconds for these numbers to settle, but you get the gist. 76 points lower on the S&P 500, a 1.4% decline. Meanwhile, the NASDAQ Composite down about 2.3% here on the day. NASDAQ 100 down about 2.4%. But let's take a look at the small and mid caps. Dow Transports down 1.7%. Mid caps down 2.1%, and the Russell 2000, Carol, closing out the day with a 3% loss.
All right, back to the big caps we go, though, and most names in the index lower, guys. 330 to the downside, 173 to the upside, Scarlett.
Yeah, but you look at the sector breakdown, and most of the declines, as expected, are in infotech. That group is off by 3 1/3%, and what you want to pay attention to is the bright red slice of that pie. That is semiconductors, and they're off about 7% at the moment.
So seeing Amazon earnings coming through now. EPS a beat at $1.26 on estimates of $1.04. So their operating income, that's a beat at 14.67 billion on estimates of 13.59 billion. Net sales, that's a miss though at 147.98 on estimates of 148.78. AWS net sales ex Forex are up 19%, which is a beat on estimates of 17.2%. The North American net sales are beat at 90.03 billion and estimates of 89.98 billion. The physical stores are missed at 5.21 billion and estimates of 5.26 billion. So looking to forward guidance, they see their Q3 operating income at 11.5 to 15 billion, which is on the low end of the prior estimate of 15.66 billion. Net sales for Q3, they see it at 154 billion. Their prior estimates were 158.5 to 158.4 billion. So misses on their forward guidance and on their net sales for Amazon as well. Amazon shares dropping 5% on bad forward guidance and net sales misses.
The third quarter operating income will be 11.5 billion to 15 billion, big range. Analysts were looking for 15.66 billion.
Okay, I'm looking at Intel right now. The company shares are just cratering in the after hours. Sees third quarter revenue $12.5 billion to $13.5 billion, a huge miss. Estimates were for $14.38 billion. Shares down 9% in the after hours. Intel second quarter adjusted gross margin coming in at 38.7%, also a miss. Estimates were for 43.6%. Sees third quarter adjusted gross margin at 38%. Estimates were for 45.5%. Shares down 10% in the after hours.
Yeah, and the company announcing that $10 billion cost reduction plan to increase efficiency and market competitiveness, implementing a more than 15% headcount reduction, suspending that dividend starting in the fourth quarter of 2024. In 2025, next year, company targeting gross capital expenditures between $20 billion and $23, and net capital spend between $12 and $14 billion.
So that's going to be a little bit whittled away here. I mean, that's what really jumped out at me. You suspend that dividend, you're obviously reducing the headcount. This now becomes a cost story, and this was sort of the concern with a lot of these companies about the spend that they were having to do to sort of keep pace with whatever new era we're going into. Some companies will be forgiven for that, but obviously for Intel, at least based on the initial share reaction, not quite so forgiving.
Yeah, let's go back to Amazon, guys, for a second, because that third quarter forecast is what is raising some eyebrows here. Net sales estimates on the high end, about 58.5 billion, and as Scarlett pointed out, is quite a range. That is just in line with what they were expecting before. Operating income, though, to be about $15 billion on the high end, that misses estimates that seems to be very much weighing on shares for the quarter, despite the fact that their physical online stores and AWS growth, et cetera, delivered very much so in the second quarter.
So the big question for Amazon clearly is what they say about how much AI contributes to Amazon Web Services. And each company has kind of done this in their own way. Microsoft talking about the contribution, the points contribution to Azure sales, for instance, but not really itemizing exactly how much it is. So that's going to drive the narrative for Amazon going forward.
Yeah, Andy Jassy flicking at that, Scarlett, in the press release, saying that as companies continue to modernize their infrastructure and move to the cloud, while also leveraging new Gen AI opportunities, AWS continues to be customers' top choice. We have much broader functionality, superior security and operational performance, a larger partner ecosystem, and AI capabilities like SageMaker, Bedrock, Trainium, and more.
But again, some disappointment, no doubt about it. Just to rehash, guys, you've got Amazon down 5% here in the aftermarket. The big headlines, second quarter AWS net sales, that is 26.28. That's a beat, but the outlook, the third quarter operating income, 11.5 to 15 billion, and the street estimate is above that, $15.66 billion.
We got MicroStrategy a little while ago here. Let's get right to it. Of course, the software company that's effectively been operating as a digital hedge fund. Its digital assets in the most recent quarter continued to grow, $5.7 billion right now on the balance sheet. What did that translate into on the top and bottom line? Well, a loss of $5.74 a share, greater than what it was a year ago at $1.52, and revenue also coming a little bit light at $111 million.
All right, just a quick check in here on DoorDash. Looking at its gross order value for Marketplace, coming in up 20% year on year, coming in at 19.7 billion. That is better than estimated. Revenue also coming in stronger than estimated. Gross margin bang in line with estimates. Orders also increasing, and if you take a look at their third quarter, they're also seeing on the high end about $540 million.